how the UK is not what it used to be. Are you confident that actually your industry can really thrive and kind of show the rest of the world what it can do almost?
Absolutely. So I am very confident in the UK life sciences environment, both the academic, from a pharmaceutical perspective, very confident as well. But also it is a hub of entrepreneurial and in innovation. And so I think it's a sector which this country will have at its core as it moves into the next decade and beyond. And so I'm very confident, and that's why we're putting our brand new headquarters right in the middle of that knowledge quarter, so we can be continue to be part of that success story.
And you're confident that even in an election year, do things change for you actually, or for funding in your industry if we're under a Labour government?
I think there's bipartisan support actually for the life sciences industry. It's one of the core economic drivers of UK PLC, and so my expectation is that there'll continue to be support whichever way the election goes. Luckily, pharmaceuticals is my thing as opposed to elections.
Deborah, thank you so much for joining us. A lot of people would say that actually, in that they'd rather be in private right now than fighting it out on the streets. Deborah Waterhouse, Chief Executive of Aviv Healthcare. Coming up, mining giant BHP is targeting its UK rival, Anglo American, in what could be the biggest deal of the year. We discuss what it means for the sector and what it means for the City of London next. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
World of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Now, the world's largest mining company, BHP, has made a takeover approach for its UK rival, Anglo American, a move that could spark the biggest shakeup in the industry in over a decade. Let's bring in Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Will, I mean, we're seeing it kind of come together. What's the likelihood this goes ahead?
I think there are considerable hurdles, Francine. The first is the complicated structure of the deal that BHP has given in its proposal to Anglo, which is that before it was happen, it would like Anglo American to divest itself of its platinum and iron ore businesses in South Africa, which aren't terribly appealing to BHP. Now, that's complicated because the biggest shareholder in Anglo American is the state investment arm of South Africa, the PIC, and they will be fiercely protective of the future of those businesses. I think the other hurdle that people see is perhaps antitrust. As you said, it will create the world's biggest supplier of copper with more than 10% of the market. China buys half the world's copper and has shown a willingness to intervene in these kind of transactions before forcing Glencore to divest a mine during its takeover for Xstrata more than 10 years ago. So those are the hurdles. I think it's a complicated deal to get done.
Yeah, and then, of course, I guess in a couple of weeks, we'll see if it does get done, what it means for the City of London, and whether it's in the FTSE's benefit to have some of these two companies merge. Of course, they're dual-listed. Will, thank you so much, as always, for your great expertise on all matters of energy and commodities. We'll continue watching the markets. It's a big earnings, well, I'd say day, but actually it's a big earnings week, and then we look to some U.S. data a little bit later. Bloomberg Brief is up next, and this is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Good morning from our global headquarters in New York. I'm Menace Cranny with Denny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Meta's disappointing forecast in AI spend shakes tech investors with more Mag 7 earnings on their way. Mining giant BHP approaches rival Anglo American with a takeover offer. Anglo considers a sale of its diamonds unit De Beers. Plus, an avalanche of earnings in Europe. Deutsche Bank reports a beat on fixed income trading revenue.
Good morning. It's like the field of dreams. Tech came to die last night. Meta got trounced down by 19%. It dragged the entire complex lower. Meta is still lower this morning by 13%. Asking for patience, patience with my capex, patience with my dreams, was not rewarded for Zuckerberg, but it was by Elon Musk. It is about the capex and the spend, 35 to 40 billion. That is more than the market had anticipated for the future, for the dreams. That's the spook. 10-year yields this morning are virtually flat on their knees. We're waiting for another auction today. Today it's about the sevens, $40 billion worth of 7-year paper will come. You've got Brown Brothers Harriman saying demand is solid, even though they had to cheapen up ever so slightly yesterday to get the auction away. Dollar yen, we are on constant intervention watch, because the very definition of what Candace said is the moment of intervention is when dollar up by 4%, yen down by 4% in the space of 2 weeks. That rings the bell for intervention. Good morning, Ms. Berger.
Good morning, Manus. And we have a little bit of breaking news to start our morning off with us. There's a new CHIPS Act winner. Micron is the latest, Manus. This confirms our reporting last week. So the details, the U.S. is going to award Micron $6.1 billion in grants, $7.5 billion in loans. The idea, help them build a new factory in America. It's the latest and potentially one of the last of these awards we're going to hear from the federal government.
Well, it's certainly going to be interesting to see how this administration plays this out into the election, which is about bringing home business to the shores of the United States of America and really ring-fencing the integrity of chips. Just think of the list. Intel got $20 billion in grants and loans. That was in March. TSMC got $11.6 billion. That was in April. And Samsung, $6.4 billion in grants. They did not get loans in April. So again, there's a deeply political message here as well about making America independent within the chip spectrum. But of course, your biggest ally is Taiwan. What does all this mean for your relationship with Taiwan?
Yeah, there's been some excellent reporting, a lot of it from the New York Times, about the cultural differences at TSMC's Arizona factory. Highly recommend that for a read. But Manus, you know the
cultural differences.
Yeah, that's us. Yeah, we mesh though. We do okay.
Blend.
Yeah, I lived in the UK long enough. I kind of get it. But Manus, we have to talk about the tech elephant in the room. It's not the CHIPS Act winners. No. It's Meta. Painful this morning. I think it's down 12.5% in the pre-market so far. Oh, 13. There we go.
This comes down to which CEO set of dreams do you believe? That is what this comes down to. Okay, that's being a bit facetious, but it's about which CEO do you back? Do you back Elon Musk or do you back Musk? That is the question.
Right, but the difference here is that after Meta's last earnings, it had a record surge. It added the most market cap ever for any company versus Tesla, which was beat up to its earnings. So maybe the bar was just different between the two.
Indeed. So what can we expect for this year?
As we're scaling CapEx and energy expenses for AI, we'll continue focusing on operating the rest of our company efficiently. But realistically, even with shifting many of our existing resources to focus on AI, we'll still grow our investment envelope meaningfully before we make much revenue from some of these new products.
Alex Webb is standing by to talk us through his take on this. To quote Mr. Zuckerberg, smart investors see the potential in AI and Reality Labs even before they make money. Trust me, I'm a genius.
I mean, it's a pretty simple calculation as to why we're seeing the stock decline right now. They've spent the past year telegraphing the fact that they care about shareholder value, that they are going to reduce their expenses, that this is a new Facebook. Then suddenly, not only have we seen a slight anticipated slowdown in growth in terms of what the market was expecting compared to Facebook's own or Meta's own forecast, but also they're going to be expanding spending. That sort of says, actually, we're a slightly longer duration stock than you thought. We're pushing out some earnings in the expectation given in a few years' time. In this high interest rate environment, investors don't have as much patience for that sort of thing as they might have done a few years ago.
I mean, I thought Meta learned this lesson last time, as you said, Alex, when they were punished and then decided to unveil the year of efficiency, perhaps, which is no longer that. We're also going to hear from Microsoft. Clearly, their AI push is one of also spending and also dominating perhaps some of the earnings. What matters then for shareholders in analyzing their earnings?
You know, Microsoft is really about seeing whether all that expense on bringing AI capabilities, particularly into data centers, is yet starting to reap rewards. When we think about NVIDIA and the huge surge that's been on, it's because companies like Microsoft and Google and Amazon and now increasingly Meta are buying their chips to kit out their data centers. They do that with the expectation that then companies will port more of their processes into AI and onto their cloud. Investors really want to see now that that investment is paying off and that indeed that AI revolution is in fact happening.
What is it that Alphabet need to convince the market of this evening? For them, it is about the advertising dollar. Economies are strong here in the United States of America, and globally we've had a robust performance. But what is it that Alphabet needs to convince the market of? The stock is up 14% this year.
So there's a strong cloud piece here. For quite a long time, Google has been trying to reduce its dependency on that core advertising business, which accounts for the majority of revenue and indeed earnings. And AI seems to be providing it a little bit of a tailwind to make that happen. So on that basis, it's a similar story to Microsoft, but still advertising is, as I said, the lion's share of its business. The fact that Meta has telegraphed a little bit of softness in that space, softer at least than what had been expected, will mean there will be attention on that at Google. But don't forget, Google is the place that if you are in the business of selling anything, certainly consumer products, you need to be advertising on Google. It is the first place that people will spend their advertising dollars, the last place that they will almost certainly give up their advertising dollars. So it has a lot more resilience than Meta, and there's therefore quite a lot of enthusiasm about the prospect of riding the coattails of the economic resurgence.
Okay, it's the last place you're going to cut your spend on Google. Alex, thank you very much. Alex Webb. Our next guest says this about Meta. Spending needs to be targeted in line with a clear strategic view. The see what sticks method of years gone by won't be tolerated by the investor base. Meta's resources are vast, but they are not infinite. Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. Sounds like your patience is running thin for Mr. Zuckerberg's future dreams.
Hi there. Yes, I think you could probably say that, really similar to what Alex was just saying. This is a direct reversal of what investors have been promised, and particularly in this higher risk, higher rate environment, I would argue that now is not the time to be trying to hard launch extreme spending plans once more. The reason that the market had thanked Meta in recent months was because it was very much understood that pretty significant AI investment was absolutely going on in the background, but there'd been this really core refocusing on the main traditional business elements, and they've kind of scrubbed that all out and spooked everybody again is essentially what's happened.
Do you think that this is a Zuckerberg, Sophie, that is willing to go back to basics, willing to go back to focusing on ad? Because again, as I said to Alex, I thought he learned that lesson when shares last year were punished and he unveils the year of efficiency. Do you think he's likely to go back to that, or have we lost him at this point if he reverses course?
I think at this stage, I'd actually be quite surprised if he reverses once again. And what is slightly worrying to me, really, is that this method that the market seemed to be supportive of was this idea of a bit of half and half, right? Absolutely go away and work on these moonshots and these AI capabilities, but at the same time remain focused. It was a 50-50 approach. What seems to be happening here is we've gone all the way back to all or nothing, and I don't think that we're going to see a reversal of that again at this stage. Now, of course, nobody is arguing that AI should be forgotten about or underinvested in, but I would argue that this is a bridge too far for this current moment in time in the market.
And yet the language differential between Musk and Zuckerberg was very clear. Musk saying to the market, look, if you don't believe in my future of robo-taxis, get off my shareholder list. And Zuckerberg actually taking a similar, if you don't believe in the future of AI, then you're very much mistaken in your interpretation. Let's move the agenda along because we've got a lot more to get through in terms of Microsoft along with Alphabet. I want to focus in on Microsoft. You say it has muscled its way to its pole position in the AI race. And Dan Ives would agree with you there, which is over at Wedbush. This is the iPhone moment for Microsoft. Is it as evangelical a moment as that?
I certainly think it could be. I mean, the reason that Microsoft, or that I'm so, and I think most people are so bullish on Microsoft at the moment, is because that path to monetization from AI is really, really clear. It already exists, you know, the ways that it can be embedded into existing products and processes. So that for me is huge and is something that I think potentially gets overlooked, just that technical element of, you know, it can be embedded in things it's already selling. And I think that really for me, I do think that there's further upside to come. Of course, now I've jinxed it, now I've said that. But I think absolutely that Microsoft is in a brilliant spot in this race. That said, not to fully contradict myself, you know, in the scheme of things, we are really at the very early stages of this AI race, really. Yeah. So we do know that these things can obviously change at short notice.
And they have plenty of companies snapping at their heels too, Sophie. Okay, let's round it out for the earnings bonanza we're going to get today. We're also going to get Alphabet. We learned from Facebook that their projection for ads were in the mid-range. Digital ad prospects maybe not as strong as we thought. Does the same translate to Google? It's obviously down heavily this morning, not heavily, but more than 2% for Alphabet. Can we say, okay, Facebook's ad revenue wasn't as strong as we thought for their forecast, therefore I'm concerned about what Alphabet delivers today?
Yes, there is a part of me that is quite apprehensive. As much as I agree that Google is the be-all and end-all if you're trying to market anything these days, it's not a shoo-in, it's not a definite in terms of capturing spending dollars at the moment, especially when we start to look at smaller, medium businesses that are potentially going for more nimble options on the likes of Meta's platforms. And also, we know that there has been some weakness from Alphabet. You know, we've heard from WPP today that there's been a slowdown in ad spending from tech companies in North America and China in particular as well. So just all in all, the global picture for ads is looking a little bit more challenging than I was certainly hoping for.
So if we were going to catch up with Nancy Tengler a little bit later on, and part of her thesis is about the cash generation aspects of the balance sheets and the robustness, the financial robustness of big blockbuster tech in America. Does that pillar play into any of your thesis, or is yours very much predicated on the show and tell narrative of the future with discipline?
It absolutely has to have both, in my opinion. You know, for me, the absolute cornerstone, the backstop of these stocks is their balance sheet, because for me, it's lovely to get carried away with the future, but you know, for me, I'm quite traditional. And if you look at the financial resilience there, you know, look at Alphabet, you're looking at over $100 billion just sitting on the balance sheet. However, one thing that I would say against that is that there certainly is an argument, in my opinion, that more could be done with some of those balances. I think they are a bit too extreme, and sometimes it would
you like to see bigger dividends? Would you like to see bigger buybacks and dividends? Briefly, for interrupting. Sorry for interrupting.
Yes, I think. Yes, that's okay. I think absolutely that would be something that could be a more prudent use of some of that cash. You know, they're so phenomenally huge. They don't need that much money sitting on the balance sheet.
Sophie, thank you very much. Sophie Lund-Yates of Hargreaves Lansdown. A real reality check on big mega tech. Okay, other stories trending on your Bloomberg terminal. Are there any other stories apart from big tech? Well, U.S. Secretary of State Antony Blinken raises the concerns about unfair trade practices. These are in his meetings with senior Chinese officials. He underscored the need for a level playing field for the United States firms while in Shanghai. Blinken will meet with the Chinese foreign minister in Beijing on Friday.
And meanwhile, Columbia University backs President Namat Shafiq, defying calls for her ouster. In a statement, the university's board said it supports Shafiq's approach to managing diversity of voices on campus. Columbia's faculty has been given the option to hold classes online as protests on campus continue.
Sells a Nestle sputter. The maker of Nespresso coffee was hit by cooler demand in North America and supply constraints at its vitamins unit. Nestle shares fell as much as 5% in early trade. That's its biggest decline in 2 months.
I just ditched my Nespresso machine for one of those fancy espresso ones.
Too expensive.
I got it as a present, so that's my justification. Not from Manus, it's okay. All right, coming up, we're going to discuss the biggest shakeup in the mining industry in over a decade. We're going to dig into BHP's offer to take over Anglo American.
And Barclays, Deutsche Bank, and BNP Paribas beat the expectations for the quarter. We'll unpack the latest results. Context matters on Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Bloomberg Brief, Danny Berger and Manus Cranny in New York. Some deal news for you. Shares of Anglo American are surging in London, up some 12.6%. Its rival and the world's biggest mining company, BHP, has offered a takeover bid that would value the company at almost $39 billion. Let's bring in Bloomberg's Will Kennedy from London on this. Will, I mean, this is the biggest deal of its size, the biggest shakeup in at least a decade. Why Anglo American and why now?
Well, BHP, I think, have been thinking for a while that they might want to do big deals again. They haven't always gone terribly well for them in the past, but the current CEO, Mike Henry, has, I think, tasked his management team with looking at deals like this. What does he want from this? Well, he wants Anglo American's copper assets. It has a very nice position in Chile, the world's largest copper producer, and copper is the metal of the moment. Most people are very optimistic about its demand outlook because of all the copper we're going to need to electrify the global economy. Think electric cars, think new grids, that kind of thing, at a time when supply is fairly constrained. So he has a bullish view of the copper market, and this is a way to increase his exposure to copper. The combined companies would have 10% of the global market.
Will, that draws the very natural question, which we understand the thesis, capture 10% of the market, deliver the efficiencies. I'm sure that will be part of the narrative, scale, efficiencies, etc. But then you're going to have major competitive antitrust issues, are you? Where are they going to be most present? I know there's a South African business, but where do you see the antitrust issues?
So there are two big obstacles, at least, to getting this deal done. The first, I think, let's talk about antitrust first. We saw in the previous round of consolidation, when Glencore bought Xstrata, that China was willing to intervene in those deals. Now, while there aren't any Chinese assets at play, China would be far the biggest customer of these companies. It takes about half the world's copper, and so has an interest in perhaps not seeing a more concentrated copper mining industry. So it may have something to say about one company having 10% of the global copper market. The more immediate problem to getting this deal done, as you say, Manus, is South Africa. Now, already in their offer, BHP says it's contingent on Anglo American divesting itself of its platinum mining business in South Africa, its iron ore business in South Africa, both fairly troubled businesses which do not add much to BHP's portfolio. But the problem they have is that the biggest shareholder in Anglo American is owned by the South African government, and they will want to protect South Africa's interests.
I'm afraid we're going to have to end it there. This won't be the last time we talk about this, I know. Will Kennedy, thank you very much.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Brief. I'm Manus Cranny alongside Danny Berger in New York. Let's get you through the front pages. What else do you want to read? Here's what's making headlines around the world. First up, we have a deeply divided Supreme Court, Danny. The New York Times reports there was a 2-hour questioning. That was on Wednesday, with the justices arguing whether federal law should allow emergency abortions in states that have near-total bans. Now, the case is focused on the conflict between the state of Idaho and federal law.
Now, next up, Manus, Boeing is on the front pages of the Wall Street Journal. They had their earnings that showed a near $4 billion cash burn in the last quarter. The financial hit, this won't surprise you, stemmed from the Alaska Airlines mid-air accident. Adding insult to injury, Moody's also yesterday downgraded the firm's unsecured debt to a BBB rating.
Now, I love this
it's
story
excellent.
because this is what I dream of being able to do one day. But of course, I'm nowhere in this league. It is the Jefferies.
Dream big, Manus.
Dream big. Dream bold. Jefferies CEO Rich Handler, he sold $65 million worth of shares in the firm, partly to buy himself a yacht. It is the first time that the CEO has made a stock sale in 34 years. So, you know, to be fair, if it's the first time you've done something like that in 34 years, why not have a yacht? I mean, it just sort of shows, you know, that's somebody who's locked up their wealth, built a business, and now they take a little bit out. It's 7% of his aggregate holding, so he's not exactly bailing on Jefferies.
I was going to say, if we don't mind Jeff Bezos selling all of his Amazon shares just because he moved to Miami, then why should we care if someone did it to buy a yacht? The thing I don't understand, Manus, is why not do the thing that most billionaires do? Just use your shares as collateral and take out a loan to buy the yacht. Then you wouldn't have to deal with all these questions. Maybe interest rates are too high.
You're working on the assumption now that he hasn't leveraged the stock.
Oh, that's a good point. I was going to say maybe rates are too high, and this purchase of a yacht is a reason the Fed should cut.
There you go. Who wants to borrow money at LIBOR plus? Well, it's not LIBOR anymore. It is. That just shows you how old I am. Who wants to borrow money at 5% plus 2% extra for the yacht? I'm sure. Maybe he's got good terms from Jefferies on a revolving credit line. What do you reckon?
That'd be excellent. I'd hope so. The man has done enough for them. Hopefully, they'd give him that at least.
See, praise indeed from Danny Berger. Keep an eye on dollar yen. She wanted this in so badly.
I did. It's important. It's crossed 155, Manus.
Crossed the Rubicon.
It has, and today kicks off the first day of 2 of a BOJ meeting. What do we get tomorrow? A surprise hike?
Oh, maybe a little bit of an intervention like you got in 2022. But there's one lady, she's on the side of the set, Nancy Tengler, CEO of Laffer Tengler Investments. What does she think of big tech?
Most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No. Rambo was a novel by David Morrell. And I was the 11th choice. Everyone. It was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our global headquarters in New York, I'm Danny Berger with Manish Cranny. Let's set your agenda.
Meta's disappointing forecast and AI spend shakes up the tech investors with a Mag 7's earnings, more to come. Mining giant BHP approaches rival Anglo American with a takeover offer. Anglo considers a sale of its diamond unit, De Beers. Plus, an avalanche of earnings in Europe with Deutsche Bank reporting a beat on fixed income trading revenue. Danny, it is all about getting shaken up with big, bad tech.
Yeah, I was going to say, good news for the banks, bad news for tech. Beautiful alliteration, Manus, as always. It's been a tough 24 hours for these markets. We're off the lows of the future session. We're down more than 1% on the NASDAQ at one point, now down about 0.9%. Meta still down 13% after their earnings. U.S. 10-year yields, those are little change this morning, 4.6%. There was a slight sell-off in debt yesterday, really led by Europe and Australia. A lot of auctions, record auctions. They've been absorbed. They've been fine. They did demand a little bit of a higher yield yesterday for the 5-year auction today. We're going to get $44 billion worth of issuance for 7 years. Finally, dollar-yen. Manus, you and I were just talking about this. We're back above 155 per dollar. Everyone's screaming intervention, but we're going to get a BOJ decision tomorrow. Oh, and not to mention US PCE, which might exacerbate this if it comes in strong. Jane Foley over Rabobank saying the MOF will probably be hoping that the Bank of Japan, Manus, can offer some hawkish commentary after Friday's policy meeting.
Yeah, well, according to the narrative from the Bank of Japan, it is about a move of more than 4% over the space of 2 weeks. That would invoke the wrath of intervention that we saw in 2022. But there's no doubt about it. That movement in Meta, Danny, is the momentum driver, and it's interesting because it's about two different CEOs, but both basically saying, "Be patient. We have a dream. We have a future." One of them managed to sell it to the market. His name was Elon Musk, although the bar was low.
Yes.
And the other is Zuckerberg, who's basically saying, if you can't see the beauty of AI, then you don't have enough vision.
But see, this is the thing with Musk. It's always been what you see is what you get. He's always had this line versus Mark Zuckerberg, who late last year said, this is the year of efficiency. We're going to rein spending in. Instead, we got a very different Zuckerberg on the call. Manus, I picked out this quote from him. He said, to your point, historically, investing to build these new scaled experiences in our app has been very good long-term investment for us and for investors who have stuck with us, saying, doesn't it pay to be loyal? Joining us now is Nancy Tangler, CEO of Laffer Tangler Investments. Musk there not Musk, getting my CEOs confused. Zuckerberg there also pointing to things like moving from desktop to mobile, investing in Reels, all of that paying off. So do you trust him this time around, Nancy?
No.
Okay, why?
We don't own the stock. We sold it a while ago. You could say I was wrong, but we bought Spotify, so you could also say we were right. That's the dilemma of being a portfolio manager. But I think to ask investors to be patient is never a good plan for any CEO. You need to lay out the vision. And even though Tesla's CEO, Elon Musk, was long on promises and short on specifics, he has a history of doing that and ultimately delivering. And so I think this is going to be a difficult, rocky period for Meta.
You were just so emphatic. No. I know you don't answer that you don't own the stock, but no. Do you trust the CEO? No. Here is the issue, which is it's about a belief of product and it's about a belief of delivery. When you see CEOs that keep extending CapEx higher with perhaps more mediocre guidance on the revenue in a higher for longer environment, is that what challenges growth even more so at this moment in time?
Yeah, and I think you could argue, we used to own the stock, and I think you can argue that he hasn't learned his lesson. It's, listen to what I say, and you nailed it in the opening, Danny. We've been here before. Where the CapEx for the metaverse, and now we're in AI chat box spending. Whereas I think with Microsoft, the use cases are multiplying in generative AI. And so, we own ServiceNow. They had a fantastic report last night, if you ask me. The stock's down a little bit this morning. But Bill McDermott is an excellent CEO. He's delivering mid-20% earnings and subscription growth. Revenue and subscription growth, and he's a hell of a salesman. And that
he sold himself to you.
Yeah, but Nancy,
have a little crush.
Okay, yeah, why not? But Nancy, why can't I say, sure, Zuckerberg wants us to trust in the future he's building, but why can't I give him the time? Because he's one of many companies that have this fortress balance sheet that pays off as long as rates are high. Why doesn't that afford him more time?
I mean, you can. I think there's better places to be, particularly in the AI realm. I mean, I haven't used the Facebook or Meta chat box, but it feels more to me like low on productivity and high on time wasting. And so that's not what we're looking for. Our analogy to the 90s is because I was managing money then, and productivity saved the day. And I think that's what we're going to see with generative AI in this next few years. It's going to actually deliver productivity improvements.
And that's why you believe much more in the Microsoft, the thesis, the delivery, the potential to deliver, even more aggressively. They've got their open AI. They have a much better narrative to sell you.
Absolutely, and I think and that's also the case with Now. They are taking IT spend share from others, and so that's something that you want to look for. They're in the sweet spot in the generative AI cloud computing area, and Google, I think, is even in a better position than Facebook going forward. So they're starting to act like a grown-up company.
Right.
Moving protesters out of the company and setting some parameters for their employees that most of us live by every day.
Right. Manis, can I ask Nancy the question that we both want to ask?
Why not? Let's have a go at it.
Nancy, I'm so sorry. It feels like we're asking you this every time you come on. I promise we'll stop one day.
I think it's a fair question. It's a great benchmark. You're very honest. I will give you that.
True.
So we'll take it away.
So you can give me more than that.
Very honest. I can give you outstanding, actually. You roll with pretty much any punch that we throw at you.
But this is the thing, Nancy. You stick to your principles, and one of them has been NVIDIA is too expensive. So here's the question we ask you every time. It falls 13.5% next week. Did you buy, Nancy?
Well, we didn't, but we're waiting still. I think it needs to be a little bit cheaper for us. Now, if you look at traditional metrics like price-earnings ratios, the stock's not expensive. We use relative price-to-sales ratio with growth stocks. So what am I paying for a unit of sales? And it's still a little bit expensive. Now, I did put in an order to buy it personally, but I kind of missed it again. So I was busy doing, who knows what. But yeah, so we want to own it for our clients, but we still are pretty happy with our AI exposure across the board.
Yeah, at least you have some exposure, even if it's your personal portfolio. That counts for something, I think.
There you go. Look, there's been big dislocations, hasn't there? I mean, if you think Tesla was down 40% before it went into the earnings.
We bought.
You bought it on the dip, did you?
We did.
Okay, just from a price action value or belief in robo-taxi and his narrative, which is I'm going to come up with a Model 2 at the right price at a lower production cost. Which bit did you believe?
Long on promises, short on specifics. We own the stock for the mega battery, mega pack utility grade battery end of the business. It's fastest growing part of their business. We think it's going to be bigger than cars in 3 to 5 years, and it's the most profitable business. And they're the low cost producer in the industry. So I think if you're a believer in renewables, that's the part of the business that you want to be focused on. But it trades as a car company, right? It trades on EV numbers, on demand. I think 3-5 years from now, we're going to have a very different discussion. And last thing I'll say, I commute a third of a mile every day, and in Arizona, I can't get in my car and get to the office without seeing a Waymo coming and a Waymo going. So even though in New York City you probably don't have much exposure, they're all over Phoenix and Scottsdale. And I do think, Tesla has 300 billion driver miles in the books. So they're learning, and they're going to be second to market, and that's not a bad place to be in many cases.
She just burst our little New York City bubble.
Well,
get outside a little bit.
Yeah, but you see, that is the whole discussion around politics and stocks. There's a metropolitan elite that talk about politics and talk about stocks in a very different way to the reality on the ground.
Yeah. I mean, it's true, as is evidenced by the Teslas, the Waymos elsewhere in the world, Nancy.
Nancy, good to see you. Sorry you didn't manage to get any of the stock on board for the PA account.
Oh, God. I'm buying it today.
You're buying it. Nancy Tengler there of Laffer Tengler Investments. Rolling with the punches. Coming up in the show. Well, Hermes defies the analyst expectations. Waning demand from China. More on the context that matters for Hermes.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried had pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Alongside Danny Berger in New York. So we've had Deutsche Bank's numbers and the investment bankers. They stepped up to the plate last quarter to help the German bank deliver a revenue beat. The CFO, James von Moltke, projects continued recovery.
The recovery in the wallet in corporate finance will continue across the year. Q1 was obviously very strong in debt products, so investment grade and a recovery in non-investment grade. We do expect that to continue and hopefully see a further recovery in M&A and equity activity.
With the Deutsche Bank CFO there sitting down with our very own Oliver Cook. Cook, good to see you this morning. From one suave CFO to a suave reporter. Talk us through the conversation. I mean, bonuses, private credit. What stood out? Good morning.
Yeah, man, it's really the headline here is the investment bank, where really did the heavy lifting this quarter, up 13%, and namely in FICC trading. That, of course, took the sort of spotlight here for Deutsche Bank, up 7%. When you compare to what happened in the United States, where on average it was down 3%, and really the only U.S. bank to beat them was Goldman Sachs, that really is a standout, particularly when we look at the numbers out of Barclays and BNP today, where we saw fixed income trading down some 20%. They have certainly something to be happy about there. In terms of what it looks like going forward, he's seeing this sort of FICC trading moderating a little bit. There is some interesting sort of comments on the ECB slowing down a little bit in terms of the anticipation of where rates are going to go. He does see M&A coming back, but he must be said that it's a little bit disappointing from what he had expected when we spoke to him last quarter. What I think is interesting when we speak to Deutsche Bank is they lend obviously to the manufacturing sector, which has been basically dead flat for quarters and quarters. Now seeing the sort of green shoots there, seeing that the foreign markets to which they export starting to come back, so a little bit of positivity there.
Oliver, give the people what they want. What did they have to say about buybacks and bonuses?
That's right. For the investors and the bankers, it's all about the buybacks and the bonuses. Unfortunately, on buybacks, we're going to have to wait. We have that 3 billion euros sitting on the sidelines. They have not yet determined how much of that is going to go back to shareholders in terms of buybacks. But what I thought was really interesting was this conversation about bonuses, because the UK has changed the law in terms of how much they can pay out to their bankers. They have lifted the cap from the EU-era regulations, which means that now at the AGMs, all these banks are going to vote on this. Have a listen to what von Moltke had to say about how that's going to affect the talent race in banking.
Look, we operate obviously globally competitive markets, and anywhere where regulation, by the way, for us it applies globally, the European regulation, and so it can put us at a competitive disadvantage. You know, we try to work within the rules and regulations that apply to us to be competitive on compensation, be an attractive employer across a whole range of considerations.
But it's certainly a concern when regulations in the U.S. and the U.K., where we are active in a number of our businesses, start to move in a way that places European competitors at disadvantage. So it's something that of course has our attention.
So that compensation question really is a big one for Deutsche Bank, where one of the cornerstones is to try to keep those costs down. And they went on this big hiring spree last year. And the concern is, are they going to be hamstrung by some of the EU regulations, not able to lift those bonuses in a sort of increasingly cutthroat environment for talent, which, as we know, is the lifeblood of banking?
Right, and they're all struggling with the same thing, perhaps overhiring and dealing with those costs. Oliver, thank you so much. Oliver Crook in Frankfurt, a fantastic conversation. Now to Barclays, they posted first quarter profit that topped analyst estimates. The bank's stock traders collected a surprise windfall from a volatile global market. Its CEO spoke with Bloomberg earlier.
Deal flow and the equity markets themselves have been starting to show some buoyancy. As I said, we are on our equity floor here, and then our own numbers in equities have shown an uptick for this quarter versus the same quarter last year. I think deal flow is increasing. In our own energy business or our sustainability business and the transition business, we've seen 9 deals in the last quarter and a bit. And so I do think that there is a deal flow happening. I think, though, it's very early. You've got to give it a quarter or two to cement.
Is Barclays prepared to capitalize on that when it does ultimately come to fruition, when it does actually see a little bit more momentum? Is Barclays positioned to capitalize on that, given a little bit of an exodus in terms of your bankers, as well as lower advisory fees relative to your American peers? How do you tackle that?
Yeah, well, it has been and it is a very, very important area of focus for us. We want to increase what we do in M&A. We want to increase what we do in equities. We have hired a lot of very talented bankers. We are focused on the energy transition. We are focused across the important sectors of technology and healthcare. And so we absolutely are positioned to capitalize on it. And you should see the results over the coming quarters. It's not something that's won in days, weeks, and months, but over a longer period of time. And we've put the sustained investment and skills behind it, and we will continue to do so.
Can I ask you about M&A within the UK market, Venkat? We've got a bit of M&A taking place. Barclays, you yourselves in the process of acquiring Tesco's retail bank offering. We also have consolidation with Nationwide buying Virgin Money. The building society space, we see consolidation there as well. Is this a sector where we'll see more, and are you going to play more of a role in that?
Well, I think at any time you have an inflection in the interest rate cycle, as we have had, with changing capital models and changing consumer regulation, it stresses business models, and it therefore drives some amount of M&A. I think our own acquisition of Tesco Bank is something that's win-win for Tesco and for us. We were looking to grow our unsecured lending, and I think you will see other institutions look at that. We have been very, very clear. Our plan for growth is predicated on as an organic one.
Venkat Krishnan, the Barclays CEO, speaking with Bloomberg earlier. Let's bring in Tom Metcalf, our Bloomberg finance editor, who joins us now. Tom, so was it really just the equity traders that come in to save the day for Barclays?
Well, that was definitely a big surprise windfall, up 25%, right? And it's a complete contrast to what we were hearing about Deutsche Bank, where, Barclays rates traders really, Venkat calling out a bit of weakness this quarter. So a bit of a subdued performance there. So for me, the fascinating thing is actually comparing, the Barclays share price today with Deutsche Bank, and it's effectively the inverse of how the rates traders did. So Barclays up very strongly, more than 4% when I last looked, now about 3.4%, whereas Deutsche Bank largely flat. And I think for me that shows all this focus on trading, etc. Ultimately, those shareholders are most interested in buybacks, as you said earlier, Danny.
Tom, obviously, you're talking about the stock price going in two different directions today, but are we comparing apples with apples when it comes to Deutsche Bank and Barclays? I mean, they have similar FIC businesses, but what is the big differentiator, let's say, between the two?
Yeah, I mean, they're pretty easy to compare just because they're among the few European banks with, I would say, substantive investment banking units. So, often people do just sort of shorthand them both as big fixed income houses. I think, in terms of comparing them today, a lot of focus is on, where are they going? And, that was a little bit disappointment for Deutsche Bank shareholders, I think, was there wasn't, as much clarity as Barclays was offering, say, on the NIM front and obviously on the buyback front as well. No real comms on that from Deutsche Bank, whereas Barclays on one of the calls, the executives were all saying, we are going to prioritise buybacks almost over everything else in terms of acquisitions or even dividends.
Well, certainly Barclays have had that activist shareholder in years gone by, and the investment bank has been, it's been like a thorn in Barclays' side in terms of what they do. Tom, thank you very much. Let's see if there's a little bit more activism to play for. China's luxury demand may be slowing for the sector, but it's not for Hermes. The French brand that makes the popular Birkin showed resilience amid slowing demand for competitors. LVMH and Caroline Conan is with us. There's nothing quite like a Hermes bag, is there? It is the ultimate symbol of resilience. Good morning, Caroline.
Good morning, Manus. I don't know if you prefer the Constance, the Kelly, the Birkin bag, perhaps.
I can't afford to buy her any of them. I can't afford to buy her any of them.
Well, a lot of people did in the first quarter because their sales at Hermes are up 17%, double-digit growth, even though the shares are actually down at the moment. Why? Because, of course, investors have already priced in a lot of this very positive Hermes story, and they are a little bit cautious about the second quarter and the rest of the year, because Hermes did mention this quarter that they've seen a softer traffic in some of their Chinese stores, especially for what perhaps you could afford, the cheaper products from Hermes, such as the silk scarves or the perfumes. Still, of course, there is a lot of polarization of the Chinese customers who tend to go these days either for the very high end, such as Hermes, or for the cheaper, more affordable products. That, of course, didn't play well for Kering. You saw the profit warning earlier this week. Hermes, on the other side, has a huge pricing power. They managed to pass on an 8% price increase just in the first quarter, even though they promised, Manus and Danny, good news for you, that there's not going to be any more price increases for the rest of the year.
Oh, good, Manus. You can save up for Christmas to get me one then. You've got plenty of time.
Aspirational luxury, Caroline.
I'll take a scarf even. Caroline Conan, thank you so much. Okay, coming up, we're going to set you up for the trading day on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief, Danny Berger and Manish Krani in New York. Let's get you set up for your trading day. Eco data will come out at 8:30 a.m. It includes GDP for the first quarter, wholesale inventories, and initial jobless claims. Then earnings on deck: Caterpillar, Airbus, plus more tech, Microsoft, Alphabet, Intel, and Snap. Then at 10 a.m. Eastern, the Supreme Court hears arguments on Donald Trump's bid for immunity from criminal charges related to attempts to overturn the 2020 election results. Manis.
Danny, a couple of punchy movers for you, surprisingly. Meta tops the bill, slumping. Disappointing revenue forecast, sparking concerns about the heavy spend on computing power isn't paying off. Zuckerberg is in retreat mode. IBM down 8%, the company's weak consulting unit sales, disappointing investors, overshadowing its acquisition of the software company HashiCorp. And Ford is up 3%. It's all about the trucks.
It's all about Meta, Manis. This morning, all about Meta. Those declines hitting the rest of the tech. Can Microsoft and Alphabet save the market today?
Well, the bar seemed to be low for Tesla and Elon Musk. The story there, the market believed it. A much more challenging time for Zuckerberg. Did he learn nothing in 2023? Hey?
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
That's really clear.
There's been a lot of good news priced into a lot of the big tech companies. That said, they really do need to deliver.
It's not all one trade anymore. It's sort of the magnificent 3 or 4.
From a valuation perspective, equities still look somewhat rich here.
We still think that there is room to run in equities, particularly U.S. equities.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your morning started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Let's pick it up with one name. Let's get Meta on the screen. Down and down hard, negative by almost 13%. It was down even harder overnight. Is the year of efficiency coming to a close over at Facebook? They're going to quote Lisa, invest aggressively. That's a very, very big change of tone over at Meta.
So they had the kind of great highfalutin words, the sort of hopes and dreams that Tesla was promising, and the reaction was exactly the opposite. They didn't want to see this in terms of investors. They wanted to see the dollars and cents, and the year of efficiency continued where there wasn't this great investment that was much bigger than people had previously expected.
Away from the CapEx numbers, the numbers were pretty solid first quarter. Revenue increasing 27% from a year ago. I think profit more than doubled, but that wasn't enough. The focus, Anne-Marie, was firmly elsewhere.
It's why when I woke up, I thought these numbers are pretty good. What would the stock be trading at this morning if they didn't talk about Reality Labs and if they came out and said, actually, we're going to have a little bit softer when it comes to CapEx spending? I love one of the things Mark Zuckerberg said on the call because it felt like he was watching the share price in real time. Smart investors, he said, see that the product is scaling, that there is a clear monetizable opportunity there even before the revenue materializes.
All I can say is this right now is a fickle bunch. Right now, investors are taking back what they gave. They really enjoyed the idea of efficiency. Now you're sort of right-sizing it. It talks about a bar that is a very different level depending on the company. It was a lot lower for the likes of Tesla and Boeing. They could basically hop across it with some nice promises of joy in the future. And here's a company that wants to invest in artificial intelligence. Remember when that actually used to mean something? And people are not having it, even as you pointed out, they had the increase of 27% in their revenues from a year ago.
Well, it certainly means something to NVIDIA, and they'll deliver results at the end of May. To Lisa's point, Tesla was down by more than 40% going into the earnings. If you look at Meta, Meta was up by more than 30% going into the earnings. There's a lot to talk about a little bit later. Microsoft and Alphabet after the close. Just in terms of the data, US first quarter GDP, 8:30 Eastern time. Jobless claims as well. Kind of the last big data points, Bremo, together with PCE tomorrow morning, going into the Fed next week.
What I'm watching in particular with GDP, I think it's going to be a really interesting print. First of all, how much did immigration really support this idea of an expansion in the employment base without necessarily some sort of inflation? And how much of it's being fueled by government spending? That's going to be an ongoing discussion as we head into the $44 billion of 7-year auctions later this year.
I was going to say, we've got to fund that government spending. So 2-year was decent, 5-year was soft.
Yeah, exactly. It wasn't terrible, but it was softer. And this sort of sets up this idea of, as you get further out on the curve, the longer maturities, do you end up having a harder time really selling this debt?
Let's check out a price of things right now. Equity futures just a little bit softer. We're negative by 0.5%. We can turn to the bond market. Going into that auction a little bit later, $44 billion of 7-year notes. We'll repeat it all morning for you.
Thanks.
Happening this afternoon on a 10-year at the moment, just about unchanged, 463.98. Coming up on the program, we'll catch up with Ben Laidler of eToro as Meta weighs on US equities. Mandeep Singh of Bloomberg on Microsoft and Alphabet. Those earnings coming after the closing bell. And Julia Coronado of Macro Policy Perspectives ahead of US GDP a little bit later this morning. We begin with our top story. Big tech weighing on equity futures with Meta results disappointing. Ben Laidler of eToro saying this: the Max 7 remain the most important drivers for another S&P 500 earnings upside surprise. Profits growth is slowly rebalancing away from big tech, but they continue to do the heavy lifting. I'm pleased to say that Ben Laidler joins us now for more. Ben, you say don't fear the recent sell-off. Should I fear this sell-off in Meta this morning?
I don't think so. I think earnings have been great. Actually, I mean, not just for big tech, but also for, across the S&P 500, 80% of companies are beaten. All sectors are running, well ahead of expectations. The problem's the guidance. That helped with Tesla and it's hurt with Meta. I think there's a message in there. It tells us that investors are nervous. It tells us maybe there's more macro uncertainty out there. I have to say, I sort of take that, with the territory, given the sort of setup we had, coming into earnings. But, big tech is important. Magnificent 7 is 30% of the S&P 500. It's going to grow earnings something like 40%, sorry, it's going to grow earnings something like 40% this quarter. Everyone else is going to struggle to keep flat. So it is important, but, this is one company. We've got, the big guns are coming out tonight. We'll see. I think there's still a lot to play for.
Well, let's talk about the big guns, the other two out of the Mag 7 that report later, Microsoft and Alphabet. Ben, given the setup, given what we've learned from how names like Meta have responded to the numbers, names like Tesla have responded to the numbers, what do you think it means for those two big names later on this afternoon?
So markets are telling us they care more about the guidance. They're concerned about costs. They're concerned about margins. So that's absolutely going to be the focus. I think both these companies have quite a lot of levers to pull, and expectations I think are clearly important. And you alluded to that earlier. So someone like Alphabet looks slightly better set up with expectations lower, with valuations a lot lower than the Microsoft does. But again, we've had two of the two reports so far. They maybe balance each other out. We've got the big ones, a couple of the big ones tonight, and then of course we go into next week where we have Amazon and Apple.
Ben, you said don't fear the sell-off. Do you embrace it? Do you love the sell-off? Do you buy aggressively into it?
I think definitions are important here. I mean, we've barely seen a 5% pullback. Put that in perspective, typically you see over 3 a year. Forget about a 10% correction. Your average intra-year drawdown for the S&P 500 is 14%. So, this is barely a sort of ripple. The only reason we're talking about it is because we've had this sort of remorseless, low volatility, rally since, October. So it could easily get worse. But to answer your question, absolutely. I think the pillars of this bull market are in place. Earnings are recovering. We're still going to get rate cuts, even in the US, especially in the rest of the world. There's a lot of cash sitting on the sidelines, which I think is going to buy these pullbacks, which maybe we've begun to see already. And again, your average bull market, 150% 5 years. I think we're barely getting started.
You said something in there that you were really ahead of. You talked about the Fed put before anybody else did, and we all laughed, and then you were absolutely correct, and everybody came around to that idea with the pivot party. And yesterday, as we were speaking with PIMCO, they were saying the pivot party is over, and that seems to be what the market is sort of suggesting. How is that still your base case if the market seems to be saying, you know what, rate cuts are not a done deal? This is an economy that doesn't need them to keep going.
Yeah, absolutely. I mean, we pushed back the magnitude and the timing for rate cuts. I still think they're coming. But to your point, I think we're just making money different ways. Growth has been stronger. Earnings expectations, have been stronger. That's also been tested here in earnings season, and it's really important, because of that. But I still don't think we can assume that the Fed is never going to cut interest rates or even is going to hike interest rates. Now, maybe the tail risks have changed, and that's a recipe for volatility, which we've begun to see across asset classes. That's a recipe for, inflation hedge assets like commodities beginning to perform better. But I think that's the market looking at the tail risks. I think we're a long way from that being the base case. As long as rates stay restrictive and as long as this productivity boom continues, I mean, US productivity running twice long-term average levels, that's the secret sauce here. If that can continue, we can absolutely thread this needle of strong growth and lower inflation.
Ben, when you're talking about the tail risk, you're talking about the geopolitical concerns that are happening right now in the world?
No, I think that's a head fake. I think the tail risk here is the Fed hikes interest rates. That is the sort of second pillar of this rally, which has been pushed back a bit, has been compensated by stronger earnings. But if you take that out completely, if the market is not pricing in higher interest rates here, it's pricing in maybe a 15-20% tail risk chance, but we're a long way from that being the base case. And I think if that did become the base case, that would be absolutely negative for markets.
Sure, it's not the base case, but what's your probability of potentially a hike?
I don't disagree with it. A low probability tail risk, call it 10%. The change, though, is it was 0. So I think that's what's been the fundamental driver of the pullback we've had. That's why commodities, are rallying. That's why volatility is up, especially in bonds. But now you have equities and FX following.
So, Ben, let's talk about the so-called cash on the sidelines. The cash sitting in money market funds that a lot of people in fixed income have been trying to get to migrate elsewhere, to credit, further out along the curve. Ben, if the new threat is not lower rates, it's higher rates, why would I move out of this front end anytime soon? I'm just trying to work out why that's a supporting factor now for the bull thesis.
I think it's an incremental support. Markets ultimately trade on fundamentals. The technicals, I think, are important, at the margin. I still think, whether you look at, the numbers, whether it's the amount of money in money market funds or just anecdotally, the feedback we're getting from investors, a lot of money missed this, rally off the October lows. And I think, they are very intently looking at any sort of pullback here, even if it's only the 5% we've seen so far.
Ben, can you characterize how bullish you are relative to where you were 6 months ago, since you were ahead of the game when you came out aggressively positive, even as other people talked about recessions that never materialized?
Probably a little bit less bullish since then. I mean, the fundamentals have changed. We're not looking for 6 or 7 rate cuts anymore. Valuations are now above average. Earnings expectations, are higher. I guess I would, I think the outlook for the US is absolutely less good, but I don't think it's bad. I still think you make money in the US. I think the real opportunity is everywhere else, where valuations are a lot lower, where you're going to get early rate cuts, where economies are already weak and much more interest rate sensitive and will respond to that. So I think the real opportunity here is in the rest of the world and actually sectors outside of big tech. That's where there's room for a multiple re-rating. That's where you have, low valuations, which give you an insurance to if things go wrong. And crucially, profit margins are very low and have a long way to rise. So I think you have, 2 ways to make money in a lot of these other assets, whereas I think tech's well supported, but valuations are high, earnings are high. How much more can you squeeze the lemon?
Ben, it sounds like you like Europe. Is that right?
Yeah, Europe, emerging markets, cyclicals. Yeah, absolutely. I mean, people have been bearish on Europe for as long as I can remember. I mean, literally decades. Yeah. That means that valuations are cheap. That means that expectations are low. Profit margins are depressed. You have a very cyclical, indices, and you have the catalyst coming of interest rate. The ECB is going to cut interest rates in June. They can get ahead of the Fed, maybe not dramatically ahead of the Fed, but that's where the catalyst is coming. And you have an economy which I think is very sensitive to that, much more than in the US. So again, that's your double combination of potentially higher valuations and higher earnings. That's how you make real money in stocks.
Do you worry that 90% of the arguments that you just presented could have been presented at any point over the last 10 years?
Could they? I mean, certainly some of them. Europe's always been cheap, deserves to be cheap. Sentiment's been low. But, if I look at European valuations or FTSE valuations today, they are 20% or 20 percentage points cheaper than that 10-year average. So, yes, I may have been able to make a version of that argument at any point in the last 10 years. But it's A, the magnitude, and B, the catalyst. The ECB is going to cut. Europe does have more debt. It does have lower profit margins. It is just much more sensitive, I think, to these catalysts than the US is.
Ben, enjoyed this. Great to catch up, buddy. As always, Ben Lader there of eToro on the international trade. Let's talk about things all international just for a moment. Dollar yen, 155.60. So yesterday we're sitting around the table. We break 155 and people are talking about intervention. It's coming. 155.60. BOJ's meeting. Let's see what we get.
Well, the obvious intervention is a rate hike. What if they actually intervene from a financial policy or a monetary policy perspective? We're going to be speaking with Kit Jukes later.
Looking forward
thinks
to it.
that basically it is inconceivable for them to do that, and I'm curious to know why.
Isn't this going to be the snapback? If you were the US administration, isn't this exactly what you would say back to the Japanese if they start complaining? Your interest rates are too low.
Well, they're going to say you have the tools that you can use yourself to get your currency to where you want it to be. But it was interesting, of course, because Janet Yellen did meet with the finance minister and the finance minister of South Korea and implied, we understand the complaint, but I think the administration behind the scenes is probably telling them, you can deal with it yourself.
We'll see what we get from the Japanese, 155.60 on dollar yen right now. Let's get you an update on stories elsewhere. Here is your Bloomberg brief this morning. We can catch up with Danny Berger. Hey, Danny.
Hey, John. President Biden's campaign has said it will continue to use its TikTok account. The irony, of course, is that the president has just signed into law that ByteDance needs to sell its stake or be banned in the U.S. Now, Biden's team, they justified it by saying, look, it's part of a strategy to reach a wide range of voters, which TikTok is one of the rare places that Biden can reach Gen Z and millennial voters, and the ban won't kick in for another 270 days if it does. Now, a transformational deal in the works, the likes of which we haven't seen in over a decade for the mining industry. BHP, the world's largest mining company, has made a takeover bid for Anglo American. This would create the world's biggest copper miner, though whether it could pass through government's approval or not is a different story. Now, forget Meta, this is the best story of the day. Jefferies CEO Rich Handler has sold 65 million shares in the firm itself to buy himself a yacht. Handler said in the statement, "My sale of shares today was a gift to myself and my family, and I do not intend to sell any further shares. I remain extremely bullish on Jefferies and fully committed to helping us continue to build the best independent global and full-service investment bank." It is the first stock sale the CEO has made in his 35 years at the investment bank. And if we're okay with Bezos selling his shares of Amazon just because he moved to Florida, what's a yacht between friends? That's your Bloomberg Brief.
Danny, I don't hate it. I feel like I do exactly the same thing. Love that story. I think so many other people did too. Just a comment on Anglo-American. Copper, the new diamonds. I think this is really, really interesting. You don't want Anglo for De Beers. The journal's reporting they might spin it off before they complete a sale. You want Anglo for the copper.
And it raises a question about the domicile of the company, too, and what London is going to serve in terms of headquarters for a lot of these major mining companies.
Lots of questions about that. Equity futures right now negative by 0.6%. Up next on the program, Meta's big spend.
The actual quarter looked pretty good, in my view, but the expectation, I think, from most was that they were going to keep those costs in check. And the fact that we're actually not seeing that, I think, is definitely spooking a lot of investors out there.
Meta down hard this morning, live from New York City. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Earnings season is here.
I think we're all asking the same question.
just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Just about squeezing out a third day of gains on the S&P 500 in yesterday's session. This morning we're negative by 0.6%. Under surveillance, Meta's big spend.
The actual quarter looked pretty good, in my view. I mean, you kind of look at the top line growing about north of 27%. That's a good number. They're probably by far going to outgrow everybody else on the digital ad side of things. But the expectation, I think, from most was that they were going to keep those costs in check. And the fact that we're actually not seeing that, I think, is definitely spooking a lot of investors out there.
It's the latest. Meta tumbling in the pre-market after revealing its plans to invest billions more than expected in artificial intelligence. The Facebook parent's revenue forecast also falling short of estimates. Investors now looking ahead to Microsoft and Google. They're due out after the close a little bit later. Mandeep Singh of Bloomberg and 20%. what would you have said to me?
I mean, the only caveat that, as I flagged yesterday, they won't get a pass if, the top line will start to decelerate and they are losing $4 billion on Reality Labs. And look, even yesterday, they called out AR glasses, but then they wrote down inventory in their Reality Lab segment for VR. So it just puts into question, there are no investment markers in Reality Labs, and there is no path to monetization. Like AI is being monetized across all their products. It's making the recommendation engine better, ad targeting better. You can see that. Why not give more clarity around what your plan is with Reality Labs? And I think that's missing.
As you know, Mandeep, the bull thesis over the last 12 months plus, going back to late 2022, was on discipline, efficiency. Yeah. Should we be worried about that now after the CapEx figures we saw yesterday?
I mean, the market was expecting a beat and raise quarter. Instead, I think what you're going to see now is the numbers will go sideways because, all the CapEx will get reflected in the gross margin over time. And look, Microsoft is going to come up with the results tonight. They'll raise their CapEx by 40%, and the market will probably cheer that because AI CapEx is good CapEx. I think that's what Meta needs to do, is to kind of separate what the Reality Labs component is versus what the AI component is.
This is important and exactly where I wanted to go, because the way that it was basically cast was this is artificial intelligence spending. So I didn't understand why you didn't see a bigger pop, since nice words work, it seems like, when you take a look at what we saw with Tesla. Do we have any sense about how much is getting funneled into virtual reality headsets in the metaverse versus artificial intelligence?
I mean, we know the segment losses for Reality Labs are still going to be $15 billion this year. And baked into that is some of the write-offs for the VR devices that weren't sold. So basically, they have to write down inventory. And look, in terms of CapEx, you could argue some of that CapEx has an overlap. If you're spending in GPUs, it can be used for developing the infrastructure for Reality Labs, as well as for AI. But I just question, how do you monetize AR, VR? Are you going to show an ad to people or who are using those devices? Like, what's the path to monetization? Hardware is a very low gross margin business. As I mentioned yesterday, they're subsidizing the hardware. So you have negative gross margins. You don't have a path to monetization in terms of ads. So why are they investing so much in Reality Labs?
At the same time, they're minting money. And if you're basically buying a stock because you're buying growth, the potential opportunity with respect to TikTok and getting some of the potential users there, the idea that they grew their revenue more than 27% year over year is really substantial. Why isn't that more meaningful to investors that, yes, have already baked in a high valuation, but also could get some sort of boom from the AI investments that they're making currently?
I mean, look, they've got a lot of drivers that look really solid in terms of revenue growth. AI agent is a big opportunity. I think they can create a market of their own in search within the social media platform. So a lot of things that could go for them, which is why investors want them to be focused on the AI opportunity as opposed to focus on AR, VR, because they have so many things they could do. Really, it's unlimited in terms of the surface that they can monetize with ads. So why focus on something that will be hard to monetize?
Mandeep, let's talk about Chinese ads, Chinese advertisers that want to get in front of American consumers. They were a little bit uncertain about the future. Why?
Yeah, well, it's reflected in that wide guidance range they gave for 2Q. So I think a question did come up on the call where they just said, we're watching and, that advertising, that spending could come back. But look, ads are an auction-driven mechanism. So even if Chinese advertisers are not there, there are some other advertisers who can fill in. Ad pricing will take a hit. But in the end, this is the company that has the attention, 3 billion users globally. So where else are you going to go if you want to acquire new customers as a small business?
And potentially that user base can grow if we do see this TikTok ban or divestment. Yeah. They were asked about it yesterday, and the CFO said, quote, "It's too early to assess the impact." Well, the countdown's already begun. At what point will Facebook come out and potentially say how they feel about this?
I think you're probably going to hear it next quarter, because a lot of those creators on TikTok will have to find another home. They will either move to YouTube or they'll move to Meta's Instagram or one of their properties. So you will start to see that migration, and I expect that user tailwind to be there for the next few quarters.
Short videos become absolutely massive. Some of the numbers coming out of the firm yesterday, Reels makes up 50%, about 50% of the time that people spend on Instagram. Isn't that some kind of guide towards what kind of world we're moving towards?
Yeah, look, I think the recommendation engine is powered by AI, so all that CapEx is being utilized in a very effective way, and they are getting that ad targeting. I mean, not only is the recommendation getting better, they're making it easy for advertisers to create their ad campaigns using AI. That tells you something, you know, we will have a lot of productivity from AI. I mean, Meta is the biggest use case out there in terms of what AI can do, and they are actually deploying it very effectively.
Mandeep, this was great. No doubt we'll catch up with you later. Mandeep Singh there of Bloomberg Intelligence, with Meta down about 13% this morning. Coming up very shortly, we'll catch up with Michael Hershon of 22V Research as possible sanctions loom over Secretary of State Antony Blinken's latest trip to China. Equity futures on the S&P down about 0.6% on the S&P 500. In the bond market, the 10-year about 464. Lisa, things pretty stable going into that auction a little bit later.
And it has been. I mean, even yesterday, yeah, it was a weak auction, but it wasn't that weak. It seems like there are the buyers who want to come in and buy. It's just a matter of price.
The 7-year auction this afternoon. Before that, maybe setting the tone, the data this morning, initial jobless claims and US GDP a few hours away. Live from New York, this is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Three days of gains on the S&P just about yesterday. Incidentally, the longest winning streak of the month so far on the S&P 500. It's been that bad through April. Equity futures this morning taking some of it back. We're down by 0.6%. We're off by 0.9 on the Nasdaq. Meta weighing on that big time, makes up about 5% of the Nasdaq 100. Let's switch at the board and turn to the bond market. Lots to talk about, particularly through the belly of the curve. At the 2-year, the front end of the curve, a little bit earlier this week. Some supply was taken down pretty well. Data was soft, encouraging that bid. 492 on a 2-year. Further out along the curve, things a bit softer on a 5-year auction yesterday. We get a 7-year this afternoon. Looking at the 10-year, just about unchanged. 463.98. I'll go back to the data, Lisa. Maybe setting the tone for that is the data that comes out in about 2 hours' time.
Initial jobless claims as well as the first reading of first quarter GDP. Which do you think is going to be more interesting? I'm actually not sure, given the fact that we do get a sense of how much government funding is fueling some of the gains that we saw in GDP, and just generally how much growth can potentially expand in the U.S.
Show me claims, any deviation away from what we've seen repeatedly over the last several months, which is something like 212. I think it's like 212 on repeat for weeks and weeks and weeks with very little movement on either side of that. I think that just encourages people to believe you're going to get another solid jobs print a few weeks away, a week away.
Which is the reason why it just hasn't been a data point that people have been looking at, because it's basically been flatlining in terms of any kind of change. Honestly, this is an interesting moment because we don't know which data is going to matter. Evidently, S&P Global PMI data was probably the most important data point so far of the week.
There's a central bank somewhere praying for soft data in America. I think you know where I'm going with this.
Oh, yeah.
Turn the board over to dollar yen. The Japanese need some soft data. They need it quick. And they need it not in Japan, they want it in America. 155.61 on dollar yen, positive by 0.2%. It has just been relentless, Lisa, through the year, and much more so through this month.
You know, I was seeing a number of headlines saying that we're heading toward intervention level. We were heading toward intervention level about a month ago. This raises a question, what is the threshold, and are they going to move without what you just said, which is weaker data in the U.S. that will make it easier for them to throw money at this? At this point, again, I want to hear from Kit Jukes. Why is it inconceivable that the Bank of Japan will hike rates if they are so concerned about the depreciation of the yen?
I wonder how much this is weighing on Japanese executives. Bloomberg caught up with the Japanese airline CEO, and they said actually 130 is what we would like, because they go out and they use the yen and they buy things like Boeings and they buy Airbuses, and they said, quote, this is a problem, a quote, big problem right now. And you have to imagine they're calling up the finance ministry and airing some of those complaints the way the finance ministry came to Washington, D.C. to air their complaints.
And they've got to pay for some fuel as well. 155.62 on dollar yen. Under surveillance this morning, shares of Meta plunging on a weak revenue forecast and plans to spend billions on artificial intelligence. The news pulling down tech more broadly, with Microsoft and Alphabet set to report after the closing bell. We gapped lower yesterday by almost 20%. We've come back since then in the pre-market. Looking at Meta, we're down about 13. I wonder if this move sticks through the day. I wonder if it does.
I agree with you, just simply because a lot of this is a knee-jerk. The bar is high. Let's sell. Let's capitalize on gains, because evidently, as you said, the year of efficiency seems to be over. Now, as you dig under the hood, I think Mandeep nailed it. How much is really virtual reality sets and throwing money, good money after bad, and how much is really investment in artificial intelligence?
Exactly, because Mandeep's talking about what we're going to hear from potentially Microsoft and Apple when it comes to this AI spending. He says investors actually like that. What they don't like is this reality labs, the fact that they're subsidizing these Ray-Ban sunglasses, and then how do you monetize that down the future? He says AI does show a path to monetize because it helps improve the core business of these companies. So I think if they came out and potentially talked about, we're going to have a lot of CapEx spending, very little is going to reality labs, but a lot's going to go to AI, potentially we wouldn't have seen this drop.
We're getting some more earnings this morning from Southwest. Southwest, Lisa, look at this headline. Limiting hiring, offering voluntary time off programs as well. These airlines are all in very different places at the moment in this country.
Especially if it's a domestic, lower-cost airline, which is what Southwest is facing. What you're looking at is adjusted loss per share that's wider than people had expected of 36 cents versus the estimate of 31-cent loss. The revenue for passengers was actually lower than expected. Again, this sort of two-speed airline industry of people who can travel overseas in first class and are able to pay a lot more, and then people are going on vacation with their families who are really feeling pinched.
A bit softer in the pre-market. That name is down by 6% in early trading. We mentioned the data. Let's talk about it. The initial read on first quarter GDP in America expected to confirm a booming economy. The median estimate in Bloomberg survey seeing a rise of 2.5%. Personal consumption And initial jobless claims are also due out in about 2 hours' time. The PCE deflator and UMich consumer sentiment survey, that will come out tomorrow going into the weekend. I want to turn to this. Secretary of State Antony Blinken raising concerns over trade and support for Russia on his latest trip to China. Blinken is meeting with Communist Party officials in Shanghai before heading to Beijing. Blinken is expected to echo Treasury Secretary Janet Yellen's threat of new sanctions on banks supporting Russia's war machine. Michael Hershon of 20TV Research joins us around the table. Michael, good morning to you.
Good morning.
Let's get into this. I heard it from Yellen. We're going to hear it from Blinken. When do we start to see the policy?
Well, I think a sanctions push is something that the U.S. is not going to take lightly, especially on a major Chinese bank. And I think, frankly, the Chinese banks are taking this pretty seriously as well. So I would guess that this move is not imminent, but you have to take the threat seriously.
Is the warning enough for the Chinese banks to change course?
I think for the large banks, Beijing will let them manage their own sanctions risk. I think it's more likely that we would see something that would be one of the smaller banks. Now, that could be still a large bank in absolute terms, but what we've seen with Iran, with North Korea, is it's typically the sanctions risk is really embedded in the smaller Chinese financial institutions.
There's a plethora of issues Tony Blinken is going to want to bring up today, whether it's China bringing in more Iranian crude, whether it's China supporting Russia, if not outright, but through these things like helping them with the materials they need, TikTok, South China Sea. What is the main request they need to ask? Overcapacity. What do you go in there and say, you need to sort this immediately?
I think it is a long list, as you said. I don't think that Blinken is going to carry the water, so to speak, on trade. I think that's really discussion left to trade officials. I mean, clearly he's going to make that point. But I think higher on Blinken's agenda will be China's support for Russia, Iran and the nexus to the Israel-Gaza conflict, and then South China Sea. You have, a flashpoint that people sometimes sleep on, but is really serious with the tensions between China and the Philippines. That could bring the U.S. in, potentially quite easily, in the sense that the U.S. is a treaty ally with the Philippines. So if we see an accidental collision, some kind of miscalculation between China and the Philippines, that issue moves right to the front burner.
How much do you think that the conversation is going to sound something like this? Tony Blinken to the ambassador or even Xi Jinping, we're so much better than the other guy will be, so work with us.
I don't think that will be an explicit part of the conversation, but the election certainly is on something that is on the minds of the Chinese. I think they don't want to see China become any more of the center of the U.S. election than they already are with an issue like TikTok. So it's an incentive for Beijing not to let these issues flare up too much. At the same time, it somewhat limits President Biden's negotiating leverage because the Chinese don't know who is going to be president a year from now. So the election is going to be something that's certainly on everyone's mind, but not explicitly raised in this conversation.
You said that trade is not going to be really the main issue. They're going to be talking about support to Russia and trade with Russia and some of the other sort of global interference with geopolitics on the part of China. How do you divorce the idea of trade from some of those issues at a time where economics increasingly is really determining the geopolitics?
They can't be divorced, and especially if you think about the excess capacity issue, it's one that's really tied to the strategic competition over clean energy. If you look at the export controls, which are a trade issue, right, limiting export of semiconductors to China, a direct link back to national security. So it is definitely going to be part of the conversation. The Chinese, I think, are going to push back quite forcefully on U.S. tech restrictions. They see this, they've been characterizing this as an obstacle to China's development. So it's getting closer to being sort of a core red line issue for China. So it absolutely is going to be part of the conversation. They can't be divorced.
Japan is going to be watching very carefully. Can we just build on this conversation that Lisa started? How do you think countries like the United States will maintain national security cooperation with countries like Japan at a time where maybe economics cooperation is tested? And I will use the word tested. I can think of Nippon Steel, looking at what's happening in the FX market. How do you maintain cooperation in one when cooperation in the other is a little bit fragile right now?
I think for U.S.-Japan, this relationship is really very solid. I think there's a mutual interest there and enough time, spent on the relationship to be able to see through issues like Nippon Steel. The exchange rate, is an issue. I think it's the same issue on the Chinese side, right? Dollar yuan has got the same issues as dollar yen. And there you have the prospect of these geopolitics seeping in there as well. So it's a complicated balancing act also on the Chinese side as we think about these exchange rate developments.
What did you make of what happened last week in Washington, D.C.? What was your impression of the meeting that Japan and South Korea had with the Treasury Secretary?
Clearly, it's showing interest on both sides in managing these exchange rate movements. It's a complicated task. I think, as you were saying, one of the questions is when do they intervene? How do they intervene? We've just seen verbal intervention so far. I think, frankly, they're fighting against some pretty strong fundamentals in terms of the strength of the U.S. economy and the prospect that the Fed is going to be higher for longer. So there's limits, to how much FX intervention can do when the mismatch between the fundamentals are that strong.
When you're talking about allies like Japan, I also think of the European Union. How much is Secretary Blinken today going to rely on those allies and the fact that the Biden administration, as opposed to really the Trump administration, has taken a multilateral approach saying it's not just us, it's a group of us that you're going to have to contend with?
It's a big part of the conversation, and I think the Biden administration really wants and needs the Europeans to step up more on this issue of China's support for Russia and a number of these other flashpoints. On excess capacity, this is even more of an issue for European countries like Germany than it is necessarily for the U.S. economy. On Russia, Ukraine, it's even more of an existential threat to European security than it is to the U.S. So the U.S. is counting on the Europeans to do more. Whether they will do more remains to be seen. President Xi will be visiting France next month. That's going to be a really interesting test to see how forcefully the Europeans are going to push back.
How nervous do you think Tim Cook is in terms of its business, Apple's business right now in China? How at risk are some of the U.S. and frankly even European companies that rely on China for their business?
If I'm Tim Cook, I'd probably be more nervous about the macro situation in China, the fact that the consumer remains weak and that there's rising competition, than I would necessarily from the political risk. He's definitely got to manage that. But if we're thinking about an Apple or a Tesla, those are such bellwether companies in China's market that I think Beijing has to be careful about overt retaliation. This is, at a time when China's trying to revive confidence in the economy, a strike against an Apple or a Tesla would really chill the business environment. I think the U.S. firms that are more at risk of retaliation are, less of the brand name marquee names, more closely tied to technology competition. Those are the areas that I think, those companies are more at risk. But frankly, Beijing does not have great options for retaliation at a time they're trying to revive the economy.
Michael, enjoyed this. Thanks for being with us, sir. Thank you very much. Michael Herson there of 22V Research. Let's get you an update on stories elsewhere. Let's get to your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. We have another winner from the U.S. CHIPS Act that was announced this morning. This time, it's Micron. It's going to get up to $13.6 billion in grants and loans, which confirms our own reporting from last week. The money will be used to build out new American factories, but the expansion does come with risk for Micron, given the volatile pricing of memory chips that can cause rapid swings between shortages and gluts. Columbia University's governing body is still backing President Nemat Shafik as calls for her resignation grow. Trustees say that they support Shafik in her approach to managing the campus amid the ongoing protests over the Israel-Hamas war. Columbia has shifted to hybrid classes this week after over 100 pro-Palestinian protesters were arrested for violating police orders. U.S. births have declined to their lowest level in more than 40 years. That new data comes from the National Center for Health Statistics. Now, this trend of declining births, it has been happening for 2 decades, and the drivers behind it, they'll come as a surprise to very few. Things like lack of paid family leave, skyrocketing health costs, higher student debt, not to mention a pandemic. But the data do underscore the importance of immigration to sustain U.S. population levels. That's your Bloomberg Brief, John.
Danny, thanks for that. A level not seen since 1979. A lot of wealthier nations facing the same issues. Up next on the program, a booming U.S. economy.
The core measure of GDP, final domestic demand growth, which economists call it, that's going to be incredibly strong. We're running at a hot economy here, and it's not really consistent with inflationary pressures further moderating.
That conversation just around the corner. U.S. GDP due at 8:30 Eastern Time.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole, ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Stocks a little bit softer here. We're down by 0.6%. Yields just about unchanged on a 10-year, 464.19. In the FX market, the euro reclaiming 107.24. The data maybe is going to dictate where this market goes a little bit later this morning. Jobless claims and Q1 GDP. Under surveillance this morning, a booming U.S. economy.
The core measure of GDP, final domestic demand growth, which economists call it, that's going to be incredibly strong. That will be the 3rd quarter in a row that we've gotten core GDP growth of above 3, and that's something that we haven't seen since 2014, absent the pandemic-related rebound. We're running at a hot economy here, and it's not really consistent with inflationary pressures further moderating.
Here's the latest this morning. 1st quarter GDP due in just over 90 minutes' time. Bloomberg survey calling for an increase of 2.5%. Julia Coronado of Macro Policy Perspectives writing this. It appears that Q1 will also feature another solid gain in productivity. That is particularly encouraging. It means this robust growth is less inflationary, despite the recent disappointments. Nonetheless, a resilient economy adds to the Fed's sense that they can take their time. Julia, I'm pleased to say, is with us now for more going into this GDP print. Julia, let's start with GDP, and then we can talk about the labour market more broadly as well, with jobless claims on deck. What are you and the team looking for? What are you focused on when we get that Q1 release?
So we, of course, are focused on the U.S. consumer. As Tiffany had just mentioned, running very strong, probably around 3%. The overall pace is expected to step down. We're in line with consensus at 2.5%, reflecting that trade is going to take a bigger bite. So that highlights that the U.S. is the outperformer, and therefore imports are outstripping exports, and trade will take a bigger bite than it did in the 2nd half of last year. So, again, I think overall the picture is going to be robust. We do already know, though, that hours worked for the quarter were pretty moderate, about 1% aggregate hours worked growth. And again, that implies with a strong top line that productivity is going to remain very strong, not as strong as last 2nd half of last year, but still at or above what we think of as the long run trend. And that's the secret sauce of a soft landing. And so that's really, really key, that productivity continues to be the driver of these strong prints and not a labor market that's starting to tighten again.
Julia, this is important. Let's extend this conversation just on this topic a little bit more. When you identify then the sources of US growth, what's underpinning this boom, does it tell you that this could be more durable than some people think?
Yeah, I do think so. I mean, I've been pretty encouraged by a lot of things that are very different this cycle than last cycle. we see more business formation, business dynamism. That's something that had been lacking the entire expansion following the GFC. So to see that kind of strong business investment, dynamic business formation, and that hot labor market is yielding dividends in the form of better productivity, better matches between employers and employees, and just strong productivity gains. And I do think it's got some legs here. That's one key driver. Another key driver is immigration. We know that there's just more people. When we look at the labor supply backdrop over the last 2 years, it's been incredibly strong and allowed the labor market to cool off despite very strong GDP numbers. There's no sign that that's going to slow down this year. It would take some policy that would bring it down over time. But right now, the flows that we're tracking, and we track monthly flows of workforce visa granting from the State Department. So this is legal workers coming here to work, and it's across the earning spectrum, across the professional spectrum, from low-wage workers to high-wage workers. And that flow has just been very strong. We're still playing catch-up from the pandemic, and people want to come to the U.S. and work. And so that's been a great driver of resilience and strength, and allowed inflation to come down despite this outperformance.
Julia, you alluded to it. Let's just go back to that. Whether this could end just like that with a policy shift. Are you saying it's a lot harder than maybe the conversations like these let on?
Yeah, look, it takes some time to implement policies and for them to take effect. These are not switches that you can just flip. I mean, one of the reasons we've been talking to the government officials about why the workforce visa granting has been so strong in the last 2 years. And, you know, part of it is just these agencies have been restaffed. Some of the processes have been streamlined. There's always been demand, and we've had been seeing increasing delays in processing of applications for workforce visas and green cards, and that process is now working more smoothly. So you know, these things take time to build up that infrastructure. We've got that infrastructure humming along right now. And again, that's yielding a very flexible backdrop for labor supply.
Julia, one other thing that's been keeping things afloat has been government spending. How much do you think that that's going to feature into the strong GDP print that we're expecting in about 90 minutes?
That's an excellent question. It has been a big source of strength. We've seen full evidence of the infrastructure bill and the CHIPS Act and the IRA boosting spending directly from the federal government, but also through state and local governments. Now, that's one element that looks to be tracking a bit cooler than the second half of last year. A still robust gain. We've got about 2.5%, both at the state and local and federal level, but it is something we're going to be watching closely because that pace is down from a 5% pace in the second half of last year at the state and local level. So government spending has been an important ingredient through all these bills that were meant to increase investment across a range of areas, including infrastructure. And it has been an important source of both growth, Lisa, and hiring. State and local government hiring has been one of the bedrocks of job gains over the last year, and really running much stronger. If you look at it in a variety of ways, the state and local government, you know, they were so cash strapped after the housing crash that historically they're at very low levels of employment. They've got room to run. Not only are these federal bills boosting state and local spending, but state and local spending, state and local governments are flush with cash. Property tax revenues, sales tax revenues have been pretty strong. And so they are kind of rebuilding a bit. And that has been a source of resiliency. This is a non-cyclical, less interest rate sensitive sector that is providing, you know, a foundation of resilience despite other sectors struggling.
Just quickly, Julia, how durable do you think this government spending is at a time where there's an increasing concern about the deficit?
Yeah, it's not going to last forever. Even, you know, the bills that were legislated, we knew that they were going to have a long tail of several years. You don't deploy infrastructure spending overnight. So we knew that the government, in our forecast, we've had the government adding about 0.5% of GDP for a period of sort of 3 to 4 years, reflecting the bills that were passed. So it's not going to go on forever. And of course, if state and local governments are to some degree playing catch up, and, you know, again, the delta on these revenues isn't going to keep being positive, we will see that slow down. So I don't expect the performance of the second half of the year of last year to persist. I think what we're likely to see in this first quarter is probably going to be close to the run rate this year, and then we'll take another step down in 2025.
Julia, thanks for the breakdown. Appreciated this. Julia Coronado there of Macro Policy Perspectives going into first quarter GDP later this morning at 8:30 Eastern Time. These are the estimates in our survey at the moment. First quarter read, 2.5%. Previous number, previous quarter, 3.4%. Jobless claims important as well. In our survey, looking for a number of 215. The previous number was 212. That's going into payrolls. About a week away, Lisa.
And basically, we've seen this robust growth, which has raised questions about what the job growth could look like given this immigration. I was looking at some data, and it's just shocking in terms of the projection of how many immigrants coming in. I believe that the Congressional Budget Office increased their projection something like 128% in terms of immigrants from 2025 to 2027 coming in.
It was projected to be 1 million pre-pandemic for these years. It's 3.3. And what the CBO has now done with this recent uptick in immigration coming into the United States, they actually said that this could add to U.S. gross domestic product $7 trillion over the next decade.
Amazing. Payrolls next week, 246. If you want a sneak peek, 246 is the estimate so far. Previous number 303. It's pretty punchy, isn't it? Still near 250. In the next hour of Bloomberg Surveillance, Chris Harvey of Wells Fargo, Tobin Marcus of Wolfe Research, Kit Juice of SocGen, and we'll catch up with Greg Peters of PGIM. Why this bond market is still in the buy zone? Is that what he says? The buy zone?
Something like that. Yeah. What is that zone?
I don't know.
Big target.
I don't know. That's next.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
think the Fed does need to wait. The bar probably has become pretty high.
Our forecast is that the Fed is actually going to cut this year, and they may cut as many as 3 times.
We are expecting rate cuts coming into the second part of the year.
I don't think we want a screaming hot economy. We want rates to be stable and we want certainty.
It does seem like in some sense the pivot party from December is over.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Check out Meta. We'll be on top of that stock throughout this morning. The name is down by 14% or so at the moment. It had gapped lower by close to 20. The numbers weren't bad. If you wake up this morning and you're like, okay, that must have been terrible yesterday afternoon. Revenue is up 27% from a year ago. Profit has basically doubled. It's a pretty solid first quarter, but when you start to look about the outlook, talk about the outlook, Bramo, CapEx, that's where people start to get upset.
So they believe the capital expenditures will be $35 to $40 billion versus a previous expectation of $30 billion to $37 billion. Doesn't sound so bad. It depends what they invest in. If they're investing in Ray-Bans that can give you access to artificial intelligence, or not even that, virtual reality, not so much. And I think that's what Mandeep Singh laid out for us.
You've been talking about it through the last 24 hours. You can't talk about where this name is now without discussing where the move has been over the last year or so. It was up aggressively going into the print. Compare that to the likes of Tesla, which was down aggressively going into the print, almost like the mirror image of the Tesla story.
It just highlights, I don't want to use this word, I'm going to have to, idiosyncratic each company is, just because you've had different expectations baked in. Happy talk was great for Tesla. Happy talk was even better for Boeing, or not even happy talk, just realistic talk. For Meta, not so much. Their hopefulness is met with a lot of consternation for people that want the year of efficiency, that want this feeling of stripping back and focusing on ad revenue and, honestly, capitalizing on market share, depending on what happens with TikTok.
And to Mandeep's point, and I think one of our reporters last night in the earnings call was saying how they were trying to, quote, AI-ify everything. He says they like that. Investors like the idea of AI because it means you can monetize it and it can come back to the core businesses of, say, better advertisements. What they don't like is the reality labs, the metaverse. How do you make money off of, say, the Ray-Ban sunglasses? Okay, you buy the hardware. What's the service attached? Nothing. And then you dumped all this money into it.
The year of efficiency has come to a close. We're going to be talking about Alphabet and the likes of Microsoft a little bit later after the closing bell. Before we get there, we need to talk about some numbers. US GDP coming this morning, jobless claims as well, going into PCE tomorrow morning. The last big data slate going into the Fed next week.
I don't even know what to do with it. Honestly, it seems like a lot of people have expectations for PCE and what we get for personal consumption and spending. How big is the surprise one way or another to move the needle right now in a market that seems to be kind of range-bound? I mean, again, I keep going back to the idea of the S&P and global composite PMI data, that moved the needle because you saw hiring come down.
Just a bit of weakness.
Just a bit of weakness. Is that where the bias is right now, that people are going to respond more to weakness, justifying some kind of Fed move? That's what I'm curious to see more than anything.
You've said it repeatedly, convictionless market coming into April. Meta's down 14%, broader equities, net session lows, we're down about 0.75% on the S&P 500. In the bond market, going into the auction a little bit later on a 7-year maturity, 464.39 is where the 10-year is, just about unchanged on the day. Coming up this out, Chris Harvey of Wells Fargo with Wall Street's most bullish S&P target. SocGen's Kit Jukes saying the yen could hit 170 this summer. And PGIM's Greg Peters on the risk of another rate hike. We begin with our top story. Meta's outlook dragging futures lower with more big tech earnings on deck. Chris Harvey of Wells Fargo with the most bullish year-end S&P 500 target on the street. Writing this, we expect near-term choppiness related to outlooks and rising rates. Our S&P 500 target is 55.35, but we're more focused on the return profile. Stay in the game, but you need some portfolio hedges. Chris is with us now for more. Chris, good morning to you.
Good morning.
55.35 up from 46.25. That's a big change. Can we start there? What changed?
That is a big change. So we knew we were going to move numbers higher. We just didn't know how much higher, because I didn't know. You know, we looked at things last year and we were expecting the market to be up 10%, maybe 15. And we couldn't figure out, that was pretty good at the time, but we missed the market by 10%. What we figured out is the market's just being a lot more aggressive on how it's discounting. It's discounting a lot further into the future, and it's using a much more aggressive forward multiple. And so when we took that into consideration, we realized, hey, we can get to 270 on 2025. We can use a 2021 multiple, and that gets us over 5,500. And so that's really how we got there. And what we think is going to happen is not the economy is going to be really strong. It's a mix shift. The winners are going to keep winning, and the more profitable companies are going to make up a bigger percentage of the S&P 500, and that's how you're going to get there.
So within this is a big core bet on mega cap tech.
Mega cap tech, but really more profitable companies. A lot of the mega cap tech are those, but it's not every single mega cap tech is a profitable company. But yes, along those lines.
Is there anything in the earnings that you've seen or the spending by said companies that makes you concerned?
No, what makes me concerned is we really haven't learned anything new at this point in time. Consumer, still value-oriented, still selective. High-end's doing better than low-end. Kind of knew that. People like to travel, services over goods and things. We knew that as well. Economy's a little bit stronger than expected. Not new news. What we're waiting for and what we're looking for and what we think is this AI spend, it's not a discretionary spend. And we'll see that going forward. Maybe that's part of what we saw last night. And what we think is, again, you're going to have a separation. You've already had that separation between the winners and losers. That separation is just going to get bigger and bigger and bigger.
The separation has been in earnings returns, but it's also been in earnings, just straight out. We saw Southwest, for example, coming out earlier this morning, underperforming, wider loss. You say people like to travel. There are signs that that's actually being challenged on the margins. We just got results from American Air, similar type of disappointment. How much does this make you shift some of the companies that you like? Is this basically a bet that the cash winners and the AI darlings can keep going, but the broadening out isn't going to happen?
Yeah, so Lisa, there's a lot there, right? If we look at Delta, Delta's a lot different than Southwest. And Delta had a lot more positive things. It's a higher end consumer. It's also more business oriented, right? What do we like? What's going to change? Well, the bigger question is we see two trades in the marketplace. It's the momentum trade and it's the reinflation trade. And I think that momentum trade will continue because, again, the winners will keep winning. As far as our positioning, what we want to do and what we've been doing for the last year and a half is we want to barbell communications with something more defensive. Now what we want to do is barbell communications with healthcare or utilities. We want some balance. We want some protection in that portfolio, but we do want to participate to the upside.
If the Fed doesn't cut this year or only cuts once, how do you change your target again?
Don't change it at all.
Really?
Right? Yeah, because the reason is if you go back to 21 when the Fed was way too aggressive and then you roll into 22, you ran into a buzzsaw. Why was that? Well, you were too accommodative in 21 and then you turned everything on its head in 22. Well, you're not going to see that going forward. You're going to see a Fed that's going to cut. It's going to be a multi-year cut, multi-year easing cycle. And that continuity is going to help. What else is backing that up? This secular AI trade is not going anywhere. It's actually broadening out to power, to electrification. And then the M&A story keeps getting better and better and better. So whether it's one cut, two cuts, three cuts, we don't care because it's the start of a bigger cycle.
I know it's no one's really base case, but what if there was a hike? How would that change your outlook?
Yeah, that won't be good. and what we tell people is if today's
that's the risk of increased U.S. exceptionalism.
Well, I don't know about that, but what I do tell people is if today was your first day on the job, you would not be coming to the conclusion the Fed needs to cut, right? The economy's stronger than expected. We're in a bull market with equities. Credit spreads are less than 90 basis points. The consumer's fine. And while the Fed says things are tight, yeah, I see parts where it's tight, but when it's really tight, people don't have to tell you. You feel it, you know it. I'm surprised that the Fed is telegraphing easing as much as it has and why they pivoted in December so hard. That's, to me, is very surprising.
My favorite line of yours over the last few years, brace yourself. I think you might know, you might have guessed. Coming out of the pandemic, I remember in 2020, you said it's going to be spring break for adults.
Yeah.
Did you expect it to last this long?
I did not.
Is it over yet?
It's toward we're late in the cycle. We're toward the tail end.
The longest spring break ever.
It is a long spring break. That's been bad, though.
Well, we're trying to work out what to do with discretionary based on that. And that was ultimately the call coming out of the pandemic. It was spring break for adults, discretionary, go, go, go.
Right.
What is it now?
I think it's more producers over consumers, right? The consumer, again, they've spent what they needed to spend. They've done their revenge spending, right? They're being a lot more selective. They're saying, I'm not going to spend a lot for that. If I can jump on a plane and go and travel, I will do that. But goods and day-to-day things, I've got enough stuff, right? And so now that AI trade, right, that's the secular trade. The discretionary spending is not AI. It's a non-discretionary spend. and it's beginning to build out, right? You have the secondary and tertiary trades, the data centers, the power issue surrounding that, the electrification. And so I think if you're looking for a narrative, consumers, probably producers over consumer, but really it's that AI trade, it's that momentum trade. It's still a growthy market in our opinion.
You mentioned M&A, and I have to go there because it's something we've been talking about a lot.
Yeah.
How much M&A can happen given some of the recent FTC action?
Well, that's a great question. And one of the things we keep saying, one of the things that we think will happen, right? People ask us, how do you handicap elections? What do you do? And the thing that we look at is who's going to control the Senate, right? Who controls the Senate is very important. If the GOP takes control of the Senate, that's much better for equity markets. And I think this time around it's going to be much better for M&A because the regulatory environment is very difficult for M&A and M&A activity. And so if you see that change in the Senate, I think that helps accelerate longer term M&A in the M&A cycle.
So aside from a rate hike by the Federal Reserve, what could crack your confidence in this type of return as we parse through which data matters most?
How long do you have?
We've got time.
We got time. So right now it's rates. I'm really worried about rates because equity and rates, there is this momentum component where I buy strength, I sell weakness. So you can see rates gap up pretty quickly, right? We're above, I think we're 460 and change. You could see 4 3/4, 5% very, very quickly. The other thing is expectations. Are we seeing people just managing expectations or are they telling us something different? And then the last thing in the equity market is the same thing, right? I buy strength, I sell weakness. Well, a downturn of 3, 4, 5% can turn into a 7, 8, 9, 10% sell-off very, very quickly. So those are some of the things that we're worried about right now.
Chris, this was great. It's good to catch up. It's been too long.
Yeah, it's
good to see you, mate. Thank you. Chris Harvey there of Wells Fargo. Your equity market pulling back by 0.7%. A little bit softer this morning, driven by those earnings yesterday from Meta going into Microsoft and Alphabet after the close later. Let's get you an update on stories elsewhere. Let's get to the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Because we haven't talked about it enough, there are more concerns for investors about Meta beyond the reversal of Zuckerberg's efficiency push, specifically that revenue forecasts were in the mid-range. Now, it does suggest that digital ad prospects aren't as strong as some had expected and potentially sets up disappointment for Alphabet's earnings today. Sophie Lunn-Yates of Hargreaves Lansdowne told me earlier this morning that she is worried about the digital ad backdrop.
There's been a slowdown in ad spending from tech companies in North America and China in particular as well. So just all in all, the global picture for ads is looking a little bit more challenging than I was certainly hoping for.
That conversation on Bloomberg Brief, which is every morning at 5 a.m. Eastern. Now, Southwest shares, those are also getting hit pre-market. Lisa, you mentioned that. The statement this morning, it also included their Q1 results. It shows just how big of a toll the Boeing crisis is having on the industry as a whole. Southwest said that growth is slowing. They'll have to end service at 4 different airports, and they're going to have to limit hiring while also offering voluntary leave. Making matters worse, Southwest is only set to get 20 Boeing 737 MAX airplanes this year, down from a planned 46. Now, speaking of Boeing, CEO David Calhoun says that it is making progress to fix manufacturing issues. He says that Boeing will meet its $10 billion annual free cash flow goal just 6 months later than anticipated. Now, as for the earnings themselves, Boeing burned through $3.9 billion. Shares, though lower this morning, were higher post-market yesterday because, as one analyst put it, quote, well, it could have been worse. That's your Bloomberg Brief. John.
That's how low the bar was. Danny, thank you. We'll catch up with you in about 30 minutes' time. Up next on the program, the president signing the foreign aid bill.
We're sending Ukraine equipment from our own stockpiles. Then we'll replenish those stockpiles with new products made by American companies here in America.
That conversation up next, live from New York this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges was elected.
was going to keep reading World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Earnings season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been? Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Stocks down here by 0.6%, just about squeezed out a third day of gains yesterday on the S&P 500. I say just. We were positive by not even 1/10%. We're softer this morning off the back of Meta numbers yesterday afternoon. The outlook disappointing you, the spending disappointing you, you being the people who are selling the stock. The 10-year at the moment, 464.60. In the FX market, the euro stronger by 0.2%, 107.23. Did that feel personal?
Yeah, I was like, why so personal? Like, you're selling Meta stock.
It disappointed you. It disappointed whoever's selling
Were you disappointed?
No, I couldn't care less. I don't hold Meta.
Okay, carry on.
No, thank you. Under surveillance this morning, the president signing the foreign aid bill.
We're sending Ukraine equipment from our own stockpiles. Then we'll replenish those stockpiles with new products made by American companies here in America. This bill includes $1 billion for additional humanitarian aid in Gaza. And Israel must make sure all this aid reaches the Palestinians in Gaza without delay.
Here's the latest. President Biden signing a $95 billion package that includes aid for Ukraine, Israel and Taiwan. The package also including language that would ban TikTok unless its China-based parent company divests. Tobin Marcus of Wolf Research writing, quote, "We continue to believe this will likely become an effective ban based on our expectation that Beijing will block a divestiture. Even if Beijing does allow the sale to go through, we expect that they will attempt to prevent TikTok's algorithm from being part of the transaction." Tobin joins us now for more. Tobin, wonderful to catch up with you. I've been going through this over the last few weeks, and I've been asking this question repeatedly. We all have around the table. It is clear the tension's starting to build, the rhetoric's starting to build from the United States towards China. What is less clear, from our perspective at least, is the policy initiatives that will be deployed in the months to come going into November. What are you expecting to see?
Well, you know, I think that for the most part, we've seen the biggest swings that we're going to see. This TikTok ban, we continue to think it's a ban rather than divestiture, as you say, I think is probably the last big thing that Congress will do before they head into the traditional pre-election inactivity. There will be more conversation about China-related restrictions for the future over the summer, but I think nothing will get done. And then from Biden's perspective, you know, from an administration perspective, the semiconductor export controls, I think, are the sort of biggest swings that we have seen so far. Secretary Blinken is in China right now, evidently threatening secondary sanctions on Chinese financial institutions if they don't stop sending, you know, dual-use goods to support the Russian war machine. I don't really think that that is going to come through, although it's a very serious threat. But you know, I think that those are sort of the biggest, most confrontational moves that are on tap. And then the last one is so finally getting the long-awaited reorientation of the Section 301 tariffs that we have on Chinese imports. The administration's been talking about this for literally years at this point, but it seems like they're finally on the verge of sort of raising tariffs on autos and EVs and solar panels and a few other things, possibly lowering tariffs on some lower value consumer goods. But overall, you know, we're locked into quite confrontational policy despite the sort of attempts at taking the tone down with China.
But when it comes to TikTok, the clock has started. What have we learned from, say, Montana when they tried to have this ban that could potentially play out nationally?
Yeah, I don't think the precedent from the Montana ban is hugely relevant to the federal level. So, you know, Montana passed the state level ban last May, I believe, in late November of last year, that was preliminarily enjoined by a federal district court that's currently being appealed. So that case is underway. But a big part of the rationale for blocking that at the district court level was that states don't have jurisdiction over foreign policy. The sort of view of the court was this clearly is a China measure, not a Montana consumer protection measure, and that's not the province of states. But that, of course, does not apply in the congressional context. I think if anyone is going to be making policy about sort of what we as a country want to allow in terms of foreign ownership of U.S. media platforms, it's Congress. And so I think they'll be afforded a lot more discretion by courts than the state was. So I don't think that, really is much of a positive signal for the company.
But do you think it survives litigation in the courts?
I think it does. Yeah, I think it does. They will make a First Amendment argument. But again, in a national security context, courts tend to defer pretty substantially to Congress and the presidency. And I think it's very important that this is a sort of newly passed law explicitly for this purpose. So, the other precedent that people point to, Trump, of course, tried to ban TikTok in 2020 using executive action under a very long-standing law called IEPA. And in that case, there were specific carve-outs in that law covering, informational materials that TikTok fell under. But again, we're in a very different situation if Congress says sort of, here is the will of Congress contemporarily. We have just decided to do this thing with a national security rationale. I think that's very different than a lot of the litigation that we've seen, under both Biden and Trump, where they're sort of reaching for some obscure provision of an 80-year-old law to try and do what they want to do because they can't get Congress to act. Here, Congress has acted. And I think that that's probably going to hold up in court.
Tobin, do you expect a response from Beijing, some sort of retaliation from China, given what's going on in the United States when it comes to TikTok?
It's an interesting question. I'm certain that we will see something, but I don't necessarily think that it's going to be substantive rather than symbolic. I mean, this question came up a lot in the context of the semiconductor export controls that were first imposed in the fall of 2022 and then tightened, in the past few months. There were a lot of questions about how will they retaliate. And I think the judgment from Beijing at the time was, we have at least as much to lose from the U.S. From any retaliation. So we ended up seeing these sort of token efforts around restrictions of chemicals that are important for semi-fabrication. And I think in this case also, you can easily come up with sort of symbolic retaliatory moves that they could make targeting American companies. Of course, Chinese rules already prohibit sort of comparable American companies from operating within China. So it's not as if there's a sort of direct retaliation that's germane here, since they've long since banned any sort of U.S. social media platform from operating within China. And people pointed to sort of recent moves facing Apple and other U.S. tech companies as sort of an indication of things to come. But I don't think that we necessarily see dramatic retaliation here, because China's positioning themselves as sort of the defenders of free trade, the opponents of unilateralism, the people who are telling the U.S. not to let ostensible national security concerns get in the way of free commerce. And I do think that both reflects how they want to position themselves to non-aligned countries and their own commercial interests. And I think both of those will steer them away from dramatic retaliation.
Tobin, what do clients ask you more about? China and potential retaliation and geopolitics, or Lina Khan?
Lina Khan has been a very long-standing topic of conversation, comes up in a lot of different contexts. I think that's probably relevant to a broader swath of investors, since deal activity across every possible sector is implicated by what the FTC is doing, whereas the U.S.-China tensions do affect some sectors much more so than others, with semis obviously being the sort of foremost example of that. Lots of questions, I think, over the course of the past 3 years about what the FTC and the DOJ are up to. And, we've been thinking a lot about what that looks like heading into Trump also, and getting questions about what a Trump win would mean for antitrust. We tend to think that Trump would steer antitrust a little bit more back in a pro-business direction, but it's not totally obvious, because there are, I think, pressures within the conservative coalition at this point. Kind of populist wing of the Republican Party has been fairly supportive of what Khan at FTC and Cantor at DOJ have been doing. And so I think there will be, at a minimum, a tug of war about that within the conservative movement if Trump wins.
In some ways, it looks like they're on the same page. Tobin, thank you, sir. Tobin Marcus there of Wolf Research. We started the week with this. If you can't get Tapestry Capri done, can you get anything done in this country now?
I mean, this is a really good question. This is a reason why when we hear from people, including Chris Harvey, he's talking about looking for the M&A wave. Where is it going to come from if you see a lot of them sort of cancel before they get off the ground? A lot of questions. They're doing some really interesting stuff.
Lena Khan, Jonathan Cantor have brought up the highest number of merger challenges since they've been required, since 1976. And to Tobin's point, J.D. Vance, Ohio Senator, potentially a VP pick.
Agrees.
The only person he agrees with in the Biden administration has praise for is Lena Khan.
It's pretty impressive stuff, isn't it? Coming up on the programme, we'll catch up with Kit Jukes of SocGen. Lisa's been looking forward to this all morning and why he's looking potentially for dollar yen to hit 170 this summer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Session lows here on the Nasdaq 100. We're down about 1% at the moment. Bear in mind, on the Nasdaq 100, Meta accounted for about 5% of that index. And Meta is down pretty hard in pre-market trading. Looking at futures elsewhere on the S&P 500, softer by 0.7%. Lots to talk about just in terms of the earnings. We'll hear from Alphabet and Microsoft a little bit later on this afternoon. In about an hour from now, you'll get US GDP and you'll get jobless claims as well. So here are the scores in the bond market going into that on a 2-year, a 10-year, 30-year. Yields just about unchanged on a 10-year maturity, 464.81. On a 2-year at the front end of the curve, 492.48. 3 big auctions this week. We've had the 2-year, the 5-year, and Lisa later, we get the 7-year.
$44 billion. It's actually more interesting to me to watch longer duration bonds right now and the sales of them, because that's the uncertainty. Longer term, are we looking at a higher inflation, a higher kind of term premium based on a higher deficit and an exceptional U.S. economy? And this really is a key question. I also am wondering how we respond to this data. I mean, what is going to really move the needle? Is it going to be weak data that actually moves the needle more than strong data that people have basically baked in? Is that kind of where we are right now?
I want to talk about risk mitigation with you too, Bramo, because you've been on top of this story for a while. I want to reflect on a conversation we had yesterday. If you missed it, it's worth going back over. Michael Schumacher of Wells Fargo, echoing comments we've had from Peter Cheer of Academy, that perhaps treasuries won't work, core fixed income won't work as a haven against the dominant risk in their mind, which could be geopolitical risk. And the argument that Mike Schumacher presented yesterday was basically the similar one to what Peter Cheer mentioned, which is if you face increased geopolitical risk, heightened risk, and the response to that is increased defense spending, particularly in places like Europe, does that put more cracks into the fiscal picture in certain countries that need to spend more money? And ultimately, does that prevent that bid from coming into the bond market in quite the same way?
You can broaden that out. Any kind of downturn, what ammunition do you have to fuel it with fiscal spending if your deficit is already as big as it is? So in a downturn, do you get that same kind of flight to safety into treasuries, into boons, into gilts, if basically you're restricted by how much you can spend without seriously weakening your fiscal profile? It's a big concern for a lot of people.
It feels very acute, though, in Germany, because they did a complete 180 when Russia invaded Ukraine. And the fact that they're even talking about really amping up their defense spending, and they have been trying to, is a big deal.
A sizable move in European bond yields yesterday as well. Let's turn the board and go to foreign exchange. Have a little look at what's happening with dollar yen and euro dollar as well. On the dollar against the yen, 155.51. Breaking through that level just yesterday. We'll be talking about that with Kick Juice of SocGen in just a moment. And looking at the euro, 107.27. Just some recent commentary from some of the hawks on the Governing Council of the European Central Bank suggesting they'll go in June, we'll agree to that. We are not going to agree to a follow-up anytime soon.
And you've seen that pretty consistently, actually. Yes, the hawks are coming out, but you also hear the doves being less confident about some sort of rate-cutting cycle there, too. It's sort of this persistent inflation that's challenging the pivot that all the central banks seem to go under, and it's the pivot to the pivot. And here we are, and we're just trying to understand.
It's a U-turn.
You know, the economists went with that, the pivot to the pivot.
The pivot.
Yeah, I wonder where they got that from.
They're watching.
Got that from Bramo.
Is it 2' pivot, or is it
no
pivot
idea.
squared?
I'm not the grammar police.
It's a U-turn.
Did they give you a check for that, or no? They didn't reach out.
Let's move on.
And you can never know who wrote it because there's no bylines.
That's true.
So you can't write to them and find out anyway.
Just talk about it on air.
Shady. Under surveillance this morning. Meta's year of efficiency in doubt. Shares tumbling in the pre-market after the company reported slower sales growth and said it will spend billions more than expected on AI. CEO Mark Zuckerberg asking investors for patience. Will they give it to him?
Well, potentially they're not giving him to today, but let's see if this stock maybe makes a turnaround during the rest of the afternoon. I'm looking forward to Microsoft and Alphabet because they're also expected to deliver updates on their own AI efforts. But when they come out, potentially if they lift CapEx, maybe it's just for AI. And this idea Mandeep has when you don't have these reality labs, this metaverse, venturing into things like hardware with Ray-Bans. If that's set aside and it's just AI, how much may potentially would the stock be up and not down?
I feel kind of bad for Mark Zuckerberg. He doesn't have the same kind of cult of personality that Elon Musk has. You know, Elon Musk can come out.
He's cultivating it.
He's cultivating it with the chain and such like that. But I'm wondering, you know, if he had a little bit.
Jiu-jitsu as well.
Yeah, exactly. He's gotten jacked. So there's this question of, okay, so at what point can he say something and people get excited about it in the same kind of way that Elon Musk does?
$175.2 billion, fourth richest person in the world, according to Bloomberg's billionaire
Lisa feels sorry for him.
I have the tiniest violin for Mark Zuckerberg.
Okay.
Do you want to take it back? No. Still feel sorry for him. Okay, good. Let's talk about the data in about an hour. US first quarter GDP data due in about 60 minutes. The median estimate in Bloomberg survey calling for a 2.5% rise over the previous quarter, underscoring the strength of the US economy. We'll also get jobless claims and personal consumption data going into next week. Going into next week, we'll have PCE, we'll have a Federal Reserve decision, and we'll be talking about payrolls next Friday. I just wonder, look, if it took a soft PMI earlier this week to drive a decent bid into bonds in the way that we'd seen, I just wonder how soft a number needs to be to reintroduce a conversation about a rate cut going into summer.
And the implication from the response to that PMI is that the threshold's actually pretty low. So maybe it really, and I'm sorry to do this, maybe it isn't the pivot to the pivot, and that we're actually looking at a Fed that still wants to cut, and that they're just going to look for any excuse possible. I also think you've been really on this, and it's really a smart point, which is if immigration is allowing the sort of federal spending is allowing this, well, how durable is that if we could potentially get some pretty significant policy shifts? I think it's a great point.
It's a question, Lisa, we've got to keep asking. Elsewhere, the BOJ, and thank you, that was very kind of you.
Let's go.
BOJ, meeting underway with traders watching for possible intervention as the yen weakens past 155. Kit Juicer Solgen says this: the most dangerous period right now is during this repricing of Fed expectations after the break of a big psychological level. If I'm going to see 170, I'll have seen it by the July Fed meeting. Kit joins us now for more. Kit, we've been looking forward to this. Lisa's been excited, not to talk about football, to talk about dollar yen. I promise you some Arsenal time at the end of this conversation. Kit, we went through 150, we went through 151, 2, 3, 4, 5, all the way up, and every single round number we cut through, we had people coming out and saying intervention risk, intervention risk. Kit, what do you think is guiding the Ministry of Finance in Japan at the moment?
I think in part they're nervous about fighting a battle they can't really win. So, you know, the correlation between dollar yen and 10-year note yields is absurdly strong. US yields are moving higher if the Fed's not going to cut rates, if the US economy is going to be strong in data released shortly. You know, if we're going to continue down that way, do they feel super brave about coming in and fighting it? They'll have to come and fight it in a committed fashion. So they've been trying to just say, you know, we're watching it. And the trouble is, in a low volatility grind higher, the people who are buying dollar yen are extremely comfortable. They're not getting squeezed out at all. The people who are selling dollar yen as a big break levels have just been frustrated and losing money and having a hard time the whole way. And the cheapness of the yen is monstrously evident for anybody who goes and stands in front of Cherry Blossom having their photo taken, or maybe who goes skiing, but it doesn't show up in export numbers and the wider economy in a big enough way. So they're nervous, I think, about going in too early. But as long as they do that at this point, that just risks the market getting the bit between the teeth and taking us to absurd levels. Because in the end, you know, the extremes of these big dollar yen cycles have done that time and time again.
Extremes, absurd. Is there anything excessive or disorderly about 155?
No, I don't think so. I think, look, you know, I mean, the first one I really thought about was the one in 95, when we'd moved down in a long cycle to 100 that sort of made sense, and then we went down from 100 to 80 extremely quickly and came back from 80 to 100 almost as fast. We've had a bunch of those since then, but that's disorderly, and at that point you feel as if this is going to blow itself out and correct itself because it's going to push volatility up. Traders won't hold positions. At the moment, it's a low volatility grind, and there's not much stopping it. The carry's still attractive. The message isn't changing. The central bank's not being aggressive enough.
And this is the reason why you suggested that we could even see this cross go to 170 if this just continues as it is without some sort of intervention, which raises the question, why do you think it's inconceivable that the Bank of Japan is going to hike rates at the meeting tomorrow?
Because the arguments they've used in terms of their rate policy was to say, you know, having moved once, was to say we want to see now what's going to happen when we get the full set of spring labor market data. And so they're going to revise forecasts on inflation and on growth. But it makes vastly more sense on that basis that in the next forecasting meeting in October, then they can say we've won the fight on the labor market and we're going in the right direction, and then they can act again. It's hard for them to do it now, except as a knee-jerk reaction to what's happening in the foreign exchange market, and I'm not sure that's how the Bank of Japan thinks.
Is 170 your base case then?
No, 170 is what I'm looking at it saying. I don't have a base case in a world where this is out of control. 170 is literally having broken 150. Why wouldn't we go 20 figures higher? Because I've seen it half a dozen times in my career.
One of the biggest surprises this year has been the dollar strength. A lot of people were expecting dollar weakness as we saw broadening out in growth and the sense of a global recovery. At what point does it become concerning or stifling in growth economically on a global level if you see this strength continue in the dollar?
I think it becomes a concern when it hurts the U.S. economy, for sure. When the U.S. thinks inflation's back under control and they don't feel the need to be fighting inflation. So a rate cutting Federal Reserve, it would be happy to see a weaker dollar. If it causes disorderly moves elsewhere, it causes a problem. I mean, you've got to go back in that sense. We had a really, really big dollar rally through the 1990s in the Great Moderation. And as the Fed raised rates, or cut rates and raised them again and then raised them again, we eventually caused the Asian crisis, having blown up quite a lot of things on the way, LTCM, Russia, bits and bobs like that. That caused a really big problem. That dollar wasn't as strong as today's dollar, but that move was a longer move up than this one. So you do get to a point where you create really genuinely big distortions and damage. I think from a US perspective, we haven't quite reached those. I think from a Far Eastern perspective, if you ask the Koreans, the Taiwanese, and the Japanese, they'd say, we don't like what the dollar's doing.
And they didn't like it last week, and there were plenty of complaints in Washington, D.C. Kit, we heard them. We heard the reports of them as well, and the meeting as well that took place with Secretary Yellen. Kit, we know the origins of these complaints. It's US exceptionalism, and it's a market that's taken the view that what we will see is central bank divergence, a Fed that has to hold, maybe even consider another hike, and central banks like the ECB that are going to go through some kind of cutting cycle. Kit, when I listen to the policymakers on the Governing Council of the ECB, though, that's not what I hear. I hear they're going to cut rates potentially in June. After that, I don't know. Can you walk me through this, Kit? So let's set it up. The economies. I understand the divergence. US really good. Europe struggled. Might be seeing a little bit of a recovery begin. People are taking that, pushing it through central banks and saying, what you're about to see is big policy divergence. Do you think we will?
No, I think you get less rate cutting in Europe. The stronger the dollar is, the less the Fed cuts rates. And I do think, from where we are now, apart from anything else, we're at the point where the market shock of strong European data is much bigger than the market shock of strong US data. You want to surprise someone, show me some signs of life in the German economy. And so you'll get a bigger market reaction. I think you'll get a bigger reaction at the ECB. The ECB is nervous from the way this has been playing out. But it wouldn't take much for the hawks at the ECB to turn around and say, hang on a second, let's just go one rate cut at a time and see how much we need. So I think this can play itself out in several ways. But I think from a currency perspective, I think it means that although the dollar's going up, it's not going up forever. I think from a policy perspective, there's some divergence because the situation's so different between the two sides of the Atlantic. But it's not going to go on indefinitely. We don't get huge divergence.
Kit, got it. Here's the appearance fee. I'm happy to pay it. Arsenal Football Club, top of the league. Did you get it done?
I hope so, but I'm watching like everybody else and just loving the ride.
Kit Jukes of Solgen, congratulations. Kit, thank you. In the stadium in the last couple of days, watching Chelsea get absolutely decimated, and Liverpool fall apart recently as well.
Yeah, really?
Yeah, okay, we'll let that go.
Arsenal, Chelsea, unbelievable, 5-0.
Casabramo,
well,
Liverpool falling apart.
Let's just move on.
If you're wondering why,
curious.
Things might get more bearish in the weeks to come if Liverpool don't win the league.
Inter Milan's looking for a loan, so let's talk about that.
Not my team.
I know,
It's
the other side, so that you don't care.
No. Equity futures right now on the S&P negative by 0.7%. Let's get to your Bloomberg Brief with Danny Berger. Hey, Danny.
Let me just add go Blues, and then I will move on. American Airlines, they are expecting strong second quarter profit, even though it is coping with still high fuel costs. While competitors have pared back their domestic flights, American has been leaning in, especially in its Sun Belt hubs. It also issued a higher than expected outlook. It's an early sign that that very strategy is paying off because consumer demand for travel is there, but perhaps mostly confined to domestics and near international routes. Ford shares trading higher in the pre-market trade, 1.8%. Work trucks and vans enjoyed a white-hot demand, as the CEO put it. It also managed to keep its EV costs in check. Ford is also on track to achieve a feat that would be the envy of any Tesla shareholders. That is more affordable EVs priced between $25,000 and $30,000 that can turn a profit. In the first quarter, however, Ford did rely on the good old-fashioned business of gas-fueled trucks and SUVs alongside its hybrids. Now, the CEO of the world's largest sovereign wealth fund told the Financial Times that he thinks Europeans are less ambitious and don't work as hard as Americans. Probably hard for European to admit. Norges Bank CEO Nikolai Tangen made the comments in the context of his growing investments in the U.S., which are about half of his equity portfolio. He said that Americans are more willing to accept mistakes and take risks, saying, you go bust in America, you get another chance. In Europe, you're dead. That's your Bloomberg Brief. John.
Danny, I think we've got to introduce him to some college grads in America and see if he changed his opinion. Danny Berger, thank you.
And there's soapbox.
We have to go there. Come on.
Well,
Too easy. Nikolai Tangen, can we just say, every time he comes on with us, just wants to talk about the numbers, where we're investing, we invest in everything. It's super dull, super boring. And then he says things like this in his own podcast as well. He's tremendous. It's fantastic. Want a little bit of that next time he makes a Bloomberg appearance.
Nikolai, please come on and talk to us about the divide in the culture between
Loosen
the
up
US
and, you know,
Europe.
tell us what you really think.
We'll give him a half hour.
About Europeans.
About how we're just not very ambitious.
Apparently, the Europeans are not ambitious. The Europeans might say they've got that work-life balance down in a way that the Americans don't.
He actually addressed that. I should be careful about talking about work-life balance, but the Americans just work harder, maybe at the expense of some other aspects of
some
life.
truth in that.
Yeah.
But by age group, you know, I think it's changing in this country.
Well, what about European graduates?
I think it's changing in this country. European graduates are like 30 years old. That's the difference. Stay at university for 10 years and live at home.
So that's the way to do it?
Oh, without a doubt.
Yeah.
Live with the parents in Italy till you're 35.
That's not happening. They're getting kicked out in my home.
Up next, the risk of a rate hike.
As long as there's no urgency around cutting, then you can have these discussions about, are we really restrictive enough? How long do we need to stay restrictive? And you wait for the data to show you something. That's where we are now.
A conversation up next, live from New York. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
Equity futures down 0.6% on the S&P 500. In the bond market, yields just about unchanged, 464.81. Under surveillance this morning, the risk of a rate hike.
When we get strong activity data, they are telling us that probably doesn't push them to hike, right? That probably doesn't push them to actually move more restrictive in terms of policy rates. But what that does do is it really reduces any kind of urgency. As long as there's no urgency around cutting, then you can have these discussions about, are we really restrictive enough? How long do we need to stay restrictive? And you wait for the data to show you something. That's where we are now.
Here's the latest, a fresh read on US GDP coming at 8:30 Eastern Time alongside jobless claims as well. Traders continuing to push back rate cut bets, with some even suggesting the Fed could make another rate hike. Greg Peters of PGIM saying this in the FT: I think it's completely appropriate to factor a rate increase in. I feel much better about the market pricing that in versus the start of this year when it was just cuts in extremis. Greg joins us now for more. Greg, you've talked about the bond market being in the strategic buy zone. Is it still in the so-called strategic buy zone?
I think so, Jonathan. I think, rates being higher is the story here. If you rewind the clock, January, November last year, there was so much bullishness around rate cuts. And I actually felt that was really the worst thing from the bond market perspective, as I think ultimately at the end of the day, the yield is what matters. The yield is what wins. And yield remaining high, I think, really continues to act as a tailwind for the bond market.
Greg, when yields were 2%, it was hard to get people interested in fixed income. I think people have been conditioned by that, the pre-pandemic bond market that went on for the best part of a decade, and that conditioning is sticky. Do you see clients shaking off that psychology? Have they got rid of that? Have they moved on? Do they understand the opportunities in front of them in fixed income?
I think they have, but there's definitely a recency bias. Investors have been jaded by this extreme central bank dominance that we've lived under the past decade or so. So I do think it's washing away. What holds investors back ultimately is the volatility. So as you see volatility in yields and just kind of markets broadly, it's hard to really alter your asset allocation scheme meaningfully. So what you need to see somewhat perversely is less fall in order to attract much more in the way of investment flow.
What's the thesis, Greg? Is it basically just simply a carry trade in a way that maybe people hadn't experienced during the years of monetary oppression? Or is this something that you can get behind the idea of rate cuts eventually and a bid into treasuries in some sort of downturn?
Yeah, so Lisa, I think it's a twofold benefit. The first benefit is just simply the fact that you are earning more in yield, and yield matters. That income in the door matters, and matters a lot. That's the first thing. The second is, if we do in fact hit some kind of economic speed bump or a recession, however you want to define it, there's actually scope for rate cuts. And so I'm not calling, cuts back to zero or what we've seen before, but, at 5% level, there is room, and having duration in the portfolio provides that protective quality that really was missing the past several years pre-pandemic and immediately post-pandemic.
I understand that for, say, 5 years. But for 10 years or 30 years, when you start talking about that level of duration, I start to wonder about the argument that we keep hearing from the likes of Peter Scheer saying, how much more can the United States borrow to help the economy fiscally during a time of difficulty? Does that kind of lever get pulled and then all of a sudden make treasuries less of a haven bid than they have been in the past? What would your response be to that?
Yeah, so I think that's a narrow focus of the world. So if you look at debt levels, they have increased globally, right? Post-pandemic, you've seen countries really start to spend. So I think there's this isolation type of examination here, and I think that this misses the bigger picture. That's the first thing. The second thing is, I think the U.S. is winning here. There's higher growth. Inflation has come down pretty meaningfully. So I think there's a real strong story for the U.S. No doubt, though, what investors are looking for is an off-ramp on spending, and we're not seeing it. So there's a lot of talk, a lot of chatter around the deficit. I think ultimately, though, the U.S. and U.S. rate market is the place to be, particularly in a time of crisis. And I think you'll see this perverse outcome where if you do have this kind of global swoon, you'll see more demand for U.S. Treasuries, not less.
Greg, just work through that an extra step. Let's say you get the economic downturn. What does the deficit look like in that world? What does that gap out to? Because if we're running something with a 7 handle at the moment with GDP growth like this that we're going to see at 8:30 Eastern time, what kind of numbers are we going to be talking about?
Yeah, so I think that is the challenge ultimately. So you don't have the same kind of fiscal room to spend in the time of a recession. That puts more pressure on central banks, which I think actually helps our treasuries a little more, actually. But you're quite right. And the way I think about it, and we think about it at PGIM, is that it actually means that the recession probably is not going to be as shallow as what many predict, right? Because you don't have that fiscal lift, which is so crucial to helping the economy find the bottom. So in my mind, you'll see a slightly harsher credit cycle, a longer duration type of recession, and an overall harsher recession, I'd say.
Interesting. Greg, really interesting thoughts. Thank you, sir. Greg Peters there of PGIM. The last one there, I find fascinating on the depth and duration of a potential downturn, given how constrained fiscal might be in the next downturn.
This is an argument people have been making for a while, that essentially because the United States incurred so much debt during good times, how much does that really constrict their hands in bad times? There is a sort of perversity that I keep thinking about, which is if there is a downturn and the Fed cuts aggressively, well, that could make the deficit a lot cheaper. I mean, that might be what you need, you know, in order to term out the debt at lower rates. I mean, this is sort of the difficulty in understanding exactly how this percolates out. It isn't just a clear line in the same way that it would be for personal finance.
You used to say this about Japan, careful what you wish for. You know, you get the growth, you get the inflation, the high rates with it. Where does that leave things?
Right, well, I mean, again, it's hard to sort of game this out. Is high inflation and longer high growth, is that a worse scenario right now for the deficit?
Coming up on the program, Bob Dole, Crossmark, the third hour of Bloomberg Surveillance with George Ferguson of Bloomberg Intelligence on the airlines. We've heard from Southwest and American this morning. We'll catch up with Marina Urici of T. Rowe Price and Stifel CEO Ron Khrushchevsky. All of that in the next hour, right here on Bloomberg TV.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, you know, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
earnings matter, and that's really clear. There's been a lot of good news priced into a lot of the big tech companies. That said, they really do need to deliver.
It's not all one trade anymore. It's sort of the magnificent 3 or 4.
From a valuation perspective, equities still look somewhat rich here.
We still think that there is room to run in equities, particularly U.S. equities.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The higher you climb, the bigger the fall, apparently, when it comes to stocks. We were up by something like 40% on Meta. Going into the earnings, we're down by 15% in the pre-market, going into the opening bell about 90 minutes away. How does this set us up for Microsoft and Alphabet a little bit later on this afternoon, and on to next week, Lisa, for Apple, for Amazon?
I wasn't sure where you were going to go there. The higher you go, the harder you fall.
I wasn't starting a therapy session.
It's like the way that the morning's going. We could do that. What it means is that, honestly, Meta was probably the highest flyer, apart from NVIDIA. So it had the highest, the most to fall, if we want to go through that. And we can talk about how sorry we all feel for Mark Zuckerberg and the lack of maybe the same kind of star power that Elon Musk has when it comes to some of his prognostications. For Microsoft and Google, it seems like the bar is equal weight, if you want to say, because basically you've had gains, but these have been the darlings of the AI trade, and they have a chance to really deliver on that and show the application going forward.
Meta's been a darling of this equity market for the last 12 months plus, since the back end of 2022. Big part of the bullish thesis was the year of efficiency. Mark gets it now. It's about discipline. It's not about spending. Is that year of efficiency coming to a close based on the comments we got from yesterday, which include invest aggressively in AI research and product development efforts? That didn't go down well yesterday. I wonder if we sort of learn to love that a little bit more in the days to come.
Here's the interesting thing about this earnings cycle. Every earnings report is different, and the bar is different for every single company. You hear this sort of efficiency discussion from certain companies that are talking about reducing costs in order to support revenues that are coming in lower. And then when it comes to, say, Elon Musk, they're spending on robo-taxis and other things, and just the promise of it is just fine. With Google and with Microsoft, the problem is investment is rewarded if it's in the right thing. If it's in the right kind of durable AI investment, people will reward it.
This is what Mandeep was saying. People like the AI story. They're not so hot on the Reality Labs and the Ray-Ban story. Mark Zuckerberg yesterday on the call, though, said smart investors, potentially those that are buying, not selling, smart investors see that the product is scaling, that there is a clear monetizable opportunity there even before the revenue materializes. But what investors are saying is, when you look at things like Reality Lab, where is that monetization? Because it hasn't materialized just yet.
Not the only focus for us this morning. We'll be talking about GDP in about 28 minutes from now. US GDP, the estimate at the moment, 2.5% in our survey. The previous quarter, the number was 3.4. So really punchy stuff, and looking for some of that to continue in the first quarter based on the information we've already had. If you look at jobless claims, Lisa, the estimate 215, previous week 212. That's your setup for 8:30 Eastern time.
How much of a leading indicator is this? I remember when people last year were saying, this is what you have to watch, and if the labor market's going to crack, this is going to tell you first. Is that still the path of travel? I don't have a sense of it. I get the sense that people are kind of dismissing it. It's sort of all of these data points get dismissed until suddenly they come out with some massive aberration, and then we focus on them for the next 2 months.
Does this sound like a crack? 246,000 for next Friday, which is the current estimate in our payroll survey.
I mean, the argument could be, why isn't it 600,000 if we're talking about a wave of immigrants, right? I mean, this is basically where we're at in terms of resetting the bar. But no, it's not showing signs of cracking, which is the reason why people are kind of pricing out rate cuts.
Look at the way economists have been reforecasting GDP based off when the CBO came out with the immigration numbers. And the CBO is saying, now that we recalibrated with this type of immigration, 3.3 million as opposed to 1 million added to the U.S. economy, $7 trillion over the next decade is what they see in growth.
This cycle has been so difficult to read, kind of making it up year to year, aren't we?
Day to
ridiculous. Oh, just nonsense half the time. Equity futures on the S&P 500 shaping up as follows. Equity futures negative and pulling back off the back of those Meta numbers. We're negative right now on the S&P by about 0.7%. In the bond market, yields a little bit higher by a single basis point. On a 10-year, 4.65. And in foreign exchange, the euro slightly firmer, 107.19. Coming up this hour, we'll catch up with Crossmark's Bob Dole on why he thinks a soft landing is unlikely. Blarina Urici of T. Rowe Price reacting to US GDP data, and Steve Stifel's Ron Krzyzewski on why a rate hike could still be on the table. We begin with our top story. US GDP data 30 minutes away. Crossmark's Bob Dole saying this: equity markets have stumbled modestly because of yet another pivot by Fed Chair Jay Powell. The odds favor an equity correction or consolidation rather than a transition into a bear market. For now, the economic and inflation backdrop is not consistent with rate cuts. Bob is with us for more. Bob, good morning.
Howdy.
Consolidation versus, say, dipping into a bear market and bear market territory. What's the distinction between the two?
Distinction, of course, is amount of decline and, of course, the macro data behind it. As you all discussed, economic data is pretty good. In that environment, it's unlikely we see the eyes of a recession anytime soon and therefore a plain old bear market. So we're way overbought, maybe not in the short term, but we've had that almost 30% rise from the Fed pivot announcement on Halloween until the recent high. It's time for just a little rest. Markets get tired, just like you and me.
When you say overbought, and I'm tired too, are you talking about the index level on the S&P, a specific cohort of names, the big tech players? What are you talking about specifically?
Yes, all of the above. I mean, the breadth of participation certainly improved. It's not what a lot of technicians would like to see. And as you're pointing out in the earlier conversation, for these high-flying, big attention names, if the numbers don't come through and the verbiage isn't perfect, you spill back. Take Meta. Down, yes, but look at it over the last 6 months, 12 months. It's still been a monster stock.
Mike Wilson was on the show of Morgan Stanley a couple of days ago, and he was talking about how difficult it is to call any kind of index level because this has been a story of specific stocks, and we see that in the earnings. The bar is different, the types of guidance is different, the response is different. How has that changed the way you approach investing?
Much more stock specific. Take the Magnificent Seven. Last year, they all went up. We get to the first quarter this year, and you get Apple and Tesla down a double-digit percentage and some up a double-digit percentage. It's not a stock market, it's a market of stocks, as we often say, but that's even more true now.
So for years, that was the opposite. It was all just riding the market, riding the Fed, riding central banks. How prepared are investors for this type of environment when they got rid of a lot of their single stock analysts? They went with indexed products. The banks cut back on that. And now we're focused on each individual earnings report and scrutinizing every line.
Great question, Lisa. I think investors are not particularly prepared, but look, the next 5-10 years, stocks are probably not going to grow double-digit percentage. And therefore, if you're going to get a double-digit percentage, you've got to be in the right stock. So doing specific analysis, when interest rates have normalized, which they have from that zero we had roughly for a decade, that's an environment where active managers and stock picking should do better.
So right now, are there any themes that you can pick out in the earnings, the early earnings, about just some of the overweight that we've seen, the conviction in energy, the sort of questions around consumer discretionary? How have you been shifting your view subtly around the edges?
So financials and energy still are the bulk of the portfolio from an overweight standpoint, but I would emphasize some common factors: earnings persistence, earnings predictability, cash flow. I have no names in my portfolio where I think the PE is going up. If I get that, that's gravy. Valuations are full.
You talked about oil prices, and you like energy as the backdrop. What is oil prices, you think, going to do when it comes to, say, earnings, corporate profits? Are they going to be passing on potentially, if the input costs are going to be so much higher, are they going to be passing that on to the consumer?
Absolutely. That's part of the problem. It's part of the squeeze we're starting to see at the low end of the consumer. No longer having excess cash from COVID, beginning to go into their credit card balances, even some evidence of rating 401ks. This is not sustainable and not healthy.
So you don't think the consumer is as healthy as some people think and say?
Agreed. Overall, still good shape. Top end, great shape. Down the bottom, we're starting to see some deterioration, and that will spread over time.
So you talk about the possibility of some sort of rate hike. What would that do to sort of shift this stock-specific type of environment into a market that definitely had a direction?
It would not be such good news as you can imagine, Lisa. Look, I don't think the Fed's going to raise rates, but out the curve, we've already seen the 10-year, for example, move up to 4.65. Could there be more upside there in an ebullient economy? Absolutely, but I think the Fed's got to try to buy time here. They're between a rock and a hard place.
You mentioned the consumer, savings down, lending standards are tight. This has been true now for quite a while, and things seem to be holding up okay. The word we heard yesterday was the word polarization. That was from Kering. They were complaining about Gucci sales and blaming it on the polarization of the consumer worldwide. Just what is happening with the consumer in America? How are you playing discretionary themes at the moment?
So top end, love the stock market gains, appreciation of their real estate. Most of them are working. They've probably gotten a raise. They're happy. They're spending money. But you go down the other end. I mean, the number of people that are working 3 jobs, most of them working 2 now, 2 jobs down to 1. Government doesn't measure all that stuff real well. But down under, we're starting to see some deterioration. And that will only slowly spread over time. Look, I'm not saying a cataclysm's coming, but I do think we will see more pervasive consumer weakness.
We're just trying to work out how to invest around it because, as you know, discretionary on the S&P 500 has the EV factor. It has Tesla as a big weighting in that. What would you strip out from the consumer bucket right now, and what would you get exposure to?
So I think the top end of the consumer in pretty good shape. Where you're high economic dependence, I think you've got to be careful. You know, and then you stick with those names that have the high, consistent earnings, which is not just in the consumer space. Takes you to some financial service companies. Yeah, some consumer names are reasonably programmatic in terms of their earnings, but not a whole lot of them.
Bob, this was great. It's good to see you.
Thank you.
And congrats, buddy, on the CEO role.
Thank you,
I missed that. We haven't spoke for a while. Congrats. It's a serious congrats. Of course it is.
Thank
Shouldn't
you,
be, I think. Bob Dole, across Mark. Bob, good to see you. Thank you, buddy. Let's get you an update on stories elsewhere. Let's get to the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Biden's campaign has said it will continue to use its TikTok account. The irony, of course, is that the president has just signed into law that ByteDance needs to sell its stake in TikTok or be banned in the U.S. Biden's team justify it by saying it's part of a strategy to reach a wider range of voters. TikTok is one of the rare places that Biden can reach Gen Z and millennial voters. Let's get a quick check on Meta shares this morning, down more than 15%. The fear is that Zuckerberg has backtracked on what was supposed to be the year of efficiency as he asked investors for trust and loyalty. Now it's Microsoft's turn to prove that it can monetize AI. Earlier, I spoke with Nancy Tangler of Lafler Tangler Investments about the tech giant earnings.
I think you can argue that he hasn't learned his lesson. We've been here before, you know, where the CapEx for the metaverse, and now we're in AI chat box spending. Whereas I think with Microsoft, the use cases are multiplying in generative AI.
Similar sentiment among many investors this morning. You can watch the Bloomberg Brief every morning at 5 a.m. Eastern. Now, David Einhorn, as many will remember, earlier called this year the stock market fundamentally broken, and his Greenlight Capital is now struggling to outperform that broken market. The fund returned 4.9% in the first quarter. That compares to 11% return for the S&P 500 Total Return Index. That all according to an investor letter. That letter repeated Einhorn's qualms that passive money and systematic strategies have caused investors to overlook valuations. Greenlight also added that there was, quote, negative alpha in our long book and positive alpha in our short book. Surely not what they intended. That's your Bloomberg Brief, John.
That note earlier this year was absolutely fantastic. Danny Berger, thanks for that. We'll catch up with Danny in about 30 minutes' time. Up next on the program, Boeing weighing on airlines.
I think we're now getting, with the new management team in place, I think we're going to hopefully see the end of these production challenges in Boeing.
The straight talking Michael O'Leary. Anyone better than that in the airline business?
Absolutely not.
Just absolutely
honestly.
fantastic.
I love it.
The best. A conversation up next. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equity futures on the S&P 500 down here by 0.7%. Yields a little bit higher on a 10-year. 465.43, about 15 minutes away from US GDP. We'll get some jobless claims as well. That'll set us up for tomorrow when we get PCE and UMich going into the weekend. Coming out the other side of the weekend, Federal Reserve decision Wednesday, then straight into payrolls for the month of May. May is here. It's just around the corner already.
Which is the reason why June is looking less and less feasible. July is the new June, and how soon is that going to be September? And then we can start talking about the silly season down in Washington.
I think we're already talking about December, aren't we?
Yeah, exactly.
Is the date on the calendar for cuts?
Well, if that's the case, how far does that get pushed out? And then how does that really change the equation at a time where any soft print seems to be giving people extra fuel to possibly go buy.
Yeah, we mentioned this. If you're just joining the program, welcome. We said earlier, what would it take to restart the rate cut conversation again? Maybe not June, but for July. How soft would the print need to be?
You know, I've heard mixed things right now. I think probably a lot of people sense that there is dissent right now on the FOMC. You could make an argument on either side, that they want to get one in and then they don't have to do any more for the rest of this year, and they want to do it further ahead of the election enough to not be considered political.
Lots of data over the next week or so. Under surveillance this morning, Boeing weighing on airlines.
We're seeing optimistic signs. I mean, we've seen aircraft now being pulled from the hulls, being moved from Wichita to Seattle, but without any defects being carried over. I think that's a good sign. It'll speed up the manufacturing process in Seattle, and I think we're now getting, with the new management team in place, I think we're going to hopefully see the end of these production challenges in Boeing.
Here's the latest this morning. Southwest shares sliding. The carrier ending service at 4 airports as Boeing reduces its aircraft deliveries for the year. Meanwhile, American Airlines expecting strong second quarter profit, even as it deals with high fuel costs. The carrier saying it's reaping the benefits of its focus on domestic routes. George Ferguson of Bloomberg Intelligence joins us now for more. George, when you look at the airlines at the moment, who's actually got a Boeing problem and who's just got a customer problem?
So Southwest is one that has a Boeing problem. American's got a bit of a mixed fleet, so I think they have less of a Boeing problem, but there's probably a little bit of interruption in deliveries. United is a big Boeing customer. They've got a Boeing problem. Delta doesn't. They're an Airbus customer. And then a lot of the small, low-cost airlines in the country, Frontier, Spirit, JetBlue, they're all Airbus shops, so no problems there. Although some of those are struggling with the geared turbofan. The geared turbofan engine built by RTX, Pratt & Whitney, that's going through an inspection program due to some parts that may have been faulty, and that's taken a bunch of airplanes out of service this year. It will be into this summer. Less of an issue, I think, than the Boeing problem for the U.S. market, but there's problems all around, I guess, right now in U.S. aerospace.
This raises an execution problem, an execution question. Who's dealing with it best? Let's do Southwest versus United. Who do you think is dealing with it best?
I think United is dealing with it best, but United's dealing with it best only because United has much more of a premium product in their airplanes. And as I look at the results that came out this morning from American and Southwest, that, you know, American may tell you that second quarter is going to do much better, but the yields, the price the customers paid per mile they flow, were actually quite poor for the first quarter, surprisingly poor compared to United and Delta. Domestic yields down mid-single digits, while the Delta was flat. United was up a bit. So, you know, there's other things going on besides just airplanes in the marketplace. I think a lot of it is premium versus basic economy, what's going on right now in the airlines.
Let's go there. This question of how much can you pass along higher costs to the consumer, and there's definite pushback among certain consumer types. I am wondering how much this really does crimp airline profits if oil prices stay where they are or go higher, simply because they cannot pass that cost along to their consumers.
Yeah, agreed. Look, right now they're not passing the cost along. If you look at all these airlines compared to the year prior, performance is down, and fares don't look to have been improving again in 1Q. They may tell us there's more demand coming in 2Q. Let's wait and see it. We're not at profitability we saw pre-pandemic, and as you said, if fuel prices rise, I don't see the consumer giving it here. They're not going to give it with just because fuel prices are rising. They're not going to be willing to come out and give the airlines more money, I think, to fly. It seems like the consumer's a little bit tapped out. Again, maybe the lower end consumer is.
Do these things matter, like airplanes, the actual rides, customers going places with their families, or is it really just about what credit card people use and whether or not these companies are collecting enough fees to really support their sort of side project of flying people around?
Yeah, so, that's one of the things I think we're always trying to think about here at Bloomberg Intelligence, right? There's always this demand to use, the airline's credit card to get miles. I guess I wonder if that's the way Americans save for vacation. And so, I don't know, maybe they're less price sensitive because they're busy using that airline card day to day for, their food purchases and their fuel purchases. And then it comes to summer vacation and they just pull the points off it and don't care as much. I mean, again, the yield fare data we're getting tell us the consumer is price sensitive and is resisting higher prices, but there is a little bit of an inertia that's built in, I think, just from these airline credit cards. Some do it a lot better than others. Delta's the best, I think, in that space with their American Express partnership.
I wonder who Lisa flies with. George, I just want to quickly go back to Boeing for a second. We had an analyst come out and said, well, it could have been worse. Do you think we're past the bad news, past peak bad news when it comes to Boeing?
Look, I think a lot is predicated at Boeing on a second quarter recovery in the manufacturing process, in all of their facilities. I think if you remember when we entered this year, we were waiting for the Boeing recovery until all of a sudden a door panel came off an Alaska Airlines airplane. I guess what concerns me about Boeing is I feel like we're potentially bottoming with this problem, but if we have some other problem crop up that we're not thinking about, then we're back in the soup, I think. And so it feels like they're starting to get the bottom underneath them in the manufacturing processes, but you got to start to deliver a bunch of airplanes through the factory that have the quality that's expected, I guess, before I'm ready to totally check that off the box. I hear management telling me things are getting better. I want to see airplanes going into the marketplace and customers happy about it.
So, George, every time you or any other analyst comes out and starts talking about engines and panels falling out and doors blowing out, we start to cringe and say, we're really sorry, we want to apologize. John does this all the time. If you're about to fly, please block your ears. Do we have any evidence that people are flying less frequently because of some of the safety concerns, or is this just basically ongoing in the political and business sphere that hasn't really percolated down into consumer sentiment?
So I hear a lot of consumers ask me the question about if there's certain product I would fly or not fly. It's in the back of people's minds, but I get the sense that they're just driving on with life right now. And I think that's probably fair. I mean, the probabilities are very, very low. We haven't had any major accidents in a lot of years. Doesn't mean it couldn't happen, but I think it's just, you just drive on with life. I think, if you probably knew all the things they were repairing in your airplane before you left the stand, you might get a lot more concerned than you do normally. It's not a perfect business.
George, thank you, sir. George Ferguson there of Bloomberg. Nothing perfect about it, certainly this year so far. I've been checking. I didn't used to check, but I check now.
This is just Therapy Thursday.
There's a website, amiflyingaboeing.com. And you can check whether the flight you're scheduled for that day is a Boeing or not.
But what are you going to do with that? I mean, honestly, if you find out that you're going to be flying it, do you not go on your vacation with your friends or see your family?
Call your therapist. It's the Therapy
You
Thursday.
check before you book, don't you? That's the...
I like George's. Right. You carry on. There are risks everywhere.
Sure. Okay. Yes. From you. Yeah. Okay. Carry on. There's risks everywhere. That's Bramo, by the way. Bramo.
Let's move on.
Does that apply to markets or no?
Look, just come on. Keep going.
Okay.
Thank you.
All right, cool. Equity futures right now down by 0.7%. Let's set up the next 10 minutes or so. We'll be talking about US GDP and jobless claims. We'll be catching up with Blarina Urucci of T. Rowe Price right here to react to those numbers in just a moment. Mike McKee's going to break it all down for you. Brahma, this is it. Going into PCE tomorrow, the last big read of data going into next week.
And we've been asking all morning, and I think it's the question, which is, where is the bias right now in markets? Is it to more heavily weight a weak print or a strong print in terms of what that means for a Federal Reserve that I don't know if they've fully pivoted yet, but it does feel like, you know, they're less willing to cut rates, but they still want to.
Can I say both? Can I say both, and I'll say why? Let's take CPI as an example. CPI comes in hot, it just reinforces the previous three prints, and everyone's like, oh, scary, they're not just bumps. CPI comes in soft, and everyone says, oh, maybe this is the beginning of it. Let's start talking about rate cuts again. I think with that convictionless around this story, and to your point, it seems to change day to day, data point to data point. I think it doesn't matter. One way or the other, it's just going to change the conversation just like that.
Well said, which is a reason why in 5 minutes you need to stick with us for us to break it down, because it's going to have a big market impact one way or another. I think that it's wise. It's basically everyone is so uncertain that they're willing to really push the needle significantly either way.
Everyone shouts shark and they run to one side of the boat and then to the other side of the boat. And, you know,
that's a risk you're worried about.
Yes, sharks.
That's ridiculous.
Big on sharks.
Well.
And bears too.
Okay, but
you're not scared of bears?
No, you just have to be
so
big.
many walking around New York City.
That's careless, Bramo.
Yeah, you carry bear spray.
Equities right now to Jackson Hole.
Yeah.
Every time.
That was ridiculous.
At the Fed show.
And you know,
bear spray down in the corner.
And you're like staying in your room. You're not even hiking.
Because of the bears. It's a sensible thing to do.
Oh my God.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So much abuse in a commercial break, just for the record. Lisa's mum, Team Ferro, text in. True story.
She'll be
Team
happy.
Ferro, all right? Equity futures on the S&P, and thank you. We're down about 0.7% near session lows. We're down 1 full percentage point on the NASDAQ. These are the scores going into US GDP on a 2-year, on a 10-year in the bond market. Yields look a little something like this. 493.52 at the front end. Yields up on a 10-year by a single basis point, 465.22. With the economic data, let's get to Mike McKee. Morning, Mike.
Good morning. Well, we're waiting for the GDP numbers to drop on the BEA's website. We can give you the initial jobless claims numbers, 207,000 last week. That's down from the initially reported 212. And continuing claims, 1,781,000, down from 1,812,000. So no economy is slowing. We need rate cuts story there. GDP comes in as a surprise. This one is one for the bears, guys. 1.6%. That is about half of the 3.4% that we saw in the fourth quarter, and it is also significantly lower than the 2.5% that was anticipated. We need to, at this point, look at what the issue was with that. Personal consumption, 2.5%. That's lower than the 3% that was anticipated, and so that may be something that we need to look into. There's what happened with consumer spending, because it had appeared very strong. The quarterly price indexes, 3.1% for the headline. That is up from 1.6%. It is a tick higher than the 3% that was forecast. And core is at 3.7% on a year-over-year basis, up from 2%. So that is higher than the 3.4% by a significant margin, 3.4% that was anticipated. So at this point, what we've got is a series of data points that say, no, the Fed does not need to be cutting rates at this point.
So, Mike, we'll turn to the boards and I'll get to the price action. And as we often say, this is the first move, and the first move is not always the right move, and we'll see if this sticks. But this is what it looks like. We're down about 1% on the S&P, down by 1.4% on the NASDAQ. Bear in mind, if you are just tuning in, there is a meta effect into all of this. We were down about 0.7 on the S&P 500 before the numbers. Looking at bond yields, we're actually climbing across the curve from the 2-year out to the 30-year by about 3 or 4 basis points. On a 10-year up by 4 to 468. On a 2-year up by 3 to 496. That's supportive of the US dollar. Dollar yen at about 155.62. My initial read on this, Lisa, and this could change in the next couple of minutes, of course. This looks like a read of what we're seeing on core PCE price index coming in a little bit hotter than expected. Jobless claims coming in a little bit lower than expected.
That seems to be clearly the read-through that at least people are settling on, though. If you watch the tape, they couldn't really make heads or tails of it at first because this is confusing data. You have, on one hand, a real question mark about why GDP didn't come in stronger, but then you have greater pricing pressure even without the personal consumption. It raises a lot of questions. The jobs figures, if you say that that is the most reliable leading indicator, points to just ongoing strength, especially with those continuing claims coming in, going down to 1.78 million.
We'll talk lots more about GDP. Mike McKee's pouring over the numbers, and he'll explain what's underpinning that downside surprise on GDP. But claims 207. The estimate was 215. The previous week was 212, just much lower than anticipated once again. Mike, you've had a bit of time. What explains this one?
Well, it looks like consumer spending is the big issue at this point. Still driving down to find the inventory numbers, which make a big deal. The inventory is down by $19.5 billion. So that's one reason we're not seeing as much GDP as we had anticipated. Business fixed investment comes in higher than anticipated. So it looks like businesses were still spending some money, but it's goods spending that hurt consumers. A lot of that had to do with automobiles and gasoline prices, but services spending held up okay.
You know, Mike, I was saying this is kind of confusing number, and John rightly said that people probably are pointing more to the price index data coming in hotter than expected, so speaking to inflation, and then the jobless figure coming in lower than expected. How reliable is GDP data, considering the fact that it gets revised about 15 times?
Well, it gets revised officially 4 times. Two more times it'll be revised. Then next year we get an update when they look through the tax data to kind of match it up. And then down the road after 5 years, they do it again. But what the Fed is looking at next week is this unrevised number, and it's what they have to go on. Now, when you look at GDP at 1.6%, that would suggest a real slowdown, but at the same time, we're getting these higher inflation numbers. So what is the Fed to make of this? We'll get some better data tomorrow with the PCE income and spending numbers and then the PCE inflation numbers. But when you look at this, you know, if you were going to shorthand it, you'd say stagflation, but this is just one quarter's number. So we also have had a history of the first quarter being lower than in initial print, and then being lower than the rest of the year. That didn't hold last year, but it has been sort of a pattern in the past.
Mike, if you strip out trade, is it actually a better report?
It could be. I haven't gotten all the trade numbers in there yet, but that could be. I'll find that out before we leave here. You know, there's so much to this. I've been looking at all these different things here. Let's see. Trade.
Take your time, Mike McKee. You stay close. You work through those numbers.
You want to look at these charts.
I work through the price action.
Your eyes will...
We're down about 1% on the S&P 500 off the back of these figures. If you turn to the bond market, let's look at the 2-year, the 10-year, and the 30-year. Initially, I think for a lot of us, didn't know what to do with this data. Yields are higher across the curve by 4 basis points on a 10-year, 467.70. On a 2-year, up by 5, approaching 5% all over again at 497.47. And with that, as you might expect, supporting the US dollar. Dollar yen still around 155, approaching now 156. Let's go through this economic data with Blarina Urucci of T. Rowe Price. She joins us now. Blarina, this is an interesting mix of data with the emphasis on interesting. You've got a big downside surprise on GDP. You've got core PCE price index quarter on quarter coming in a bit hotter than expected. Jobless claims a little bit lower than expected. Where would you place the emphasis this morning?
So I think it's very important to unpack the components of GDP and what led to this slowing in growth in Q1. So overall, I would say this is not a worrying report for the Fed. It's a report that says the economy continues to expand at a solid pace. Look at consumption growth at about 2.5%. This is a healthy consumer that is backed up by the claims data where unemployment claims are low and job growth remains strong when you look at the payroll data. So overall, it's a report that says to the Fed, the economy is not reaccelerating. It's slowing from the pace of growth in the second half of last year. That is telling the Fed that those interest rate increases may be having some effect in slowing demand, particularly for goods, but it's not alarming by any means. And then what I like to do with this GDP reports is to sort of look at the final domestic sales and final sales to domestic private actors in the economy, and that's showing 2.5% to 3.5% growth in Q1. It's not telling us that the economy is that weak after all. And I think a big drag here is also coming from net inventory contribution, which Michael already alluded to.
So we want to talk about the sustainability of this economic growth that we're seeing, because so many people are piling onto this story of US exceptionalism. Away from the top line number, which is a clear and obvious downside surprise, the sources of growth in the first quarter, Blarina, can we talk about that? Do you see that continuing through 2024?
Yeah, so there are a couple of interesting things here. Let's start with business investment. This has been driven by structures investment in the past and intellectual property investment as the housing market was really retrenching throughout 22 and 23 and res investment collapsed. Now we're seeing a rebound in res investment. And I think this is going to be sustained this year because there is really a dearth of housing in the housing market. We don't have inventory, and home builders will start building again. And we're seeing that in Q1. So I think this will remain supportive of growth. Also, the point that we've made in the past together in this show is that I think the consumer, the U.S. consumer, will continue to keep its wallet open so long as we don't have layoffs. And layoff data are not screaming weak signs now, and so long as we continue to add jobs. And then Michael McKee already discussed this problem of historical residual seasonality with Q1 GDP growth, which means that oftentimes Q1, also Q2 tends to be weaker than the second half of the year. So we need to be cautious of this as well. Now, the bigger question that I think you're also trying to allude to is, where is potential growth for the economy? How fast can we grow beyond potential this year? And this is the big question mark this year, because we don't know the effect of this shock to the labor supply from migrant workers that we received last year.
Lorena, the market seems to emphasize, as John was pointing out, the inflation figures as well as the jobless claims coming in lighter than expected. Is this what the Fed would focus on as well? Would they focus more on inflationary pressures than they would, say, on slowing growth?
What the Fed has told us is that they're not concerned about the strong growth numbers and the strong employment numbers, and their focus remains inflation. So in that sense, it makes sense. I think they'll look at the GDP numbers through this lens too. But at the same time, there's no new information really in the PCE deflator for Q1, because we've already received January and February data for PCE. We knew that beat expectations. We largely have the components of March PCE because of the CPI reports and the PPI reports that we've received in recent weeks. And so I'm surprised that the market should focus so much on the Q1 GDP deflator, because there's no new information there as far as I'm concerned.
Lorena, great to catch up with you. I just want to get a final question, if we can, looking ahead to the Federal Reserve next week. What is going to be the big topic of focus for you at that FOMC meeting? Do you expect any big changes to the statement at all?
So I would say that they want to be a little bit cautious about how sanguine they are on the number of cuts that they will be able to deliver this year, given the strength of economic data, the labor market, and the upside surprises to inflation. So I do think they will emphasize that they have a dovish bias, but it's uncertain whether they'll be able to deliver on that March SEP and the dot plot. So I'm watching for signs that they want to back off from 3 cuts this year.
Got it. Lorena, thank you. Lorena Urucci there of T. Rowe Price going into the Federal Reserve next Wednesday. Mike McKee, you've been waiting patiently. You've had a bit of time to go over this. What jumps out?
Well, Anne-Marie was right about trade. Trade subtracted about 0.8%. We had a big increase in imports and a very small increase in exports. So even with the strong dollar, it didn't help out a whole lot. Well, it maybe helps on the inflation side. Personal consumption, 2.5%. As Lorena said, it's not particularly bad. Business fixed investment, non-residential up 2.9%, down from 3.7%. Surprisingly, 2.1% increase in equipment, while structures went down. That's a reverse of the story we've been getting. They were building lots of factories with the CHIPS Act and the Inflation Reduction Act, and now it may be that they're starting to fill those up. Mentioned inventories change as an issue, and the one other thing that is interesting here is that the federal government spending was down by 0.2. First time it's been down since June of last year. 0.6 of national defense was down 0.6 national defense spending, and so you wonder if this is one of those things that it's a shift in timing because Congress didn't pass the Ukraine-Israel bill, which will spend a lot of that money in the United States rebuilding ammunition and stocks, that we'll see that come up later in the year and contribute to more growth. So if you're the Fed, you have to take all these little things into consideration. I might walk back the idea of stagflation and say this is kind of a statistically mixed report. So it doesn't necessarily say growth has slowed significantly and you need to react to that.
Well, let's talk about how this market is trading on the statistically what? Statistically, what are you calling this? Mixed report? Okay, let's go with that. Equity futures on the S&P 500 down by more than 1%. We're negative by 1.16% on the S&P 500. Let's get up to speed with news elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Let's also get you a check on Southwest shares. Shares are down by 8% in the pre-market. It had a statement this morning that showed just how big of a toll the Boeing crisis is having on the industry as a whole. Southwest said that the growth is slowing. They'll have to end services at 4 airports, and they'll be limiting hire while also offering voluntary leave. Boeing has also said to only give them 20 737 MAX 8 planes this year, down from a planned 46. and it's smooth sailing for Royal Caribbean. How's that for a pun? Shares are higher by 2% pre-market. Earnings did beat, and it also upped its full-year profit forecast. Royal Caribbean said that demand for cruises is still surging, and now ticket prices are at an all-time high. Maybe the Fed does need to hike. ESG funds, they were supposed to be the cash cow future of fund management, but now the category is in the middle of its worst ever outflows. Clients pulled $8.8 billion from ESG funds in the first quarter of the year, data from Morningstar show. It's a clear U.S.-Europe divide. Europe, for its part, still attracted $11 billion of inflows in the quarter. It also highlights a growing political sensitivity to strategies that Republicans have labeled as woke and anti-American. One strategist at Morningstar said that there was indeed increased caution ahead of the U.S. election. And that's your brief. John.
Danny, thank you very much. Strong feelings here about cruises. We'll save those thoughts for another time if you're not familiar with them.
Everyone knows.
Maybe some people don't. Up next on this program,
Big cruiser.
Looking ahead to the Fed's next meeting.
Whenever the Fed does cut, the market will price a lot more easing, but who knows when that happens to be. So committee members have to subscribe to the idea it's not just 1 or 2 cuts, it's probably 4 or 5 at a minimum.
That conversation up next from New York. This is Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
The S&P negative here by more than 1%. Bond yield shifting higher by 6 basis points now on a 10-year through 470. Kind of ignoring what we got on GDP. And Lisa, we said it initially when the numbers dropped. The focus seems to be on core PCE, on the quarter coming in hotter and claims coming in lower than expected.
Those speak to inflation, and it implies that people think the Fed is going to care more about the inflationary read in the sense that there is not any cracks in the labor market than they do a GDP print that came in softer than expected, but still points to growth.
The 2-year very close to 5%, 4.99. Under surveillance this morning, looking ahead to the Fed's next meeting.
If you think about the FOMC, when those committee members sign up for one cut, they have to assume there will be a bunch of cuts to follow. And my strongest view with respect to Fed policy hasn't changed. Whenever the Fed does cut, the market will price a lot more easing, but who knows when that happens to be. So committee members have to subscribe to the idea it's not just 1 or 2 cuts, it's probably 4 or 5 at a minimum.
Here's the latest. Investors looking ahead to the PCE data tomorrow morning following GDP. Just after 20 minutes ago or so, the Stifel chair and CEO, Ron Kruszewski, saying this: at the beginning of 2024, the market anticipated 6 to 7 rate cuts. Stifel was not in this camp, and we projected 2 to 3. We stand by this view, although 0 or 1 And even a rate increase could also be in the cards. Ron, I'm pleased to say, is with us now for more. Ron, wonderful to catch up with you, sir. I remember our conversation at the start of the year. The market was at something like 7, and you were talking to us about how bonkers that call actually was. You also said something interesting about coming out of this investment banking recession, so maybe we should start the conversation there. Do you believe that over the last 3 months you've seen more evidence of that? We're coming out of the other side.
For sure. As I said in Davos, though, I said that 24 would be a transition year, and I stand by that as well. But in our first quarter, we had our best capital raising for equities that we've had since the end of 2021. So certainly the market is improving, and we say that, but it's not a hockey stick.
How sustainable do you think the bounce is in deal making, in M&A, given that seemingly, apparently, with this government, with this regulator, you can't get a Tapestry Capri deal done? How are we going to get deals done in America in 24?
Well, that's the regulatory aspect is for sure something that deal makers are concerned about. I know the boards that I talk to, a risk factor, which is higher than it ever has been, is the risk of a transaction being held up in whatever agency decides to hold it up, justice, EPA, you name it. But that said, the environment is improving for advisory M&A, strategic. There's a lot to do, a lot of things that companies are going to do, and I think the environment is improving.
The market is not the economy. And when we talk about the idea of the environment improving, it raises a question, does that suggest the economy is accelerating, or just simply that people have more conviction of where we're heading?
I would say the latter, that there's just more conviction. Certainly, when in the last year and a half, when you have the Fed aggressively raising rates and the uncertainty with that doesn't help. That doesn't help. And today, at least, rates are stable, if not, projected to go down. We're not, I haven't been thinking the Fed's going to pivot fast since the beginning of the year. But the environment has a little more certainty than it did even a year ago.
We're looking through this data, and it was confusing for us a little bit because we felt like the GDP number was expected to come in hotter, which would cohere with this idea of stickier price pressure that we could see in some of the PCE, the price index data that we also got. Davos claims also coming in lower than expected. How much does this sort of cohere with what you're seeing among your own clientele, that price pressure still is the main pressure for them, and a lot of small businesses still are just hiring as many people as they can?
Well, for sure. I don't think the GDP report today was that meaningful one way or another. I think that the fact that we believe inflation is going to prove more sticky than it has, sticky for us would be that the Fed's preferred measure, which is core PCE, it may settle at 2.5 versus 2, and the Fed's not. I don't see why the Fed would be, rushing to be cutting rates into an environment where inflation is still sticky. That was true 3 months ago. It's true today.
If that's the case, what does this mean for regional banks and, frankly, all banks that are basically having to pay their depositors that much more to keep them in place, but longer term? When you look at those rates, they're below. You still see that inverted yield curve. At what point does that become punitive in a way that restricts business?
Well, I don't think an inverted yield curve is beneficial for banks for the reasons you just said. You're paying the highest relative to the curve for your short-term deposits. And the market is adjusting for loan demand, and the banks are adjusting to a higher rate environment. Overall, though, I believe loan demand is going to improve, and I think that over time, the yield curve will become certainly flat, if not somewhat inverted as we move into next year. And that's good for the banks.
A lot of uncertainties out there, pace of race cuts, there's geopolitical risks. Everyone's talking about this idea that maybe people are staying on the sidelines ahead of the election. When it comes to deal making, what are you seeing in the deal making space? Can we see a proper rebound?
Again, I think so. There are a lot of uncertainties. All that you just said, a lot will be resolved this year, beginning with the uncertainty in the U.S. presidential election. That which way that goes will certainly, I think its arguments would be on a Republican win would free up some of the regulatory burdens surrounding M&A today. And that we saw it in 2016, certainly with the banks. And I think you could see it again if that would happen. But there's no, I'm not making a presidential election. I'm just saying that the market, that uncertainty is weighing on the market a little bit.
But is that really correct? Because we heard from Senator J.D. Vance and a few other Republicans who actually praised the FTC's Lena Khan for how tough she's been when it comes to antitrust. And he's an individual that's on the former president's shortlist to be VP. So do you actually think we can see a change in regulation if we see a change at the White House?
Well, I think some of the praise, I might be wrong here, but some of the praise is surrounding big tech and the privacy and a lot of the, I think that's almost bipartisan. It's a popular thing to pile onto big tech today. So certainly, though, I wouldn't think that J.D. Vance would be saying that regional banks shouldn't be able to combine. I don't believe that at all. Maybe I'll have to call it.
Ron, just quickly, I want to ask this question directly of you. Did you release all your staff from non-competes this week? Did you listen to the regulator?
We don't have non-competes. You work at Stifel because you want to. If we do have anything, we have deferred comp that you have to do certain things to continue to vest. But one of them is that you can compete. That's the American way. So we didn't release people, so to speak, from non-competes.
Love that. Deferred comp's an even bigger trap, and we both know that. Ron, it's good to see you.
We do.
Try to catch up. Steve was Ron Koszewski there on non-competes, deal making, and investment banking in America.
Did you see Matt Levine's column?
What did he say?
It was great. He was talking about, the big question is, if you have no non-competes, does that mean no gardening leave? And that's what people really care about, which is basically a paid 6 months vacation, because they do have non-disclosure, as well as, of course, deferred compensation.
Deferred compensation, that's the trap. That's like, you know.
The golden handcuffs.
Oh, without a doubt. Without a doubt. Equities right now, session lows down by 1.2%. Coming up tomorrow, Dan Ives of Wedbush, Mohit Mittal of PIMCO, Emily Rowland of John Hancock, and JP Morgan's Bruce Kasman. The data, GDP, a bit softer, PCE, a bit firmer, jobless claims a little bit lower. Put it all together, equities down, yields up.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm gonna get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
I think I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time, surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
From New York City, for our viewers worldwide, very good morning, I'm Menace Cranny. These stock markets, they're just debating the field of dreams that is tech. $185 billion was wiped off the value of Meta in the past 18 hours. Is that a new message? We'll count it down right the way through to the open. We're 30 minutes away. Show. Big tech under pressure. This as the Meta earnings disappoint. Bond yields spike. Higher on signs of sticky inflation and the US GDP delivering a downside surprise. Let me set the stage with the big issue. Growing concerns over big tech's outlook.
Earnings have been great. Actually, I mean, not just for big tech, but also for, across the S&P 500, 80% of companies are beaten. All sectors are running, well ahead of expectations. The problem's the guidance. That helped with Tesla and it's hurt with Meta. I think there's a message in there. It tells us that investors are nervous. It tells us maybe there's more macro uncertainty out there.
Well, let's get right into those results. Meta is the only stock that we've been talking about, but there are more issues in tech to deal with. Mandeep Singh is with me from Bloomberg Intelligence. So Zuckerberg chastised those investors who aren't smart enough to keep up with his capex.
Well, so he talked about a multi-year investment cycle, and I think that's where the comments were not very clear. What is he talking about? I mean, clearly the AI investments are working. It's showing up in the product. It's driving a lot of engagement and user growth. And in the end, the fact that they keep investing in Reality Labs, I mean, look, it may pay off, 5-10 years down the line, but nobody can see the payoff in the near term. And that's why I think you see such a strong reaction, because other than that, the print was great. I think the company is firing on all cylinders. The era of efficiency probably has passed. That's why you're not going to see that kind of margin expansion again. But look, they still have a phenomenal core business that generates a lot of cash. It's about what do they do with that cash. And right now they are investing in a lot of things. Some of it is good, appreciated by the market, and some of it is not.
And this is what Nancy Tengler had said to us this morning, which was he hadn't learned his lesson. Last year he cleaned up, cut down, refined the message, convinced shareholders about buybacks and dividends. As we cast forward, perhaps the case is multiplying for Microsoft a little bit more assuredly relative to Meta on the AI front.
I would agree. And look, Microsoft, the way they are deploying AI, it's reflected in their cloud numbers. We are probably going to see that tonight, at 5 to 6% growth or even more. Copilots. And in the end, there's so much opportunity with AI that why would you want to be distracted with VR, AR when you have so much to do on the AI front? And maybe, as I said, the payoff could be in the long term, but near term, you're going to see that with both Microsoft and Alphabet. They're emphasizing their cloud business and the AI agents and, the ad side of it that they are deploying within their businesses.
Well, certainly tech is the field of dreams that a few were shouted on today. Mandeep, thank you very much. Let's continue the conversation. My guest this morning is BlackRock's Jean Boivin. Jean, it just wasn't supposed to be this way. The profits, amazing. The revenue, very, very strong. But the market heard from Zuckerberg yesterday, and this is what the market worries about in a higher for longer world. Spending too much on CapEx in a higher for longer world in a growth stock. It's just not convincing, is it?
Well, I think, we've been saying this year, pushing this year, thinking it would be a story of two parts. And at the beginning of the year, we had a very powerful kind of, narrative, hope that we were going back to the good old world of the pre-pandemic with rates that would be ultimately falling to low levels. I think that has been recalibrating clearly over the last few weeks for many reasons. Of course, don't have to go into all the details here, but I think this is the broader story. And then this information flow comes from companies' earnings and so on, and I think they're looked at now through a different lens. And it's a lens that, as you say, is probably one that we're adjusting to higher for longer. That said, we believe these mega forces like AI will be powering returns, and we're bullish on that. But it's the connection between that on the one end and this macro story that is evolving.
I mean, we're showing that very quote that you talk about, the year of two halves, supporting risk appetite. Resurgent inflation would come into view and disrupt that sentiment. That was something that was supposed to happen later in the year. You've just had the GDP and the inflation narrative in there. Underlying inflation 3.7%. That wasn't really what the market wanted to hear. Yields are spiking on that. Is the stickier and higher inflation something that you're having to deal with, which will dislocate risk appetite earlier than you had anticipated?
So the whole story of two parts was predicated on the fact that we thought there was some disconnect between the market hopes of everything is now getting into place in macro disinflation and what we thought was reality. We've been saying and believing that inflation would be bouncing back and ultimately, going into 2025, be more around closer to 3 than 2%. I think this is we've always been. Timing this is very difficult. Yeah. We thought there will need to be some accumulation of evidence for that to disrupt the market conviction. And, the central banks in particular, and I would say the Fed even more particularly, has been really underwriting this market narrative since December. So you needed that to change before you would see some sign of the market needing to adjust. But I think that has now accumulated more and maybe a bit quicker than we would have expected. And the Fed has changed much more radically, I guess, from December to March than maybe you would have expected. So, yes, I think this is a bit sooner than we would have expected.
And we are anticipating perhaps even more of a hawkish pivot, according to Bloomberg Economics, next week to undo some of that bullish, louse pivot that we had in December from Powell. Let's just return to the one alpha in the market this morning, which is about tech. It's about the expectation for Microsoft and Alphabet later on today. You went overweight AI, the winners and the enablers. As you look at the differentiation that's being struck now in Mag 7, which is Elon was believed, Zuckerberg was challenged, to Microsoft this evening, which is about a much clearer pathway to monetization earlier than the others, yes?
So I think the AI thematic, as you're saying, which as I said, we're bullish, and we think that, the world is bullish about that. The question is, where exactly will the profit be generated? And I think this is something we will need to continue to evolve and think about. But I do think that, there's some signs, and, all of these earnings over the last week have not been received the same way. We've seen pretty good numbers. But I think it's also interesting to see in some cases it's the intention to invest in the AI space that has been driving the story. So I think this is not simply just like AI. Any company in that space will work. I think there's more differentiation that is coming true now.
Yeah, it is about the nuances. I'm curious to know whether you're closer to a pivot away from U.S. equities. You say that you are overweight U.S. stocks. That makes perfect sense. You look at that GDP number this morning and the PMIs earlier on in the week, and we may have to caveat that. I just wonder, is that bringing forward the possibility of a pivot? You say the next 6 to 12 months, you're tactically long in the U.S., but you're ready to pivot. What provokes the pivot?
Yeah, I think this is about how a big part has evolved, right? So it was about when will the market narrative, the hopeful market narrative around everything is falling into place, would be challenged. I think we've seen that being challenged now. And the other piece is earnings. Earnings, on the other hand, right, this year have been very strong and continue to support the market. So we've been approaching now this earnings season thinking about the bar being higher for earnings to maintain the bullish stance. So we're early in the season still. Some key numbers are coming out, but I think this is going to be key to whether we pivot, because the growth piece, the macro environment has evolved in a way that is more challenging. So now the question that remains to be answered is on the earnings front and whether it sets the bar high enough to offset the more challenging growth environment. So that's what we're watching right now.
Two-year yields have just gone above 5%. They weren't quite that generous when the auction was there just the other day. So we're seeing a little bit more fluidity come into the very, very short end of the curve. We saw the 5s go by nicely. Well, a little bit of a cheapening yesterday, and the 7s will come today. So it is going according to plan. My question to you is similar to others. Term premium, it's not as rich now as it was in the back end of the autumn. Is it approaching levels that are acceptable to you to take sovereign risk at 5% on 2s and 4.7% on 10s? Is the term premium sufficient, or does it need to be enhanced?
So I would separate here along the horizon. So on a tactical basis, on a tactical horizon, I think the volatility is extreme. We've been going like up and down, like I've rarely seen over the last few decades, right? So the response of rates or of yields to incoming macro data has been sustained at a level like we haven't seen. So that is makes I think making bets on yields I think more risky in this environment, and as a result we're neutral on a tactical basis. You know, no high conviction. Can you go higher or lower from here over the next 2-3 months? I think this is.
So we've just lost Jean.
Further out, like on a, you know.
Sorry, Jean, we just lost your sign there for a moment. It was the drama at the end is what we missed. Just finish your statement again for us there. Sorry about that.
I was saying that like that was about the more near-term horizon. If you look beyond like over the next couple of years, we do think that long-term rates, 10-year yield will be closer to 5 than 4. So it's moving in that direction. We're still underweight, so I think that's somewhat more to go before we find that like a buying opportunity. But it's moving in that direction.
Jean, thank you very much. Well, one thing the traders at the moment, they've pushed back their timing for the first rate cut, Jean, to December. So incrementally, we're moving closer to that narrative of potentially no rate cuts this year. Did somebody say stagflation? Joining me now to take a look at the stocks ahead of the opening bell, Abigail Doolittle. Abby.
Well, we have to start out with Meta, and these shares are absolutely plunging, heading to the worst day in at least a year, with the stock set to lose $175 billion worth of market cap. This, of course, after they put up a great quarter, but the growth is not going to continue. The revenue guide in particular, disappointing. Plus, the talk of spending, as you've been talking about, on AI, a bit worrying. Now, after the bell, we, of course, have Alphabet and Microsoft. So Meta Platforms has now set up somewhat of a difficult road for these two companies. I would argue, though, that Meta up 130% into yesterday, a little bit of more of a high bar than either of these two companies. Nonetheless, down. Alphabet, a lot of look will be on their declining revenues plus AI. Microsoft Azure, the cloud component, it's expected to grow 28%. But we do have one bright spot, at least one bright spot. American Airlines up nearly 3%. They missed in the quarter, but their earnings guide is better than the street, and that has to do with solid summer demand, Manus.
Okay, Abby, thank you very much. Well, we just had the data. Coming up, the U.S. economy shows signs it may be slowing.
This is not a worrying report for the Fed. That is telling the Fed that those interest rate increases may be having some effect in slowing demand, particularly for goods, but it's not alarming by any means.
Don't be alarmed. Stand easy. Give you a snapshot of the rates market. You're showing an acceleration in the sell-off. Yields up 7 basis points on 10-year government bonds. This as the underlying inflation level comes in at 3.7%. And the rates market has pushed it back. No rate cut in the U.S. until December 2024, right now on Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
This is not a worrying report for the Fed. It's a report that says the economy continues to expand at a solid pace. Look at the consumption growth at about 2.5%. This is a healthy consumer that is backed up by the claims data, where unemployment claims are low and job growth remains strong when you look at the payroll data.
Well, yields are spiky this morning after that GDP data. The 1.6% growth figure shows a significant economic slowdown in the first quarter amid persistent inflation pressures. And maybe it's the inflation pressures, Mike Nikki, that this market is more irked by than perhaps the GDP number in of itself. Good morning.
Good morning, and my apologies for shrinking the markets and sending bond yields higher.
It's all you.
Not really my fault, but anyway, yes, we got a disappointing GDP number. It's not as bad under the hood as it appears. 1.6%, certainly lower than last quarter and lower than anticipated. Consumer spending a big part of that, 2.5% instead of the 3.3% last time, although 2.5% is still reasonably strong. Business investment hung in there. It was inventories that did a lot of the damage, a much smaller inventory build than expected. Also, we had far fewer exports than expected, so net trade subtracted, and government spending, federal government spending, fell for the first time since last June, which may be because Congress pushed off the Ukraine-Israel military spend. We'll see if that shows up in this quarter. Jobless claims, as Lorena Ricci was just saying, surprising to the downside, 207,000 after a string of 212s. And so it looks like the labor market is still strong enough, and companies, even if they didn't have a great quarter, are not laying people off yet. That's going to make a big difference. Looking forward, well, let me just throw in, of course, as you mentioned, we had strong inflation numbers, 3.7% on the PCE quarterly core. Now, is that because it was revised in January and February, or because we're going to get a strong March print tomorrow? Right now, the forecast isn't for a particularly strong print. The headline is expected to rise, but the core is expected to go down. If it's because March was a lot stronger than expected, you could expect a big market reaction tomorrow. Incomes and spending, interesting that GDP was so weak for spending. We'll see if that 6/10 forecast holds up. And remember, this is all about the Fed. And the last comments we had from Jay Powell before the blackout basically said, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. And the numbers we got today, with higher inflation and still strong labor markets, guide them to do nothing next week. And as you mentioned, we have now seen the rates markets push out the first Fed rate cut to December.
Well, the bond market is, those two-year paper is up over 5%. Mike, thank you very much. A very clear, objective view of the data. Vishy Trapatur is at Morgan Stanley. The short end of the bond market is not happy with this data. The long end of the bond market is not happy with this data. How do you interpret the pip higher in inflation and the drop in growth? Good morning.
Good morning very much. I think the bond market is reacting a lot more to the upside surprise in the inflation front rather than the downside surprise in growth. I mean, if you look at the growth numbers there, if the growth is, if you take away the effect of the stronger imports and the somewhat slowing down of the government expenditure and the inventory drag, the overall GDP growth picture is not that bad.
Okay.
It is showing deceleration, but what's more worrying for the markets is any sign of acceleration in inflation is worrying to the market, and that's what the market is reacting to.
I'm just looking here at the blog that we're running, which is the speed up in inflation is all about the services component. That rose at 5.4%, the fastest run up in the first quarter since last year. And that's what will immobilize the Fed, I think, to use your language. How immobilized or paralyzed is the Fed? Because the market has now decided that we're down to one cut in December. So let's just sort of have a truth and reconciliation moment. That's virtually no cuts for 2024, isn't it? It's a matter of time before we get there.
So our economists at the moment still have a base case of 3 cuts, which will be in line with what the Fed's dot plot suggests. But our economists did raise the point that any signs of reacceleration in inflation would make them rethink their view. So I mean, we have been highlighting for some time that the risk of fewer cuts that arrive later is certainly a scenario that we have thought a lot about, and the source of that risk showing up is services inflation. And if services inflation, in particular shelter, and if we see upside surprises, if we continue to see upside surprises related to services driven mainly by shelter, that's something that we will have to rethink.
Look, part of the narrative as well, Bloomberg Economics, some great pieces this morning, talks about the pivot in December time that Powell delivered is responsible for a great deal of where we are now. And this is what they put forward as their thesis. Powell's pivot reversed much of the disinflation progress made in the second half of 2023, according to their model. It's boosted CPI by 0.5 percentage points so far this year, relative to a pivotless path, would therefore put the onus on Powell, because you don't get any new projections next week, to have a materially hawkish pivot. Well, to catch up with the market, he needs to, doesn't he?
I think it's a tough job. I think communication from the Fed chair are going to be pretty challenging, and I would not underestimate the challenge, difficulty associated with communicating that we need growth to decelerate, and we need the path of deceleration and inflation to continue, and the data dependency on how monetary policy evolves. I expect that to be the point that the chair will reiterate, the data dependency. And there is a considerable, let us not forget, there is an enormous amount of uncertainty for the ahead of us. So I wouldn't pile on the Fed chair given the amount of uncertainty that is there.
I mean, it would be quite shocking if we did have sort of a vault face, but then if everybody was surprised in December time when we got such a dovish pivot. I'm curious to know what Morgan Stanley thinks is the biggest tail risk as we square away lack of rate cuts going from 7 to 3 to 2 to 1. But the IMF warned on energy prices. I know the war premium is dissipating now. What's your biggest tail risk?
I think reacceleration in inflation would be a significant tail risk. This is not our base case. Our base case is that we will see a gradual decline in the pace of inflation over the course of the year, especially shelter inflation. But our tail risk scenario is here. If we see significant reacceleration of inflation, that upsets a lot of the assumptions that we make. So I think from the markets, generally speaking, I think the markets, especially the credit markets, can handle fewer cuts that arrive later. Where the market's biggest challenge would be is if the next move is not a cut. And then if the next move is actually a hike, that would be very challenging outcome for the market. But we think that the bar for the next move to be a hike is still very, very high.
Okay, Vishy, thank you very much. Vishy Tropiteur, they're my guest this morning on the markets. Coming up, your morning calls. Meta disappoints, raising the stakes for Microsoft and Alphabet. The results. We'll have Mark Lehman with me from Citizens JMP Securities next.
This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning calls for you. First up, Bank of America downgrades DECAs to neutral, citing margin valuation concerns. Next up, Wells Fargo upgrades 5 below to overweight, highlighting compelling risk reward. And finally, Truist's downgrades Monster Beverage to a sell from a buy, seeing limited catalysts on the horizon. Now, if you've been hiding under a rock, you may well not have noticed that big tech is in focus, as well as rising yields. I mean, there is only one stock to talk about. It is Meta and the annihilation of equity shareholder value. We'll talk about that with Mark Lehman next.
Biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Your fixed income fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
These equity markets are stirred. You've got big tech under pressure, Meta really under pressure on their CapEx spend. That was the one punch. The two punch is the spike in yields. 2-year paper is above 5%. So you are looking at a real challenge to the growth narrative and indeed to the breadth narrative as we see these markets push rate cuts in the United States of America out to December of this year. This is what we've got for you in terms of the rest of the assets. You've got a stronger dollar on the back of the spike in rates. The euro is down by 1/10 of 1% at 106.88. The dollar is strong across the board. Rates are now really propelling higher, up 8 bips at the moment as the market reassesses on the back of the stronger underlying inflation in the United States of America, 3.7%. So whilst people are trying to explain this away, the slowdown and the spike in inflation, it is irking the bond market. Oil is up 0.3 of 1%. That just reflects back on crude inventories, which declined the most since January. That was late yesterday afternoon. We're talking about the concentration in tech, and that revolves around Meta. Delivering disappointing outlook, the plans to spend billions of AI on AI. Ed Ludlow is with me. I mean, the profits and the revenue were enviable, but this is about belief in the guidance of the dream of the founder. Good morning, Ed Ludlow.
That is a perfect summation. You know, Mark Zuckerberg says Meta can be the world's leading AI company. And the bit that the investor base didn't like was almost the roadmap to get there. Not necessarily the idea that the range for expenses for the full year was slightly raised at the bottom end of the range. Not that CapEx has been boosted to 40 billion at the top end. It was the explanation of how long that infrastructure investment to support AI model development is going to show up in what Facebook, Meta already does, the family of apps. They're still principally an advertising company. And he got peppered with questions on the call about product cycle. So typically, if you think about the Facebook platform, WhatsApp app, the hardware business, they run 2-year product cycles, where after 2 years, you can clearly see that product showing up in revenue. But this is a direct quote from Mark Zuckerberg. The smart investor, which was a bit of a dig at the investor base. For those of you watching, reach out to me. I'd love to hear your thoughts. The smart investor will not only see the scaling of the product and they'll see the monetizable opportunity and the revenue come. The stock's down more than 15%. That puts it on track for its biggest drop since October of 2022. And it's that roadmap or product cycle that the market just doesn't believe in. And you see a number of sell-siders have cut their price targets, partly because they also wanted everything right. They wanted to see prudence. Expenses are going up, headcount's growing, and they're all in on AI.
Well, that's two CEOs that are chiding their investor base. One is, if you don't believe in my robo-taxis, get off my investor base. And the second one is, you know, very much very disingenuous. There's some smart investors. Sometimes you need those big investors You can find that, Ed, as you go through the cycle of life. I'll leave you with that thought. We got Meta down 15% at the open, the biggest drop since October 2022. We'll continue on the earnings numbers. We've got a nice beat coming through from Ford, the automaker, boosted by demand for, you got it, that big old truck. Abby.
And this is an interesting one, Manus, because this stock has been flipping around in the pre-market, but it is now up more than 1%, heading to a 6th up day in a row, the longest winning streak since December of last year. So investors choosing to go with the positive messaging out of the quarter, and they did in fact beat adjusted earnings by about 16%, revenues in flat. It did have to do with the work truck strength. On the other hand, net income fell 24%, so I think that was part of why the stock had been down, but now investors are going with revenues, even though they were about flat or a small miss, up 36%, and plus the fatter profit margins for the commercial Ford Pro unit. So we have investors very positive on the street. Citi saying encouraging outcome. The stock right now, again, up 0.9% on the morning.
Okay, Abby, thank you very much. Abigail Doolittle on the stocks and sector watch. We'll be back in just a moment. Sticking on the earnings front, it's a roller coaster day. Caterpillar results sending a note of economic caution. It's a bellwether, delivering a disappointing outlook and a warning about the second quarter on both sales and volume. Emily Grafeo is with me with the detail, down nearly 7%. The market does not like what it hears.
Yeah, it's interesting. The stock was already up 23% year to date, so perhaps the bar was higher than normal for Caterpillar. But like you said, this is one of the biggest manufacturing companies, really a bellwether for the economy here. And they did note that they see a softening economy in the Asia-Pacific ex-China region, and they also see weakness in Europe, but North America sales seem to offset the weakness in the other regions. The company did beat on EPS, coming in at $5.60. versus estimates of $5.13. The revenue was a slight miss here at $15.8 billion versus estimates of $16.12 billion. But again, the market really does seem to be punishing anything less than perfect in this earnings season. And they also said they expect second quarter sales to be lower year over year. That stock now down almost 8% after the bell, Manus.
Emily, thank you very much. Emily Grafeo there. A tale of two earnings within the transports. You've got Southwest Airlines and American Airlines, both under pressure, but different story for Royal Caribbean, boosting its outlook amid surging demand. I've never been on a cruise. Alex Hemenova, differentiate for me.
Good morning, Manus. Well, you can definitely say that there's something for the Bulls and something for the Bears in this morning's earnings results. We got to start with the downbeat readout from Southwest. The air carrier said that it's ending service in 4 airports, also offering voluntary leave to address significant challenges in 2024 and 2025. Those challenges created after Boeing again reduced the number of aircrafts that the carrier will receive this year. Southwest is now set to get just 20 Boeing 737 MAX jets, down from 46 previously. This is the 3rd reduction from Boeing, highlighting the toll that the plane maker's fallout is having on one of its leading customers. Southwest had previously been known for flying an all 737 fleet, and this came along with first quarter results that fell short of Wall Street estimates. Shares are down about 9% this morning. The stock was up 1.5% year to date heading into these results. And then on the flip side, you have Royal Caribbean seeing much brighter days. It hiked its outlook as demand for cruises surges. That also prompted them to hike up prices. Earnings per share will now be between $10.70 to $10.90. That blew past the average Wall Street estimates of about $9.99. CEO Jason Liberty said the demand continues to be very robust with bookings at all-time highs. The cruise operator will also continue to raise prices as demand surges. Shares are a little changed this morning.
Okay, Alex, thank you very much. Let's turn our attention back to tech. A little bit earlier, Danny Berger and myself caught up with Nancy Tengler of Laffer Tengler Investments on the Meta earnings.
I think you can argue that he hasn't learned his lesson. We've been here before, you know, where the CapEx for the metaverse, and now we're in AI chat box spending. Whereas I think with Microsoft, the use cases are multiplying in generative AI.
Mark Lehman of JMP Securities joins me now. Nancy was fairly direct. He hasn't learned his lesson. The year of cleaning it up in 2023 is long gone. Do you think he hasn't learned his lesson? Is there a bit of an arrogance in his presumption, I can do this CapEx and you all better pay up and listen?
It's a great question. It's the question. The question is that arrogance or is that confidence? And I think at this point with the stock down as much as it is today, the street is telling you that was a surprise. And maybe the arrogance was just assuming that, as Zuckerberg assumed, the street would take him for granted when he said he was going to slow CapEx, but just wait. You're going to want to get that reward at the end of 25 and 26. So for now, it's being punished. You've got to spend, and that investment is going to take a little bit longer, and the profits are going to take a little bit longer too.
Well, I think really what we've got, our markets are moving from pricing genius and rewarding genius at multi-levels. In Elon Musk, in Zuckerberg, etc., in founder genius to reality of delivery. But you mark down the stock, I know incrementally, your target's 525. Now, you are worried about something more fundamental, which will come through tonight. You're worried about the underlying business, the ad business. Talk me through that, because we haven't spent a lot of time on that this morning.
I think the real issue is what the ad business is going to look like and what people are going to spend for that ad business. And I think Meta is a great harbinger of the future. It tells you what the future looks like because they have so many platforms and they touch so many people. They touch 4 billion people per month across their platforms. Now, we have a big year in advertising. Obviously, we have the Olympics coming up. We have an election coming up here in the States. But the question is pricing and that price optimization that they think they will garner through AI. And I think the bears today are voting with their feet. But let's remember, stock's up a great deal year to date. It's up a lot more than the market. It's also growing almost three times as fast as the stock market is, and close to a market multiple on today's earnings. So the question is, can they perform with those earnings targets for next year? Because right now they're being much more transparent about how much investment they're going to have to make.
What I'm struggling with here is the original guidance on CapEx was 35 to 40. This year, this is the guidance. It's going to be 35 to 40 billion. Originally, that was 30 to 37 billion. Can you compute a 15% drop in Meta on the market quibbling over $3 billion?
I can. I mean, the stock, like a lot of the stock market, was priced to perfection. It was also pricing the stock when it was over 500 that there would probably be a meet and beat, and there would probably be rates that were not going to be over 5%. That was 90 days ago or 30 days ago, and a lot's changed in that short time, as we can see for the overall stock market. So things are priced to perfection, and this was by far not perfect.
And that's why there's just no room, as it were, for forgiveness. When it comes to Alphabet and Microsoft, and the narrative would be this, is that there's something much quicker and demonstrable in the AI delivery within Microsoft. They have OpenAI, they have something much more provable. Does that make Microsoft just a better alternative in this suite of AI?
It makes it a safer play. It certainly is showing the kind of fruit on the top and bottom line that investors like. Meta, I mean, look at all the last 3 quarters, how fast the stock went higher and lower. You talked about October 23. I mean, the swings in that stock for such a large, trillion-dollar company is beyond any comprehension for somebody who's done this as long as I have. But I think the people who own Microsoft know what they own. And I think when you own Facebook, you own a lot bigger beta. And that's a hard thing to swallow when markets are priced to perfection.
Well, if we're priced to perfection, I look at WPP in the United Kingdom this morning talking about advertising revenues in big tech being down by 8%. That is an inauspicious background to seeing these Alphabet numbers tonight. It is going to be about core search, and it is going to be about certainly a heavy dose of AI. But WPP does not beckon a great curtain raiser, does it?
No, and listen, I think the thing that you have to look at when you see the Google numbers is what are they doing to make sure that they stay at the top of the game going forward. I think you're going to see numbers that probably are fine for what you saw in the rearview mirror, but their commentary on the future and how they're investing for the future, I think, is really crucial because they have so many eyeballs and so many advertisers, and they see so much. And I think to date, there's been more worry than excitement about that future. But again, they are a great demonstrator of what the market looks like. I think the overall market got very frothy, obviously, at the end of last year and the beginning of this year with such big promise for AI. That promise, I mean, we're seeing it inside Citizens every day. That promise is real. What it translated into earnings is the real question mark for the market. And today they're telling you it's not as soon as we thought.
Let's just round off with Reddit. Phenomenal community, great IPO. I'm just wondering, you know, in rising markets, everybody wants to know a mountain of information. But it's really in falling markets that typically the higher volume goes through on a lot of these, you know, leveraged exchanges. It's in collapsing markets probably that people want more information. Talk me through your analysis of Reddit as we close off here.
So, as you know, went public recently last quarter. Fortunately, Citizens JMP was part of that story. You know, our analyst Andrew Boone sees 20% growth pretty much visible in the next few months and quarters and years. And I think the market is questioning whether they can do that. Largely investment spending has already taken place. And they have a very, very active, loyal fan base and group of people who every day are part of that community. If they can bring those loyalists down to the bottom line, and we think they can, that stock's going to be a lot higher, and it's kind of getting closer to its IPO price. But if they show that kind of visibility on earnings and growth, we think the stock's going to be very attractive here.
Okay, all eyes down on that. Mark, thank you very much, Mark Lehman there. I just want to bring you some reaction from the White House on the GDP numbers. Obviously, GDP lower than estimated in the first quarter at 1.6%, the lowest in 2 years, and that spike in inflation. And this is what President Biden is saying today. The economy remains strong. It continued steady and stable growth, but he adds this, that more work needs to be done. We have more work to do. Costs are too high for working families, and I'm fighting to lower those. So this is a very first reaction, obviously, because the markets are convulsing. They're moving rate cuts out to December at the end of the year. Yields are higher. Stocks are lower. It's a double punch for stocks from Meta and the GDP and the inflation data. Coming up, European bank earnings, they continue to roll in.
We try to work within the rules and regulations that apply to us to be competitive on compensation, to be an attractive employer across a whole range of considerations.
You got it. Banking bonuses, they're in focus. That conversation next on Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show. This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
People
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
We operate, obviously, in globally competitive markets, and anywhere where regulation, by the way, for us, it applies globally, the European regulation. And so it can put us at a competitive disadvantage. You know, we try to work within the rules and regulations that apply to us to be competitive on compensation, be an attractive employer across a whole range of considerations. But it's certainly a concern when regulations in the U.S. and the U.K., where we are active in a number of our businesses, you know, start to move in a way that places European competitors at disadvantage.
It's that magical word. It is all about banker bonus and compensation in focus. That was Deutsche Bank's CFO saying that the UK's decision to scrap the cap on bankers' bonuses could put the firm at a disadvantage when it's hiring. Now, those comments come after the bank's trading revenue rose more than expected and beat most of the biggest names on Wall Street. Tom Metcalf is with me now. So, two probably zeitgeist words, one for the shareholders. Let's start with that, which is buybacks, because Von Moltke talks about kicking off talks again with the regulator on buybacks. The stock's up 8%, Tom.
Yeah, and a complete reversal from earlier in the day before he made these comments where, you know, we were scratching our heads a bit looking at Deutsche Bank shares going down despite that outperformance by their bond traders. But goes to show sort of just what's on top of investors' minds, right? Like, you know, as soon as the word buybacks mentioned, the fact that Deutsche Bank is at least going down this process, albeit one that needs regulatory approval. I mean, look at that share price, right? Up more than 7%, and now it's overhauled Barclays, which previously was the best performing bank.
Well, I think, you know, here's another way to frame it, which is you look at UBS perhaps facing a monumental hike in capital requirements from the regulator. That's what we heard last week. Motti and Kelleher have always been about the dividend and the buyback. It's been the holy grail within UBS. And here we are. Maybe my return on equity and my dividend and my buyback story is pivoting at Deutsche Bank on a relative sense to UBS. Just food for thought. Talk to me about bonuses, because suddenly London could be the attractive destination. I mean, they did adjust the comp in London when the bonus cap came in, which was higher regular comp to smaller bonus, but looks as if that has been upended.
Yeah, exactly. So the UK government here, one of sort of these post-Brexit dividends they love to tout, has now basically told banks, look, we no longer need to see that 2-to-1 cap that is still in place across the EU. And for a bank like Deutsche Bank, even though they've got a massive London operation, they still have to adhere to the EU cap, where basically your bonus can only be twice fixed pay. So it's really interesting to hear the CFO speak on those things, because, you know, a lot of executives on the other side of the coin, the British lenders, have said, oh, you know, it's almost too late now. We've kind of established this other system. Do we really want to go back and reverse it? But now they are starting to go down that path. And to hear an executive at a rival bank saying, hey, we're looking over our shoulders at this and wondering, could this be like a key sort of differentiator in that, you know, race for the top talent? It just goes to show that it's sometimes those regulatory shifts that can make all the difference.
Maybe the top talent has decided to go to Dubai. Tom, thank you very much. Tom Metcalf there. There's no income tax there at all for Europeans or Brits. Sector price action for you. Let's get to Abigail Doolittle.
Well, we are looking at a decline for the S&P 500 right now of 1.4%, largely having to do with that Meta sell-off. Making the day a little bit more risk-off is the one sector that's higher. That is consumer staples. That's a defensive sector. So the fact that you have investors leaning toward the PepsiCos, the Procter & Gamble's, and the Walmarts of the world, again, makes this day a little bit more defensive, risk-off. You can see 10 of the 11 S&P 500 sectors are lower. Clearly, it's those mega-cap tech sectors that are down the most. In fact, we at this point have 6 sectors down more more than 1%. But the communication services, and yes, that is home to Meta, down 6%, at one point down close to 7%, the worst day at that point in more than 2 years. Right now, the worst day since October of last year. This week, right now, we have this sector also heading to its worst week of the year, Manus. And actually at this point, we have just one stock that's trading up. Nope, all stocks within the sector are trading lower, again, headed by Meta, down 14% right now.
It's quite a monster destruction in equity value, isn't it? Abigail, thank you very much. Coming up, we'll set your events for the rest of the day. Guess what? A little bit of tech will be in your trading diary on Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
It's a gut punch, whatever way you look at it. Meta's done $170 billion in market capitalization, $178 billion in the space of 2 days. That is an inauspicious backdrop to Microsoft, Alphabet coming later on today. NASDAQ down 1.69%. And if you're hoping for rate cuts this year, dream on, because right now the market is repricing one cut, and that is by December. And that is a fading glory as well. Here's your trading diary for the rest of the week. Pending home sales come in at the top of the hour. Alphabet, Microsoft report later today after the close. And finally Friday, PCE deflator and University of Michigan sentiment hit the tape. But it is about intervention watch from the Bank of Japan. They have a rate decision tomorrow. Have we traveled sufficiently far to give us the wrath of the Ministry of Finance and the Bank of Japan? Yen is down by more than 4% in the space of 2 weeks. That is enough to irk officials at the Bank of Japan. Countdown to the open. I think we talked enough about Meta. Tomorrow, a little bit more tech for you. We'll take you through those results from Microsoft and Alphabet right here on Countdown to the Open. The team take you through the rest of the trading day from New York.
Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele, she is on holiday this week. Sitting in for Alex is our very own Molly Smith from Bloomberg News. She covers all the economy for Bloomberg News, which is good because we've had a lot of economic data today, so we'll break it down with Molly and a lot of our guests. We're here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Coming up, we're going to check in with June Grasso, Bloomberg legal analyst, get the update on President Trump's immunity case that's at the Supreme Court today. That is big. Obviously, big economic news out today, moving markets. We'll check in with Vince Signorella. He's at Bloomberg. He's a macro strategist. His job is to talk to traders all over the street. We're going to sense of what's happening. Meta, big numbers last night. They're spending more money again. The revenue growth is kind of slowing. Stock doesn't like it. The stock's down 13%. We'll break it down. And then, of course, we'll check in with Ira Jersey, see what this economic data is going to mean for this Federal Reserve. But right now, let's kick everything off with Lisa Mateo and get a look at the Bloomberg Business Flash.
Oh, you got it. What a morning it is. Stock's getting crushed right now. You had the NASDAQ down more than 2%. The Dow, the S&P 500 down more than 1%. The Dow down 696 points. The NASDAQ down 323 points. This is a handful of big tech sold off. Data showed a significant economic slowdown on top of it. Want to get to the data first. So GDP increased at a 1.6 annualized rate. Personal spending, that rose as 2.5% pace. And that closely watched measure of underlying inflation, that advanced at a more than expected 3.7% pace. Jobless claims came in weaker than expected too. 207,000 applications were filed last week. And now we're getting in pending home sales for March. The survey was for 0.4%. Came in, Paul, is this right? 3.4% is the actual. So you see the increase there. Yep. As far as tech right now, we want to get over to Meta because there's a lot of talk about that. Shares are down 13%. That is pushing other tech stocks lower. We have Alphabet, that's down 4%, and we have Microsoft, that's down 4% as well. And they both report after the close, along with Intel, so we'll keep you posted there. That is your Bloomberg Business Flash. Paul and Molly.
All right, Lisa Mateo, thank you so much. We have Molly Smith sitting in for Alex Steele here today. We're in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. Molly, thanks so much for coming in again today.
2 for 2, and it looks like it's bring your kid to work day. So I don't
We're-
know. It is. We have an army outside of the studio right now. So
they're all over the place.
excuse me if I'm a little distracted with like a
Exactly.
fishbowl environment right now.
Exactly. So they're always welcome here at the Bloomberg
Yeah.
HQ here in New York. All right, a lot of stuff happening in the marketplace today. A lot of economic news. We're going to get right to it in just a moment. But there's also a lot going on at the United States Supreme Court with former President Donald Trump. June Grasso joins us here, Bloomberg legal analyst. June, can you summarize for us what's happening at the Supreme Court today? What is former President Trump and his team, what are they arguing?
So Trump is asking for absolute presidential immunity, so that he thinks that in the January 6th case for election interference, that because he was president at the time, that he deserves immunity for his actions. And you've heard him talk about this, how if I don't get immunity, what will mean for other presidents, they'll have to watch everything they do, because then when they leave office, they'll be prosecuted. They could be prosecuted. Of course, that hasn't happened in our country's history until this particular president. So that's the argument that he's going to be making, and there is no Supreme Court precedent for that. The Supreme Court has never ruled on absolute or any kind of criminal immunity process of trying Trump for criminal.
So what do you think, what are the reasonable expectations for what could happen today with the Supreme Court? Will they rule? If so, how do you think they will?
They're not going to rule today.
They're not going to rule today.
That's the problem is that these cases take months.
Okay.
For them when they don't want to. I mean, look at the Colorado case over the Colorado ballot decision. They did that really quickly. For some reason, they have delayed. They delayed taking it, deciding whether to take it, and then they put it on the last possible day of the term for oral arguments. The court is done with oral arguments after today, and they don't usually have oral arguments on Thursday. So this decision could come out the end of June, which is before they go on their summer recess, and that would really make it perhaps impossible, because they may not rule on the issue itself. They may say, we're going to send this back to the district court judge, Tanya Chutkin, and have her explore the areas where there might be some presidential immunity here.
Okay, so today is just the arguing of the case.
Yes.
Right. Well, this is, it sounds like we're just going to be going back and forth potentially, that this could really drag out beyond the election, perhaps, that as far as when we get a verdict.
This won't. The Supreme Court will have a decision by the end of June.
All right.
June 30th is, how many days are there in June?
30.
September.
Yeah, that sounds
okay,
right.
So June 30th. They rarely go past because they want to go on vacation, and usually the biggest cases of the term come down that last week of the term. And it doesn't have to be that way. They always say, well, the big cases take longer because there are more concurrences and dissents, but I just think that they hold them until the end when they leave town.
Is there a consensus within the legal community today how this court may rule?
Well, the consensus within the legal community is that they shouldn't have even taken this case, that the federal district court, you remember the question about SEAL Team 6. So they wrote a really thorough opinion. And the Supreme Court took a while to decide whether to take this. That means 4 justices decided to take this case. So the consensus is that there is no presidential immunity, but there's no consensus about how the Supreme Court might rule.
Okay. June, thank you so much for joining us here. June Grasso, Bloomberg legal analyst, joining us, talking to us about what the Supreme Court will be hearing some arguments today regarding former President Trump and his immunity. Big day in the marketplace here. Again, we got the markets moving. The S&P off 1.5%, Dow off 1.8%. Same for the Nasdaq. Slower than expected GDP growth there in the first quarter, leading to discussions about stagflation and maybe what this means for the Federal Reserve. Joining us here in our Bloomberg Interactive Broker Studios, Norma Linda, Bloomberg Equities. She covers all the equities for Bloomberg News. Nora, what are you looking at today?
Lots going on this morning. I feel like there's so many earnings every single day, but right now I'm looking at Meta. Of course, we do know that this is pretty much moving the market after those earnings came through. Meta shares are seeing their biggest drop since 2022. Now we're seeing that stock plunging as much as 16%. Investors have really been looking to a lot of these tech companies to affirm their robust expectations, but it seems as though Meta's report did pretty much the opposite. So profit and revenue were a big win for the company, but it did show slower than expected sales growth. But investors are pretty much focused on its outlook, where it revealed that it'll spend more than billions of dollars more than expected this year on AI. And of course, all eyes have really been locked on Zuckerberg. During the call, we heard from him. He's obviously still touting that Meta can be the world's greatest AI company. But of course, we do know that right now it's still more of an advertisement-based company. But during the earnings call, investors were hitting him with a bunch of questions, particularly around how long it'll take a product to show up in revenue. And that's, of course, called the product cycle. So that's where investors are a little bit apprehensive as to what the future may look like for the company.
Yeah, sounds like a lot of skepticism to me. I mean, obviously the stock, as you just said, having a pretty tough day. Let's shift over to Caterpillar. What's happening there?
Yes, watching Caterpillar, also a downward name. It's seeing its biggest one-day drop in more than 4 years, down as much as 9%. Now, its first quarter results showed sales fell from a year earlier, and it warned that the trend is set to continue into the second quarter. Of course, we don't hear investors super excited to hear this news. Its adjusted profit did beat expectations, but its overall revenues did show weakness outside of North America.
Yeah, this is something that, Chris Ciolino, who covers this stock for Bloomberg Intelligence, he's been flagging this for a couple of quarters, saying, we've seen kind of the peak earnings, at least for this cycle for the U.S. farmer. Farmer's doing well, but it's probably the peak. And then, this is a cyclical business, this big tractor and farm equipment business. So maybe this
sensitivity to rates, for sure.
Yep, exactly right.
Yeah.
So maybe they're seeing it in their business right now.
Yes. Also looking at IBM. That's down as well. It's seeing its worst days since 2021. Those shares are plunging as much as 9.5% in trading this morning. The company did confirm its acquisition of the software firm HashiCorp, but it sees weak demand for its consulting unit, and that's caused shares to tumble as investors are losing a bit of faith.
Yep. All right, so we got, again, there's tons of earnings. There's a million places we could go with you today, Nora. What else you got on the earnings front? I'm just, my headlines on the Bloomberg terminal is just kind of overwhelming with all the companies reporting numbers. So what else are you looking at?
I mean, on the flip side, I did want to look at a positive name. We're looking at Keurig Dr. Pepper. That's ticker KDP. Those shares are up as much as 6.6%, seeing their best day since October.
Really?
Now pairing a bit, but this is coming after the company reported first quarter results that beat expectations, as well as affirming its full year forecast. And essentially, they're touting the company's coffee business as a highlight.
Oh, what do you know? I mean, I can't say that I'm helping. I've actually never had a cup of coffee in my life.
Ever? No way.
In your
Naturally
life?
hype.
No way.
Yeah. So look at that. KDP, they don't need me. They're doing great.
Wow.
They don't need me.
I need to know the reason.
I'm a big fan of Dr. Pepper, although it's...
Yeah.
I just don't
Is
get
it
it
that
a
cherry
lot.
flavor that
It's
people
a
are
little
into?
different. Yeah, I don't know what it's all about, but it's a Texas thing. I mean, like...
Oh, okay.
It's
Oh,
originally...
I'm thinking of Dr. Brown's. That's the cherry thing. Okay. Different doctor.
Yep.
Okay.
All right, so very good. Norma Linda, thanks so much for joining us. Norma Linda, she covers all the equity markets for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. Again, markets on the move. The S&P off 1.4%, the NASDAQ off 1.7%. We want to get a sense of what's happening here in the markets. We got the 2-year Treasury right at 5% here. We got a lot of movement in the markets. Let's check in with Vince Signorella, Bloomberg Market Strategist here. Hey, Vince, kind of real, I guess, concerning or certainly on an off-mark GDP print here has kind of got the markets a little bit rattled. What are you hearing out there?
Yeah, a couple of things. Speaking on a little bit of a more positive note, what we've seen is over the last 20 years, 17 out of 20 times GDP for the first quarter's missed estimates. And generally speaking, it comes back later on and it gets revised higher. There are a lot of seasonal factors with the first quarter that kind of screw with it. So what economists I'm talking to this morning are telling me, don't put a pin in the stagflation story just yet. Let's wait to see what the revisions for the first quarter will be, and their expectation is it will be bumped up. Now, how far up is another story, but we'll wait to see that. As far as the inflation numbers, we'll get a better read on that tomorrow with PCE, but so far it's not looking very good. And I think realistically, when you look at the overall debt in the United States, and Jamie Dimon's been pounding this, on the desk for a long time, and I think he's really right on this one. With $35 trillion in overall debt, looking at inflation down the road, this is going to remain sticky. And I've been saying this for about a month or so. The odds of a rate cut this year are probably zero. And it's getting more and more likely that we see a hawkish pivot come 2025, and we don't see any rate cuts at all.
Well, wouldn't that really throw us all for a loop? Remember how long ago was it when investors were pricing in 7 rate cuts this year?
Yeah, just the beginning of the year.
Yeah, wasn't that fun? Yeah, how things have changed, right? I mean, it looks like, obviously, Vince, the market reaction today is really all about that inflation print. But I'm wondering if you're hearing from your context, because this is what I'm getting from the economist side of things. So I wonder if traders are focusing on this too, that the headline GDP figure, obviously much softer than expected, but perhaps a bit misleading, that there are other measures of underlying growth within this report that actually came in quite strongly, and perhaps that's really telling more the story of growth right now.
Yeah, well, I think one of the biggest, there are 2 negatives that came into this print, which is inventories and government spending.
And again, trade, had a third.
And trade.
Yeah.
All of those seasonal factors, which, as the economists are telling me, don't marry yourself to a bad GDP print. This could be revised higher. And I think down the road, that's what's more likely to see. We also get UMich sentiment numbers tomorrow, which could be very telling. To see where the consumer's head is at in terms of future spending and future inflation expectations. So while I'm usually more interested in hard data like what we've seen, this is a little backward looking. Sentiment does sometimes carry the day, and that's going to be an interesting number to look at tomorrow.
So, Vince, I mean, the 2-year Treasury at 5%, that gets my attention here. The real yield, well north of 2%, that gets my attention. So is the bond market telling us, hey, not only are there no rate cuts this year, there might be a rate increase?
I think what the bond market is telling us is there won't be rate cuts this year. I don't know about an increase necessarily. That'll depend on growth and jobs growth going forward. But inflation numbers we had Powell, the 2 FOMCs ago basically saying, let's write off January and February. That's just the seasonal number. And then March comes in hotter than expected, and he does an about face, which hit markets. Now we're waiting on April, and if April comes in, hotter than expected as well, all bets are off. You can't be looking back and saying these are seasonal data when you get 4 months in a row showing higher than expected inflation. We had a trend lower in the second half of last year, but the first half of this year, at least so far, first quarter is reversing all of that and suggesting we've hit a bottom in inflation. And unless we see a turn, you're not going to see a Fed cut rates with strong growth, strong jobs growth, and sticky to higher inflation. It just doesn't happen. And I just don't see it happening unless things turn markedly in the next few months.
Well, even just speaking in the next week, we've got the Fed meeting coming up next week. I mean, what do you think Jay Powell's doing in his chair right now, just shaking his head and maybe looking at what that press statement's going to say?
I bet he's got the old whiteout and erasers out and scratching out.
I might too.
What he was originally hoping to say, and having to actually acknowledge that the economy appears to be slowing, at least from the data today, and that inflation remains sticky, and that unfortunately the Federal Reserve is not going to, or has not yet seen sufficient data to suggest that there warrants a rate cut, and that they're going to need more information. I think he'll sort of try to walk that middle line, not write off rate cuts altogether, but just tend to walk the line that says we need more information. And I think that is exactly what they need to see. And so far, they're just not seeing it.
Well, yeah, just quickly here, Vince. I mean, what do you think is the most hawkish thing that Jay can say next week?
Oh, gosh. I think the most hawkish thing he could say is that the way we're seeing inflation, and that if we see an April print, once again hotter, which we'll wait to see tomorrow, I think the most hawkish thing he could say is that we've seen inflation print higher 4 months in a row, and the odds of a cut in 2024 seem less than realistic.
Vince Signorello, good stuff. As always, Vince Signorello, Bloomberg macro strategist, joining us via Zoom. So, Maggie, when you dig into the GDP number, what jumps out at you?
Yeah, it was, I got to say, a tough morning for me writing this story because, of course, we look at that headline figure, think, oh, gosh, 1.6, estimates for like twice that. So that's really scary. But then you look at what actually factors into GDP. You see that it was dragged down a lot by trade because imports were so much higher than exports. Business investment, not as strong as we were hoping. Consumer spending, still pretty good, but not as strong. And it's like little quirky things like inventories, things like that subtracting from growth. So there is this other measure in the report that we look at that is really what a lot of economists look to for real underlying demand. That one is still trending above 3% for 3 quarters in a row. So that is still a good sign.
All right, so we have to dig under the covers a little bit there.
Very deep.
Yeah, very deep. That's why we've got people like Molly Smith, because she does that stuff for Bloomberg News, and we're fortunate to have her here in our studio here. S&P 500 off 1.3%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got a deadly combination on Wall Street today. Reports showing economic growth has not been as good as predicted. We're not spending as much as economists thought we would, and an indication of inflation, well, that came in worse than expected. All that news has the markets really getting beat up. Right now, the Dow leading the losses, down more than 1.5% at 635 points. We have the NASDAQ down just a tick under 1.5% at 225 points, and we have the S&P 500 down 1% at 61 points. Over to the bond market, the 2-year yield at 4.99%. That's up 6 basis points. The 10-year yield at 4.71%, and that's up 7 basis points. To commodities we go. We have spot gold higher at $2,323 an ounce. And over to oil, Brent crude $87 a barrel, NYMEX crude $82 a barrel. Some deal-making news. Want to get to BHP. It made an all-share bid for Anglo American. It values a firm at $39 billion. Now, a tie-up would create the world's biggest copper miner with roughly 10% of mine supply. The question now is, will it face antitrust scrutiny? We shall see. We have BHP is down 2%, Anglo American up nearly 14%. That is your Bloomberg Business Flash. Paula Molly.
All right, Lisa Mateo, thank you so much. We appreciate that. Molly Smith is sitting in for Alex Steele today, Alex is on a holiday this week, so we appreciate Molly sparing us a couple hours here. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. One of the stocks in the news here, we're right in the thick of earnings, is Facebook. The kids call it Meta. It's down about 10% today. They put out some numbers last night after the close. Revenue a little bit slower than expected, and then they ramping up spending on artificial intelligence, and that's setting the stock back a little bit here. Let's get some perspective on Facebook, and nobody better than David Kirkpatrick. He is the founder of Techomony, and he's also the author of The Facebook Effect. In my mind, the definitive book on Facebook when it just kind of burst onto the public consciousness. David, thanks so much for joining us here. What were your takeaways from, I guess, their results, the conference call last night, Mark Zuckerberg's comments about the investments required for AI? How do you put it all together?
Well, first of all, their results were stellar. You can't say anything other than that. They are making great growth and profit. The problem, such as there is a problem, is that they are spending so much money on capital costs, mostly connected to artificial intelligence. And the question of what the returns on that will be, I think, is legitimately on investors' minds. And that probably more than any other factor explains the fairly dramatic drop in the stock.
How about for you, though, David? I mean, are you questioning, just how good of an investment this might be? Or you think this is perhaps like it will be a significant revenue driver at some point?
It's a great question. Well, first of all, you got to look at this company, of all the tech companies, has just skyrocketed in the last year or so. So, this is a very highly valued stock compared to what it was. And I think given the extraordinary run-up, a little bit of a correction is hardly a shock. So probably you could say it's not at all problematic that the stock has pulled back a little bit from that perspective. I think the most interesting thing, I'm actually here at the Council on Foreign Relations, having just attended a meeting that was very heavily focused on energy. And, even Zuckerberg in his remarks yesterday was talking about the energy costs of AI are going to be one of the significant capital expenditures they're having to deal with. So they have to build their own renewable energy infrastructure in many instances these days. And this is true of all these big companies. The thing that I'm thinking about right now is whether, in some sense, because of the sheer scale of the investments that are having to be made in data centers and the energy associated with them, that these companies are shifting to, in the long run, a fundamentally different business model that's a little bit more like a utility, where they're just going to be facing these ongoing gigantic costs just to stay abreast with one another. I don't think we know the answer to that yet, but it could very well be starting to happen.
I got to say, though, when we're looking at the estimates for the CapEx here, to me, it doesn't look like it's all that different from what they had previously estimated. So they now think CapEx, its capital expenditure, is going to be in the range of $35 to $40 billion before 30 to 37. I don't know. That sounds pretty similar to me, is it not?
It is similar. And, I think, markets tend to overreact. There's no question. I mean, I think that what people were reacting to in Zuckerberg's call yesterday was more a tone that he was conveying that the payoff for some of these expenditures may be a little longer than people expected. They don't face any fundamental problem in the short term. So in that sense, you're right. And in fact, I think Meta has done an unusually good job of taking advantage of AI in the recent year or two, in that they are doing a better job targeting advertising with AI. That's a concrete benefit. The thing that's also interesting, though, to me, if I were an investor that I would be somewhat concerned about, is that the Meta AI product, which they're just rolling out to their customers or their users across a lot of their services, effectively is a way of declaring that they're competing head-to-head with Google. Because they're basically starting to do what is effectively search inside Instagram, inside Facebook, using their Meta AI product. So that's a different business model if they go down that road too far. They still have an extraordinary ability to target advertising that is superior to pretty much anybody else, and that's going to guarantee a lot of profit for the long term.
David, where is the metaverse these days in terms of Mr. Zuckerberg's zeitgeist?
Well, in his zeitgeist, it's very prominent. I don't think it's really high in the zeitgeist of much of anybody else. I mean, it's so prominent, he renamed his company. I wouldn't be surprised if he regrets that now, but he got out of a tight spot with Frances Haugen at the moment by doing that. I don't think the metaverse is nearly such a big deal as you would think listening to him, and I don't think any other company thinks it's that big of a deal in any kind of short term. The degree to which it could be a big deal long term is unknown. We know that AI is changing everything now. We have no reason to think that metaverse issues are going to change everything anytime soon.
Not that I would think that Zuckerberg would have commented on this, but I'm sure he's got to be thinking, you know, what if TikTok gets banned, and potentially what a boon that would be for Instagram and the Reels product. I mean, how much do you think is that getting priced into the stock right now?
Probably not at all. There's also things that aren't being priced in, like extreme regulatory pushback in Europe that's really changing the way that Meta is able to target users in advertising across all of its product lines. So there's big shifts happening. It's very hard to know where these companies are headed. But yes, if TikTok really were banned, which frankly I do not expect, that would be fantastically great news for this company, and one would want to, you know, go long on them if you thought that's really likely. So yeah, there's so many shifting parts in this equation. It's astonishing.
All right, David, it's a busy week for tech earnings. Also, Microsoft and Alphabet. Let's just go to Alphabet because that's kind of dovetails on kind of the digital advertising theme that we started last night with Facebook. How are our good friends at Google/Alphabet? How are they doing? What do you expect here with their earnings?
Well, I think again, earnings from the standpoint of the ongoing business will be good. The question, again, will arise, how much are they spending on AI and data center infrastructure, and what's the chronology of the likely payoff? And you're seeing concerns being raised by analysts that the number of investment is going to be higher, and the possible long-term returns, just like with Meta, could be longer. But look, these businesses are thriving for the most part overall. I think Microsoft in particular, which is also coming up, is a company that just can't really do anything wrong from the standpoint of investors. And I think they too are going to be spending even more on AI infrastructure, and it's becoming almost like an energy investment as well as a data center and server investment.
So then it sounds like, though, there has to be, in investor's mind at least, there is a ceiling for how much investment in AI is too much. It sounds like that there is a bit of a threshold and a fine line here.
Let's figure out what the ceiling is. I have no clue. Nobody really knows what's happening with AI. It's a frenzy. Everybody's piling in, rightly so, but the exact terms of long-term competition are effectively unknown. So to say the ceiling is X or the ceiling is Y, it's pretty hard to do.
All right, David. So stepping back here, who do you think how real is AI to you? I mean, I think that a lot of people are trying to get a sense of, is this just big data we were talking about 4 or 5 years ago, or is this something fundamentally different?
Well, it is something fundamentally different. I think that's widely believed at this point, and I believe it. But again, the way it's going to manifest itself in business terms is extremely hard to predict. I know for myself, I am surprisingly often using ChatGPT instead of Google, and I'm getting results that I really can use. And I think many people are finding that. So this is changing the nature of these businesses in a fundamental way. And I think if Meta, for example, successfully deploys Meta AI across all its products, and just while you're in the middle of using Instagram or Facebook, you can do a search using their AI tool that you would have otherwise had to leave Meta's product to go to Google to do. that's a strategic benefit for them. So it is worth making those investments. But, you know, when you're talking about annual capital expenditures of $40 billion, you know, it's hard to know should it be 45? Should it be 35? Look, I wish I knew.
David, thanks so much for joining us. As always appreciate getting your perspective on all things tech. David Kirkpatrick, founder of Techominy, and also the author of the book, the seminal book, I think, on Facebook is The Facebook Effect there. Looking at shares of Meta Platforms, a.k.a. Facebook, off about 10.5% today, still up 25% year-to-date, and more than doubling over the prior 12 months. With our news in New York City, here is Michael Barr.
Thank you very much, Paul, Molly, and Lisa. New York's highest court has overturned Harvey Weinstein's 2020 rape conviction and ordered a new trial. Today, the Court of Appeals ruled that the judge at disgraced movie mogul's landmark Me Too trial prejudiced him with improper rulings, including a decision to let women testify about allegations that weren't part of the case. The 72-year-old Weinstein has been serving a 23-year sentence in New York. He'll remain in prison because he was convicted in Los Angeles in 2022 of another rape and sentenced to 16 years in prison. Donald Trump is back in a New York City courtroom as his hush money trial resumes. Manhattan jurors are hearing more witness testimony from former National Enquirer publisher David Pecker. Also today, the U.S. Supreme Court hears arguments in Washington over whether he should be immune from prosecution as actions Trump took during his time as president. Trump spoke before heading to his hush money case during a surprise campaign stop in Manhattan.
We have a big case today. This judge isn't allowing me to go. We have a big case today in the Supreme Court on presidential immunity. A president has to have immunity. If you don't have immunity, you just have a ceremonial president.
However, former Principal Deputy Assistant Attorney General Tom Dupree says Trump is not likely to prevail with the justices.
They've never recognized this sort of immunity from criminal prosecution that Trump is requesting. So I think it's a pretty uphill battle for the Trump side.
In filings, the special counsel argues that instead of an official act, Trump was working to carry out a private scheme to remain in power by fraud. Support among swing state voters for U.S. aid to Israel has plunged in the months since the country launched its campaign. That's according to Bloomberg News Morning Consult poll. Global news 24 hours a day, whenever you want it. markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks really getting crushed this morning as a handful of big tech sold off while data showed a significant economic slowdown. Right now, let's get to it. And we have the NASDAQ down more than 1.5%. Same for the Dow. The S&P 500 down more than 1%. Want to dig a little bit deeper? Go to the IMAP function on your terminal. The biggest drag coming from communication services. Then you go further, you see media entertainment. A little further, interactive media and services. And you see where we're getting right to the top is Meta. Meta shares down 12%. That's followed by Alphabet. Alphabet's down nearly 3% right now. They're going to be reporting after the bell, along with Microsoft. Microsoft not looking good either, down 3%. Intel, that's going to be reporting later this afternoon. That is actually up right now, nearly 1%. And since we're talking tech, we have some news from Micron Technology. It's been awarded up to $13.6 billion in grants and loans from the Biden administration for some new memory chip factories in the U.S., but shares this morning, they are lower, down 0.7%. That is your Bloomberg Business Flash. Paul and Molly.
All right, Lisa Mateo, thank you so much. We appreciate that. We have Molly Smith sitting in for Alex Steele here. Alex is on holiday for the week. Paul Sweeney here. I'm live in Bloomberg Interactive Broker Studio. And we're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast. And that's where you will find us. Big economic data point coming out today, GDP plus some inflation data coming out, spooking the markets a little bit here. I'm looking at the yield curve. The two-year Treasury seeing right at 5%. Big move, up 7 basis points. And that kind of feeds into, like, I'm looking at the 30-year fixed mortgage. It's now back up to 7.24%.
Better believe it's going to be higher next week.
Yeah.
Assuming, that the trend right now still holds. And I'm sure, Powell next week probably going to have to rip up the script, say something a bit more hawkish.
Yep.
We're going to have Ira Jersey come in and tell us all about it now. So Ira Jersey joining us on Zoom from Princeton, New Jersey, where we definitely need to host our next show from.
Yes.
We will do that at some point. So Ira's our chief U.S. interest rate strategist at Bloomberg Intelligence. Thanks for joining us, Ira. We've been looking at these GDP numbers, and obviously the inflation print really seems to be driving the market action today. Tell us what you're looking at.
Yeah, so obviously that inflation print just implies that the monthly number that we get tomorrow is going to be much higher than economists are expecting, and that is a big driver. When inflation's this high, the market has to continue to reprice the expectations of when and if the Federal Reserve is going to actually cut interest rates, and the market now is much more symmetric in thinking not only, yes, it's like 50% chance that they're going to cut interest rates, but there's actually a growing chance that's being priced into markets that the Fed's next move may actually be an interest rate increase, right, a hike at some point. I personally think that that's a relatively low probability still, probably lower than what the market's pricing, but on hold is, I think, a growing default scenario for the next 9 to 12 months for the Fed because inflation's just too high. It's way above their comfort level.
So, Ira, I guess one of the questions is here, did the Fed and Jay Powell back in December, when they kind of had that Fed pivot, started talking a little bit more dovish, in hindsight, was that a mistake?
Well, it was a mistake because their forecasts were wrong, right? Like at the end of the day, the Fed makes forecasts just like everyone makes forecasts, and their forecast for how quickly inflation was going to slow down was incorrect. And we were incorrect too, and we were among the more hawkish or less dovish, probably strategists on the street. The issue that's come up is that when you looked at the survey data, a lot of the survey data back in December and even in January and February, it was pointing toward a slowdown in the economy. So a lot of the traditional indicators for economic activity, like ISM new orders, like some of the consumer confidence surveys, they were all pointing to a potential slowdown. But and even though those have rebounded just a little bit, the hard data, so things like retail sales, personal consumption, spending, the jobs data obviously is probably among the most important and visible of these numbers. Those have all been reasonably robust. So there's this disconnect between what people are saying and what people are doing. And I think that that's really been a challenge for forecasters who rely on these surveys for forward-looking indicators, and they just haven't been realized. So, so they made a bad forecast, so therefore they made a bad pivot, and now they have to kind of take some of that back, and that's exactly what you've heard out of a lot of the Fed speakers the last couple of weeks. They're in the quiet period now, so you're not going to hear anything from Fed speakers until next Wednesday. But when you go back and you listen to what Jay Powell said and a lot of the other speakers, they're going to probably continue to say, like, look, unless inflation goes down more significantly and substantially, we're going to keep interest rates on hold. And I think that that's probably what Jay Powell will say next week.
So it sounds like you think then, Ira, that this print that we got today, the robust inflation prints that we've gotten to start this year, who knows what we'll see tomorrow, doesn't seem to really change the narrative a whole lot, that the economy is still proving to run really strong. Doesn't seem like interest rates are really denting that a whole lot. And that's still the narrative that they're going to go with? Or do you think that anything has changed here?
Yeah, I don't think very much has changed. Interest rate sensitive sectors have certainly been affected by interest rate hikes. But what's happened over the last 15, 20 years is that we've shifted away, firstly, from interest rate sensitive growth to non-interest rate sensitive growth. So things like the services sector, when you dig into the details of today's GDP report, you see that on a seasonally adjusted annualized basis, the services sector saw a 4% growth, whereas the durable goods sector saw a negative 1% growth, right? And durable goods were things like autos, right? So auto sales have slowed down substantially. Part of that's on price. Certainly prices have gone up, but that's also credit availability, right? Large purchases like automobiles and houses, you tend to be purchased on credit of some form or another, and so those are very sensitive to these higher interest rates. Whereas the service sector just isn't. Services aren't services spending have more to do with wages, how much disposable cash you have, as opposed to you're not going to probably go out and go to the movies and then finance that over 10 years, right? That's just not something you're going to do. You're going to spend, but if you have if you get a pay raise, you might go to an extra movie every month, and that's basically what you're seeing in the data. And if those trends continue, then you can wind up having an okay economy, and the Federal Reserve might not have to move interest rates very much at all.
Well, then what can they do about inflation then if our economy is just structurally more resistant to higher interest rates?
Yeah, well, there's not much you could do. You could either raise interest rates a lot more, and that would probably ultimately be recessionary, because you'd wind up with a recession in housing, a recession maybe in the auto sector and some of the other interest rate sensitive sectors, and that could start ultimately to bring down the entire economy. Or you could do things that are politically unpopular, things like raising taxes, for example, just reduce the ability for the household sector to spend money. Or, and this is something that I think a mistake that the Federal Reserve made, the Federal Reserve could come out and just say, like, hey, we're not worried about 2.5%, 3% inflation anymore. That's fine. And if you go back to the 1990s, for example, like, we were running at around 2.5% to 3% PCE deflator. So, why not pivot back to that? I think the mistake that the Fed made was having a hard target of 2% on inflation, as opposed to something just a little bit more flexible. And the fact is inflation's not increasing, right? Inflation's not going up anymore. It's just not coming down. And because it's not coming down, they're not reaching their 2% target. And I think that's where the disconnect really has come.
All right, Ira, thank you so much for joining us. Ira Jersey, Chief U.S. interest rate strategist, Bloomberg Intelligence, joining us from our Princeton campus down via Zoom there. So be interesting to see. So the GDP print, again, the takeaway, as I understand from you, Molly, the headline, very disappointing, but if you dig underneath it, a little bit less so.
Yeah, exactly. I think, one of the parts of the headline that was disappointing was the fact that trade subtracted from growth, as in higher imports relative to exports. But higher imports also mean that there's a lot of demand. The idea is just that we're sourcing it from outside the country rather than producing it here. So I think that still bodes well for the story of the consumer and the health of the consumer, and that demand in the economy is still strong. And obviously that's still making inflation not go away.
Yep. All right. Very good. We're looking at the markets here, taking it on the chin. The S&P off about 1.3%. The NASDAQ off about 1.6%. Yields higher. 2-year Treasury up 7 basis points. 5 0.5% even on your 2-year. The 10-year's up about 7 basis points as well, 4.71%. That's a resistance level that Ira Jersey has called out in the past, so we'll keep an eye on that level. We'll have more coming up. This is Bloomberg.
company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Shares of Facebook parent Meta Platforms are falling. They're down more than 12%, and this after boosting spending projections by billions as a sales forecast, well, it missed. We get more from Bloomberg's Ed Ludlow.
The bit that the investor base didn't like was almost the roadmap to get there, not necessarily the idea that the range for expenses for the full year was slightly raised at the bottom end of the range, not that CapEx has been boosted to 40 billion at the top end. It was the explanation of how long that infrastructure investment to support AI model development is going to show up in what Meta already does, the family of apps.
Now, there's more big tech on the way today. After the bell, we get earnings from Alphabet. Their shares are down nearly 3%, and Microsoft, they're down 4%. IBM shares, well, they're tanking too. They're down 9%. The company's weak consulting unit sales overshadowed its acquisition of software firm HashiCorp. And it's a mixed picture for airlines earnings. Southwest cutting growth as it expects fewer Boeing deliveries this year, while American Airlines forecasting a return to profit. George Ferguson covers the airlines for Bloomberg Intelligence.
Southwest is one that has a Boeing problem. American's got a bit of a mixed fleet, so I think they have less of a Boeing problem, but there's probably a little bit of interruption in deliveries. United is a big Boeing customer. They've got a Boeing problem. Delta doesn't. They're an Airbus customer.
Southwest is down 9%. American is up about 0.5%. Machinery maker Caterpillar had a good first quarter, but it said it expects sales for the second quarter in 2024 to be lower, and those shares are down about 8%. Merck raised its annual profit and revenue forecast as its cancer drug Keytruda continued to dominate the treatment landscape. And Bristol Myers Squibb, it had first quarter revenue beat. Those shares of Bristol Myers, they're down 7%. Finally, Hertz reported a miss that was much worse than expected. That's your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, markets are moving today. The S&P 500 off about 1.5%. NASDAQ off about 1.9%, plumbing some of the lows, intraday lows of the day here. Yields are higher. 10-year Treasuries now yielding 4.71%. Crude oil down $82 a barrel. Bitcoin, it's also down 1.3%, 63,000 per token. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Molly, and Lisa. Disgraced film producer Harvey Weinstein's sex crimes conviction was overturned in New York. New York's highest court overturned Weinstein's conviction for sex crimes against 3 women, ruling the trial judge erroneously allowed testimony related prior to uncharged acts. The New York Court of Appeals also ruled that the judge abused his discretion when he allowed Weinstein to be cross-examined about these acts. Weinstein was convicted separately of sex crimes in California. He'll now be transferred from New York to California. Former President Donald Trump is back in a New York City courtroom for his criminal trial over hush money payments. Trump told reporters he wanted to be in Washington, D.C. as the Supreme Court listened to oral arguments over his assertions of presidential immunity. Lawyers for Trump are telling the justices presidents cannot be prosecuted for any action they take while in office. Trump spoke to reporters outside the courtroom in New York.
If you don't have immunity, you're not going to do anything. You're going to become a ceremonial president. You're just going to be doing nothing. You're not going to take any of the risks, both good and bad.
The government, meanwhile, calls Trump's claim of immunity novel, unsupported by the Constitution and refuted by history. He was feared dead, but American-Israeli hostage Hersh Goldberg Poland was seen in a new Hamas video appearing under duress with a shaven head and missing part of his left arm. His mother, Rachel Goldberg, spoke to ABC this morning.
Any parent and anyone who has parents can imagine after 201 days, more than half a year of doubt and fear and angst and trauma, to have that, it was very bittersweet.
The release of the Poland video sparked an impromptu protest of family and friends outside Prime Minister Benjamin Netanyahu's residence last night, demanding he make a deal to bring the hostages home. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Molly, and now John.
All right, Michael Barr, thank you so much. We appreciate it. Molly, there's a lot of big, important news out there, but this one just kind of got my attention here. It's worth mentioning. Chipotle Mexican Grill is telling its employees not to include chicken in their own meals as surging customer demand has crimped supply. The reintroduction of chicken al pastor has been a huge success, creating challenges, the company told U.S. employees in an email last week. I mean, if I'm working at a Chipotle, I darn expect to be able to go get a chicken soft taco or something.
At a minimum,
At a minimum.
So that's like so surprising to me. I would have thought maybe more like the carne asada was maybe more like the popular one. But
exactly.
I don't know. I mean, I've had the chicken al pastor. I'm a fan. So personally, selfishly, as a non-Chipotle employee, I'm okay with this. But, of course, if I worked at Chipotle, I'd probably feel differently. I mean, who knows? Maybe you've got, like, a dietary, religious restriction. All you can eat is chicken, that you can't have shellfish or red meat. Like, that's got to be challenging.
All right, here we go. Here's the message. Bearing the subject line, quote, "Let's conserve our fan-favorite chicken," said the changes were effective immediately and would last until further notice. The goal is to, quote, "preserve our supply of adobo chicken for our guests."
So if you work at Chipotle, you're allowed to eat the food?
Darn right you are.
You get free, I think it's maybe Monday, you get free and or discounted lunches.
So if I worked at McDonald's, I'd get free Big Macs?
Well, I don't know what McDonald's policy is.
When I worked at McDonald's, I definitely scarfed out.
That was last year. That was
19, I was 16. I lasted 3 days. And then it was so rough that I said, I'd rather be a dishwasher at the Parfait House on Olden Avenue in Trenton, New Jersey, and ride my moped about 20 minutes each way.
There's demand for those positions right now, you know?
Well, now they're being filled. they're being filled by the illegal immigration.
That's true.
So I don't know. But anyway, tough days for our good friends, the employees at Chipotle. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to keep moving this thing forward. We'll take a look at what's happening with stocks because they are moving. We're going to chat with Gina Martin Adams, Chief Equity Strategist at Bloomberg Intelligence, get her thoughts on these markets as we kind of wade into the teeth of earnings. And then Pascal Soriot, CEO of AstraZeneca, he's going to join the program to discuss AstraZeneca's earnings along with regulatory and scientific updates. So it's going to be good to check in with Mr. Soriot, the CEO of Big Pharma, AstraZeneca. Barry Ritholtz is going to join us. It is Thursday, so that means we talk to Barry, and we'll talk to him about whatever he wants to talk about. That's how we roll with Barry Ritholtz. With our news and stocks, all kinds of good stuff, Mr. John Tucker.
All right, and I should tell you, we're being brought to you by IBKR. Financial advisors switch to interactive brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA. Did just get some data, since we're data dependent. This is the Kansas City Fed manufacturing activity, down 8 points. We're expecting a decline of 5 points, so worse than expected there. The S&P 500 right now 68 points lower, a decline of 1.4%. We're at 5,003 on the index. The sell-off extends to the Dow. That's down 1.7%, down 659 points. And the NASDAQ Composite Index, 267 points lower. That is down 1.7%. And for now, it's the economic data that's in the driver's seat. The GDP report showing slowing inflation, higher rate of inflation. While it's just one report, it hints at dreaded stagflation, just maybe. That has spooking investors. Again, the stock averages are falling, yields are jumping. And then Meta Platforms helping depress the risk sentiment after its earnings report last night. They're going to spend billions of dollars more than previously anticipated. In the meantime, at Morgan Stanley, Andrew Sheet says it is a stock picker's market.
We still think when we look more broadly, there are segments of the market, especially if we step back and think globally, that we still think are more reasonably valued. It's really about picking our spots.
Again, two of the Magnificent Seven, two more in the batter's box tonight. Both Microsoft and Alphabet are due to deliver after the close of regular trading. A quick look at the yields. The 2-year, 6 basis points higher. That's at 4.99. Let's just call it 5%, round up. 10-year is up 6 basis points, and that is at 4.70. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, thank you so much. We appreciate that. Molly Smith and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so you can check us out right there. Stocks moving today on the back of some of that economic data. The GDP came in lower than expected. Inflation data came in a little bit hotter than expected, and that's why you're seeing these big moves in the markets. Let's check out what's happening under the hood in those equity markets with some individual names, because it is earnings season. We'll check in with Norma Linda. She covers all the markets for Bloomberg News.
Well, Paul, Meta Platforms has really been in focus today, especially as it's been leading a lot of those tech stocks lower. It's seeing its worst day since 2022, with shares down as much as 16%. Now, of course, investors are still parsing those earnings, especially as we're looking toward the earnings to come after the close today from some other tech firms like Alphabet and Microsoft. But as we look at Meta in particular, we did see profits and revenue as a pretty big win for the company, but it's really the outlook that investors are looking for. They are seeing that the company will spend billions of dollars more than expected this year on AI, and that has investors a little bit nervous.
I want to go to these travel names next because this is interesting. We've got Royal Caribbean that's boosting its earnings outlook, saying that, cruise demand is really strong. Then we've got Southwest Airline pulling out of 4 airports, saying that growth is really slow. So what is it right now? How's travel
Exactly,
doing?
Molly. It's good for bulls and bears, it seems like. But for Royal Caribbean, we are seeing it on the upside, as you mentioned, as we're seeing continued surge for demand for cruises. It actually was able to see a record price hike this past quarter. The company said that it expects earnings per share to be between $10.70 to $10.90, and that's versus an average analyst estimates of just under $10, $9.99 to be specific. And on the flip side, we're seeing Southwest Air down. Those shares are coming back, plunging as much as 11%, hitting their lowest intraday level since December. Now, this is after Southwest said that it's ending service at 4 separate airports and offering voluntary leave to, quote, address significant challenges that have been imposed by the reduced deliveries of Boeing planes. So, of course, Boeing is still the story when it comes to a lot of these transportation stocks and airlines here.
Yeah, the ripple effect from Boeing across the industry is unbelievable.
I think we're still I don't think we felt the full extent of it yet. I think there's still definitely more to come. And I mean, obviously they had their earnings this week, not as bad as expected, but far from over that story, it seems like.
Very good. All right, Norma Linda, thank you so much. We appreciate that. Norma Linda giving us some of the highlights here and a couple of lowlights there in the equity markets here. We got right in the midst of earnings season here. Again, the Meta number was a big one, but we've got Amazon and I think Microsoft after the close tonight. Is that right, John?
You are correct.
There we go. So we'll get a lot more news coming from the tech sector, and that kind of raises the question that I think a lot of investors have is, to what extent will tech continue to be the leader for this market going forward? I think a lot of investors feel like it's been, for a lot of market participants, that's the only thing they've ever known.
Right, yeah.
Technology leading the market.
That keeps on giving.
Yeah.
It's hard to say that, like, should we buy into it? It's so expensive, but it's the only one that keeps going up.
No, and it keeps Dan Ives, gainfully employed, because he's been a super bull on technology. He's been super right, so good for him. Gina Martin Adams joins us right now here in our Bloomberg Interactive Broker Studio. She is our equity strategist here. And Gina, we're just kind of starting to get into the meat of it, but let's just start with that kind of general question. Is tech still kind of the bomb? Does tech have to work for the markets to work?
It doesn't have to work for the markets to work, but it has to work for the markets to go up at a double-digit pace, without a doubt, because tech is still such a large market cap share, and because we are still seeing earnings struggles across some of the non-tech segments. If tech isn't working, then the market is most likely going to go through a period of churn, and that was our outlook coming into second quarter. Is all the way back in really the early part of March, we started to see signs of a leadership shift emerging on the S&P. Tech reached a near-term peak in relative terms. I think that was precipitating the earnings season that we're going through now, which is tech companies face almost impossible expectations, and thus only a few are going to be able to beat and raise relative to expectations. So that creates a little bit of friction, that creates a little bit of disturbance for the market. It doesn't necessarily mean all bets are off and it's time for the equities to plummet, but it does mean that we might have a period of churn for the equity market as we determine where leadership likely lies going into the second half of the year.
Yeah, so where do you think that's going to come from then, if it's maybe not going to be tech, or maybe just not tech at double digits?
Yeah. It's very difficult to say yet, because what is generally happening is tech and communications together are still sectors that are leading overall growth trends. The rest of the index is starting to catch up. But you highlighted just this morning, we are seeing positive trends emerge in some other segments. Consumer segments are still pretty stable. Healthcare, when we get past the one-time charges affiliated with accounting changes, are also starting to show some pretty significant growth. For the first time in several quarters, we should see stabilization emerge for energy, which is yet to really report en masse, or at least some guidance that it should start to get a little bit better for energy. Financials didn't start off great with banks, but the bigger companies have yet to report in financials. So where are we going to go with financials? There are a lot of questions still, and I think that is also part of the reason why the market has been a little bit dodgy so far in the second quarter. We don't know where leadership is likely to come from. The one big thing we know is that the market is likely to trade with that leadership as it emerges.
And so what's the next big thing you're looking for in terms of earnings here?
Yeah, I think the biggest thing you need to look for, of course, you want to watch the big cap tech stocks. There is still opportunity for some of these companies to hit it out of the park and surprise. NVIDIA is, of course, still the stock that everyone is watching most carefully. But beyond tech, I do think we want to watch the rest of the segments of the index. Healthcare is the sector that we're watching most closely. Healthcare has been an incredible earnings downtrend over the course of the last year. We've got big charges that are masking an overall improvement in healthcare segments. We're also watching the consumer space as well as industrials and financials. I think beyond sectors, the big theme of this earnings season has to be what happens with margins and how companies are contending with inflation, which is not decelerating as fast as anyone had hoped.
Yep.
Are they retaining pricing power? Are consumers or their ultimate end market, are we seeing some pushback there? Those will be really key questions so far this quarter. Now, one stat that I don't think anybody's paying attention to, so far this season, 76% of companies are beating net income forecast or net income margin forecasts. Yep. So we are seeing margins beat expectations. That's the highest pace of beat since the pandemic. That will need to continue to generate some degree of optimism in non-tech segments.
All right, Gina, thank you so much for joining us. Gina Martin-Adams, she is our U.S. equity market strategist for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. It is earnings season in full, fast and furious. They're coming. A good print coming out of a large pharma company, AstraZeneca, just early this morning, moving that stock here. And we are fortunate right now to check in with Pascal Soriot. He is the CEO of AstraZeneca. He is in London, joining us via Zoom. Patrick, thanks so much. Pascal, thanks so much for taking the time. We really appreciate getting a few minutes of your time. You guys reported numbers this morning. What are the key takeaways from your most recent quarter for your investors?
Hi, Paul. Thank you so much for having me. Yes, we had a tremendous start of the year. Actually, our revenue, I should say, grew by 19%. But the exciting piece was that every portfolio of products grew very strongly. Oncology plus 26% to $5 billion for the quarter. Cardiovascular 23%. Rare disease 16% growth. The geographies grew 19% in the US and Europe. The most remarkable was 40% growth in the emerging markets outside of China. And China itself is returning to growth. So really a very, very strong start of the year. And beyond the financials, our portfolio, our pipeline is making tremendous progress. And we started new phase 3 trials, and we announced very positive results, in particular in oncology, which we will present at the ASCO in Chicago very soon.
Yeah, you've got an investor day coming up next month, and it seems like you just said, you're going to discuss the pipeline, including the timing of future treatments and their revenue potential. So can you give us a little sneak peek now for some of us who can't wait?
Yes, exactly. Actually, Marty, thank you for that question. What we're going to try and show to investors is that we can be a strong growth company, not only for the next 7-8 years to 2030, but even beyond that. And so the growth over the next period of time to 2030 is going to be driven by what we have in our hands today and what is going to come out of our phase 3 pipeline very soon. So we're going to attract attention to investors, of investors to the major growth drivers. We're going to show them where consensus is actually underestimating some of our products and the opportunities we have in our pipeline. We have a very large pipeline of new projects, and some of those are underestimated. Beyond that, we also want to show investors what our strategy is and what our plans are for the long term. We've been investing in new platforms, new technologies, which we believe will shape the future of medicine in cancer, immune diseases, and beyond. For instance, cell therapies, gene therapies, antibody-drug conjugates, radioconjugates. So really, this is our goal: show people that we are focused on today, but also tomorrow to 2030 and the long term.
The CEO, we were speaking with Pascal Soriot, the CEO of AstraZeneca. I'm looking at the stock here. AZN is the ticker. It's a big company, $230 billion market cap. The stock is up 6% today on the back of those strong earnings, up 12% year to date. Pascal, I always joke to people, and I say, in my next life, I want to come back as a healthcare M&A banker, because it seems like every Monday we come in and pharmaceutical company A is buying pharmaceutical company B or biotechnology company C. How does M&A, growth via acquisition, fit in with your growth strategy vis-a-vis organic growth that comes from your own in-house R&D?
Yeah, thanks, Paul. It's another great question. We identified a number of years ago the technology platforms of the future, as I said a minute ago. So if you look at cell therapy, for instance, we have our own internal efforts, and we've been complementing this with acquisitions or licensing agreements. Particularly, we bought a cell therapy company that is bringing us technologies, but also products. And we've been putting all of this together to actually build a portfolio of products in cell therapy, in gene therapy, in antibody drug conjugates and beyond. So we target small to mid-size bolt-on acquisitions. That's really has been our strategy, so we can integrate them much better, and then we can add value along the way before we launch.
Pascal, what can you tell us about drug prices right now? I mean, this is such a sensitive topic here in the U.S., especially in an election year, something that's really close to the heart of so many consumers and voters. I mean, can you tell us a little bit about the pricing strategy, and are people able to afford a lot of these medications?
Yeah, it's important, first of all, to remember that in the United States, of course, price is an issue like everywhere in the world, but in the United States, patients have access to innovative medicines that can save their lives much faster than in Europe or in other parts of the world. Innovation is rewarded and access is much faster. Now, price is definitely a consideration, of course. The IRA, of course, has some challenges and some issues we are trying to work to address. But there's also a big benefit for patients, which is that starting in 2025, there will be a copay cap. Patients will not pay more than $2,000 a year who are on Medicare Part D products. And this year it's $3,500 or $600 as a max. So ultimately, if you're a Medicare patient, you will not pay more than $2,000 a year for your medicines, regardless of how many medicines you have and how much they cost. So that will be really an enormous progress for patients. And of course, some of these rebates or that are discounts that are required to compensate for this, we will be paying. But suddenly we see that as a big improvement for patients, and hopefully also an incremental revenue for us, because patients will be able to afford their medicines and take them and stay on them longer. So, win-win, really better for patients and hopefully better for the industry as well.
Pascal, I'm looking at the on the Bloomberg terminal, the PGEO function, which shows me kind of your revenue by segment. And I see that oncology is your biggest revenue line there, about 37% of total revenue. What are the opportunities there in your oncology business? I know it's a competitive business, but what do you have in the pipeline? What do you have to bring to market? How do you think about that business?
Yeah, our oncology portfolio of products grew by 26% in the first quarter to $5 billion in the quarter. So we are on a very strong trajectory, driven by a number of products that we have in a portfolio for lung cancer, breast cancer, prostate cancer, ovarian cancer, and there's more to come. And the future of oncology really is about combination therapy, combination of antibody drug conjugates, as I said before, those products that target the tumor cells and deliver a toxin at the site of the tumor cell and essentially kill the tumor cells without affecting the healthy cells around, and combining this with immuno-oncology products, and then in the long run, adding cell therapy to this. So there's an enormous amount of innovation that's going on in cancer. The biology of cancer is being improved very rapidly, and as a result, new medicines are coming up. There are still cancers, unfortunately, that are difficult to treat. But one of the other aspects of cancer that is very important is diagnosing patients early so you can intercept the disease early. If you look at breast cancer, mammographies have really helped diagnose breast cancer very early, and the survival rate at 5 years is 99% when patients are diagnosed early. Lung cancer is the opposite, diagnosed too late. So there are now technologies that will enable patients and doctors to diagnose cancer very early and treat it early. So the combination of this plus new treatments gives us hope that there is a possibility that in the near future we could actually cure cancer or turn it to a chronic condition that people can live with.
Pascal, 30 seconds left here. One of our readers writes in and says, on your May 21st Investor Day, are you going to give a big sales target for 2030?
I think I will have to invite people to our meeting in Cambridge in the UK. We've even, offered to offer them a lunch. So I won't disclose that today, but we certainly will show people our strategy and why we believe we can be a growth company and what will be the growth drivers. But I can't say today whether we will be disclosing a target at that point.
All right, Pascal, thank you so much for joining us. Really appreciate you sparing a few minutes of your time today. Pascal Soriot, he's the CEO of AstraZeneca, joining us from London via Zoom. The company reported strong numbers this morning, as Pascal was talking about, and stock is up 6% today, up about 12% year to date. Right now, let's kind of get a reset here on these markets. We'll do that with Mr. John Tucker.
All right, I'm going to say this is a pretty bad combination for risk assets. The economy losing momentum in the first quarter, while inflation accelerated. That is a pretty troubling performance. Now, it is one report. It is kind of a look in the rearview mirror. GDP expanding at a 1.6% pace. That's the slowest in almost 2 years. Inflation, that was most notable in services. The major stock averages selling off. Yields are pushing higher. Meta Platforms, the worst performing stock right now, the S&P 500, that is down over 13%. And Caterpillar shares, they're weighing on the Dow Jones Industrial Average after a disappointing second quarter sales view. And those shares right now down 6.5%. Now, overall, the S&P 500 down 65 points. That is a decline of 1.3%. We're at 5,006 on the index. The Dow Jones Industrial Average, 610 points lower. That's down 1.6%. The Nasdaq Composite Index down 273 points. That's a decline of 1.75%. As for those yields, the policy reactive 2-year, just about 5%, so 4.99. That is up 6 basis points. The 10-year yield, that's up 6 basis points. We're at just about 4.70. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Molly.
All right, John Tucker, thank you very much. We appreciate it. Molly Smith, she's sitting in for Alex Steele this week. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. We had that GDP print that came out this morning, significantly weaker on the surface than the forecast, and showing a pretty market decline from last month as well, and that's kind of having an impact on the markets, as John Tucker was just reporting. Yields up, stock prices down. Let's get some perspective here. We can do that with Barry Ritholtz. He's host of Masters in Business on Bloomberg Radio. He's also the founder of Ritholtz Wealth Management. Hey, Barry, so we get the economic data. It kind of freaks people out as it relates to where this economy is going. A, what did you read into the economic data that came out today, both on GDP and inflation, and maybe how the market's reacting to it?
Yeah, so I always love the attempt to impose rationality on what is essentially a free-for-all. We've had the Fed crank up rates 525 basis points from zero, and we continue to hear the phrase long and variable lags on the growth side. And at a certain point, you have to assume the chickens come home to roost. And this is the natural impact of higher cost of credit, higher rates. We've already seen housing slow because there's no real supply around. But now you're seeing it impact things like automobile sales. Remember, went through a big period where you couldn't get cars easily. Now that's behind us, and car sales are starting to slow down. Gasoline sales are starting to slow down. You have to lay this right at the feet of the Fed. And yet at the same time, when we take apart the inflation data, the Fed BLS data includes renewals as well as someone moving into a new house or apartment. If your lease renews, if you just renew your lease, that was set in motion 2 years ago when you did your prior lease. The Fed has nothing whatsoever to do with rates, have nothing to do with it. But 2 years ago, that lease had a high number built into it. Back that out, and you're at the 2% inflation target for the Fed.
I think there's got to be more to it, though, than housing right now, though. No, Barry? I mean, it sounds like there's so many other broader services costs right now that are so expensive. I mean, one of them that was in the GDP report was financial services and insurance. I mean, we talk a lot about in this show, especially homeowners insurance, car insurance. I mean, those are things you can't really avoid.
That's right, but you have to look at what's driving those prices higher. Is it monetary policy? Is it, pent up demand? Look at what's been going on in Florida with both homeowners and automobiles. It's very difficult to get insurance, and you have to turn around and say, you have all these cars that have gotten flooded out from repeated hurricanes and repeated flooding events. You have all these homeowners who live right on the water. These are prices going up, but you have an externality driving it. It's not inflation, it's global warming and climate change. And just maybe Florida is a crazy example because, Florida is Florida. But when we look around and look at the things that are going higher, like healthcare and the cost of education, that's been in the backdrop for 25 years and has been the most expensive side of the services thing. Insurance is a very specific reaction to an externality and not what we think of. Hey, if the Fed raises rates to 10%, are they going to make the cost of waterfront homeowners insurance any cheaper in Florida? Or when you have all these cars flooded out or being destroyed in places by weather, the Fed has zero impact on that. You have to put that into a different context than usual inflation.
So Barry, with today's pullback, we got the S&P off about 5% from its highs. That feels like it's just a healthy kind of pullback in what may be an otherwise upwardly trajecting market. Is that how you view it, or is there anything else going on here?
You read my mind, Paul. Look, we finished the first quarter with the NASDAQ 100 up 8.5% and the S&P 500 up 10.2%. That's a good year. Forget quarter. That's on average 8 to 10% is what you should rationally expect from equity markets. So a little bit of a pullback is healthy. Let me also point out, even though we have very strong earnings and revenue numbers, a lot of it was built into the expectations, and they're a little disappointing compared to Q4. So look, what are we, about a quarter of the way through? About 140 companies have reported, plus 4.5% on profits and plus about, I'm ballparking this because as the numbers come out, the shifts, but plus 3.5% on revenues. Go back to Q4, and as good as these numbers sound, it was plus 6.8% on earnings and plus nearly 4% on revenues. As it almost makes Q1 look a little disappointing. I also suspect a lot of these strong numbers have been built into expectations. And so it's never the actual numbers, but how the market reacts to those numbers that are so revealing.
Well, market reaction today has been rough. And we've got now the traders' bets for the timing of the first Fed cut fully priced for the first meeting now out to December. I mean, remember, not too long ago, people thought that first cut was going to be coming last month. So tell us a little bit about the environment for rate cuts here. And I mean, also that possibility if we don't get one at all in 2024.
Right. This is a little bit one part analysis, one part wishful thinking. From reading everything Jerome Powell has been saying and talking about, and just looking at the arc of the data that's been coming in, I suspect the Fed very much recognizes that the economy is beginning to slow, not dramatically, but a little bit. And they're now at the point where they're looking for an excuse to take rates down marginally. More than half of people, so about half of the homes out, single-family homes, don't have mortgages. But of those that do, half are 4% or less, and something like 65% are at 5% or less. So these people have golden handcuff with their mortgages. That's why there's no supply or such limited supply of homes out there. And that's the biggest single component in the inflation numbers. I suspect Jay Powell understands that, the sort of paradox we've been living with is that if the Fed lowers rates, which will ultimately bring mortgage rates down, you'll see a whole lot more supply hit the market, and that could have an impact, especially in the rental market, of driving that aspect of either PCE or CPI inflation lower. Seems kind of counterintuitive for lower inflation, reduce FOMC rates, but that's the odd situation we find ourselves in after underbuilding single-family homes for a decade post-GFC.
Hey, Barry, Molly was just, referencing the WERP function, how the market was discounting maybe 6 rate cuts in the beginning of the year, and here we are now down to like 1. Is that unusual for the market to get it so wrong or change its bets in such a short period of time? Does that typically happen?
One of my all-time favorite authors is William Goldman, who wrote Marathon Man and The Princess Bride, and he won Academy Awards for the screenplay for Butch Cassidy and the Sundance Kid. He used to very famously say, nobody knows anything. And that when you're looking out forward, look at the track record of economists, of the Fed themselves, and of people who are forecasting, including the market, when rate cuts are going to happen, where rates are going to go. It's been so consistently wrong for so long. I mean, look at the dot plot, is hilariously wrong. At a certain point, you have to ask yourself, why are we paying any attention to these forecasts? I know it's a necessary evil and it's all part of how we do our jobs. I think we have to dramatically lower the weight we put on these sorts of forecasts. Occasionally, even a blind squirrel finds a nut. So sometimes somebody gets it right. But when you take the average, when you look at the overall consensus, not only were we expecting, was the market pricing in rate cuts last year, perhaps because they were pricing in a recession, but look how wrong they were on the round of increases, how quickly it came, how far it went. Of all the many things that the human genius can do, predicting things like Fed funds rate just ain't one of them.
Real quickly for you here, Barry. So next week, Fed's going to be presumably holding interest rates. We're not getting any new forecasts. 30 seconds, what should we look out for?
I mean, I want to see how we continue to do earnings-wise. We're running a pretty reasonable beat rate, although obviously the better companies, the better earnings come out earlier. It's the components of inflation, and I want to keep an eye on consumer spending. That'll let us know if the Fed has kept us too tight for too long and it's really beginning to bite into the economy.
All right, Barry, thank you so much for joining us. As always, Barry Ritholtz, he is the host of Masters in Business on Bloomberg Radio. Highly recommend you check out that podcast. He gets phenomenal guests week after week after week, and a lot of smart discussion about investing and about these markets. Oh, and he's got a day job. He's the founder of Ritholtz Wealth Management. So we appreciate getting a few minutes of his time. Looking at the markets here again, the S&P off about 1.2%, the NASDAQ off about 1.7%. And I'll call out the Dow. It's off 600 points. That's 1.57%. 600 points, 37,858 on your Dow Jones Industrials yields. They move higher. The 10-year Treasury, it is up about 5 basis points. Let's call it 4.7% on your 10-year Treasury. 2 years, I can get that about 5% right now. How about that? With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Molly, and John. Harvey Weinstein's sexual assault conviction has been overturned by New York's highest court. Bloomberg's Karen Moscow has more.
The New York Court of Appeals has ordered a new trial for the 72-year-old Weinstein, arguing that the judge in his 2020 trial had wrongly permitted women who were not part of the indictment to testify about his conduct. The reversal marks a stunning turnaround in one of the highest-profile convictions of the Me Too era. Weinstein will remain imprisoned. He was convicted in Los Angeles in 2022 of another rape and is serving a 16-year prison sentence. Karen Moscow, Bloomberg Radio.
Arguments are taking place before the Supreme Court this morning in a case to determine the extent of presidential immunity from criminal prosecution. Former President Trump has argued presidents need absolute immunity. Justice Sonia Sotomayor presenting a hypothetical to John Sauer, arguing on behalf of Trump this morning.
If the president decides that his rival is a corrupt person and he orders the military or orders someone to assassinate him, is that within his official acts that for which he can get immunity?
It would depend on the hypothetical, but we can see that could well be an official act.
It could.
It comes as Trump is back before a Manhattan jury hearing more testimony in the criminal hush money trial. Former National Enquirer publisher David Pecker is on the witness stand. Support among swing state voters for U.S. aid to Israel has plunged in the months since the country launched its campaign to root out Hamas in the Gaza Strip. According to the latest Bloomberg News Morning Consult poll, it's at 51%, down 11% from November. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash sell-off today. Traders have been rattled by the data, the GDP figures hinting at deflation, slowing growth, higher rate of inflation. Toss in some of the disappointing earnings reports, and you have a sell-off in stocks and the push higher in the yields right now. All 11 major industry groups in the S&P 500 are lower. You have communication services. That's the biggest drag. And, of course, that is home to Meta Platforms. Right now, those shares down just about 13%. Still, Bob Dahl at Crossmark Global says the odds do favor a stock market correction and nothing worse.
We're way overbought. Maybe not in the short term, but we've had that almost 30% rise from the Fed pivot announcement on Halloween until the recent high. It's time for just a little rest. Markets get tired, just like you and me.
Well, investors now betting the Fed's going to wait till at least December before cutting rates. And as a result of that, you get yields along with the data today. They are higher. The 2-year, that is up 6 basis points. Right now, 4.98. 10-year is up 5 basis points. That is at 4.69. And overall, the S&P 500 61 points lower. That's a 1.2% fall. Right now at 5,010 on the index. The Dow Jones Industrial Average 585 points lower. The Nasdaq Composite Index is down 262 points. That is a decline of 1.7%. And after the close of regular trading today, the next two of these so-called Magnificent Seven cohort, we're going to hear from Microsoft and Google's parent Alphabet. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, thank you so much. We appreciate that. Molly Smith and Paul Sweeney, we're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so you can check out the video on youtube.com. Search Bloomberg Podcast here. Looking at the S&P 500, John was just reporting off 1.2% off the lows of the day, so attempting a little bit of a bounce here, but we'll see where we end up throughout the trading day. But again, people are really calling into question what the Fed will do going forward, given some of this economic data we saw today. We'll see really some key data tomorrow with the PCE deflator data as well, so we'll be on top of that. James Abate joins us. He's a managing director and chief investment officer at Center Asset Management, joining us from New York via Zoom. James, thanks so much for joining us here. What did you take away from the economic data we saw this morning and what it may mean for the Federal Reserve?
Well, when you look at today's release of annualized GDP of 1.6%, it was much lower than expectations. And it was combined with a higher inflation reading with the PCE coming in at 3.7%. Now, we may see, some offset to that tomorrow with with PPI numbers impacting the deflator, which is the Fed's preferred metric in terms of its 2% price target. But the bottom line is that when you look at equities and the fact that we've seen no safe harbor in the equity markets today is that the margin of safety for markets and U.S. markets in particular is that the expectations have been that the Fed would be reducing rates at least 2 or 3 times through the end of the year. And we would see the economy move strongly ahead to support what we have in terms of double-digit earnings expectations for the S&P 500. So neither of the data points that came out today are consistent with either of those pillars that's been holding up the market since the rally began in October 2023.
Right, that's the PCE data coming out tomorrow that you were just referring to. So we'll get a look at the March inflation data there. But coming back to this GDP report today, I mean, when you're looking at the surface level of slower growth and higher inflation, it doesn't really sound like that soft landing story that we've all been betting on, huh?
Well, not everybody's been betting on that. I think, our view has been that when you look at the major economic indicators, there has been somewhat of a disconnect, meaning that the market was highly dependent upon both interest rates declining and earnings expectations, which were consistent with a booming economy. So if you just want to look at top-down indicators that would give some indications of economic activity, I mean, ISM indices or leading economic indicators, they remain in kind of flattish or, recessionary type levels. They seem to be bouncing or pivoting higher, but not yet to any type of booming economic recovery. So from that perspective, when you look at what's happening from an earnings perspective, you've got essentially flattish sales growth still. You've got profit margins across the S&P 500 stable, but with labor costs continuing to be pressure, potential for a degradation of profit margins. And when you look at what expectations are embedded in the S&P 500, it's essentially mid-single digits revenue growth with double-digit earnings growth. Now, how you get to that 2 times operating leverage when sales growth is relatively anemic outside of things that are tied towards AI and profit margins declining doesn't really reconcile with essentially the expectations that are embedded in earnings expectations, as well as some of the top-down indicators as mentioned via the manufacturing statistics like the PMIs, as well as leading economic indicators.
I'll tell you where to make money. Chipotle Mexican Grill stock's up 4% today, all-time high. People are still buying their tacos and burritos.
It's because they're not letting the employees eat the chicken.
I know, that's exactly right.
That's
we talked
the
about that
driver.
earlier. So, James, how about in the fixed income space here? I can get 5% sitting in 2-year treasuries. Is that a fair trade, or should I go out and maybe take some credit risk here?
No, I think if you look at premiums, and credit premiums or high yield premiums in particular, are consistent with the equity risk premium. And the equity risk premium is nothing more than the anticipated return of stocks versus the risk-free alternative, which is, as you mentioned, yielding 5% right now. So, our view at this point in terms of the market and why we've been very defensive, have re-implemented hedges in our American Select Equity Fund, is the fact that the way we calculate a forward equity risk premium, it's at the level that we last witnessed in early 2000.
Oh boy!
And I hate to say it, right before the crash of 1987.
Yep,
so
both
credit premiums and equity risk premiums leave no margin of safety, which is something that either leads to a flat equity market or potentially some type of major drawdown if there's the implementation or instigation of some type of catalyst.
Looking at the 2-year yield coming up on 5% on the day, got to think if maybe, you didn't cash in on it when it was 5.2 in October, maybe a little bit of a second chance here. Is this a good level?
Yeah, I think that's very important because the expectations are that, the Fed, even if they do see continuing economic weakness, or maybe there is some type of financial event in regional banks, or even the further escalation of some kind of geopolitical crisis, which would really be the only cover that the Fed would have to reduce interest rates. I would tell people that, if you're relying upon a reduction in interest rates from these levels, be careful what you wish for, because when you look at market drawdowns over many periods of time, some of the most significant market drawdowns happen when the Fed is aggressively easing in response to a crisis. And our view going into the year was that the Fed was not going to reduce rates unless there was actually the introduction of a slower economic environment or a crisis. So to lock in, 5.2% yield at this point in time, I think is, a wise choice vis-a-vis other investment alternatives right now, particularly since the premium that you're being paid for owning equities as well as owning credit is, in essence, zero.
All right, James. Thanks so much for joining us there. James Abate, Managing Director and Chief Investment Officer for Center Asset Management. Decidedly conservative outlook there, and that is being borne out today with the market down. I don't know. I guess you could look at today's data and say, all right, economy's slowing down. Maybe the Fed will, in fact, cut rates. They're not worried about an overheating economy, but you did have that inflation print that kind of
That really is just taking the entire story today. And, as we've been saying, some of these underlying measures of growth underneath the GDP figure still pretty strong. So, and I'm sure the Fed will definitely be attuned to some of those as well.
I will stay on top of that here. S&P down 1.25% here, 62 points, 5,008 is the level. This is Bloomberg.
company news headlines on Bloomberg Radio.
The Justice Department could decide by the first week of June whether or not to tear up a controversial deferred prosecution agreement with Boeing. This, according to lawyers for the families of people killed in 2 crashes of 737 MAX jets. Prosecutors met with the families in Washington to share information about the timing of their probe. The relatives have criticized the department's 2021 deal that would allow Boeing to escape criminal charges over the crashes in 2018 and 2019 that killed 346 people if the company met certain conditions. But Boeing's most recent mishap, that's the door blowout with Alaska Airlines, that sparked a criminal probe of the company's practices, also raised the possibility of ditching that DPA. Allstate, they're going to end their years-long pause on underwriting in California as soon as the state regulator adopts proposed regulatory changes to make it easier for insurers to raise rates. This is the first time a large property insurer has publicly promised to return to the California market. Disaster-prone state, I guess that's safe to say. More than half of the major property insurers in California have cut back on business in the state in recent years in response to the increasing severity of wildfires. And OnStar, remember that? That's, you crash into a ditch and it alerts somebody. GM has ended its OnStar Smart Driver program. Customers complained it violated their privacy. OnStar had cut deals with LexisNexis and Veris to share personal driving data as part of that program, which they then shared with insurance companies. And that's a look at your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, markets are moving today on the back of that GDP print. The S&P 500's off 1.2%, NASDAQ's off 1.6%. Yields are higher. 10-year Treasury up 6 basis points, 4.70%. The 2-year right at that 5% level. Keep an eye on that. With our news in New York City, here is Michael Barr.
Thank you very much, Paul, Molly, and John. The Supreme Court this morning is hearing arguments over the extent of immunity from criminal prosecution for former presidents. Former President Trump says presidents must enjoy absolute immunity. John Sauer, arguing on behalf of Trump, suggested this morning that the idea of a lack of immunity has come about relatively recently, but Justice Ketanji Brown Jackson sees American history differently.
I understood that every president from the beginning of time, essentially, has understood that there was a threat of prosecution, if for no other reason than the Constitution suggests that they can be prosecuted after impeachment.
Meanwhile, Donald Trump is back in a New York City courtroom as his hush money trial continues. New York's highest court has ordered a new trial for Harvey Weinstein. The New York Court of Appeals said the judge in Weinstein's 2020 rape case made several improper rulings that prevented the 72-year-old disgraced movie mogul from getting a fair trial. That included allowing women to testify about allegations that were not part of the case. Weinstein is serving a 23-year sentence in New York. He was convicted in 2022 of rape in Los Angeles and sentenced to 16 years in prison there. The first cargo ship passed through a newly opened deep water channel in Baltimore today after being stuck in the harbor since the Francis Scott Key Bridge collapsed 4 weeks ago. Bloomberg's Karen Moscow has more.
The Balsa 94, a bulk carrier sailing under a Panama flag, passed through the new 35-foot channel headed for St. John, Canada. It was guided by 2 tugboats, one in front and one behind. It passed slowly by the wreckage of the Francis Scott Key Bridge, as well as the Dolly, the massive container ship that caused the bridge to collapse when it slammed into one of its support columns. The new channel will remain open until Monday or Tuesday. It will then close again until roughly May 10th, while crews work to remove steel from the Dolly and refloat the ship. Karen Moscow, Bloomberg Radio.
Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Michael Barr, and this is Bloomberg. Paul, Molly, John.
All right, Michael Barr, thank you so much. We appreciate that. All right, Molly, fans of the original Alien will get to see Sigourney Weaver battle a deadly extraterrestrial on big screens all over again this weekend. The picture is being released for a limited run across the U.S. on Friday. 45 years after its debut, in part to stoke interest in Alien Romulus, a new installment of the franchise set for theaters in August. The sci-fi classic is not alone. Sony Pictures is releasing 8 Spider-Man films, staggering them in a weekly promotion that began on April 15th. So what's happening here is, with a dearth of new pictures contributing to a slump in ticket sales, studios are releasing past hits in greater numbers. Some 38 old movies were scheduled to hit the theaters through the end of April, a third more than last year, and that's according to data from ComScore.
Yeah, just give them another run. Why not? I mean, use the stock that you have, right? Just, see if people come out, spend, God, what is it for a movie ticket right now? Like almost $20 probably for an adult ticket?
Can I ask the
More than
rude
that?
question?
Sure.
Please
How old
do.
is Sigourney Weaver?
I don't know.
Might be older than you, John.
I don't know.
Whoa,
I don't-
touche, Molly.
I don't know if she's in the new version here, because there's not much. What you're seeing here is a surge, because there's not much commercial product in the market. That says Ray Nutt, Chief Executive Officer of Fathom Events, a distributor owned by 3 of the biggest theater chains that regularly releases classic films. I do believe exhibitors are trying to fill a slow time in the marketplace. So the seasonality of the movie businesses, big summer season, that's where they generate most of their box office. Secondarily, time around the holidays between Thanksgiving and Christmas, and that's where they make roughly 80% of their revenue is in those 2 time periods. So here we are a little bit before summer, so let's put some old films in there.
Yeah, why not?
Why
right?
not? Sell some popcorn, sell some soda and some candy and stuff like that. Good stuff. All right, we're going to balance of power with Joe Matthew from Washington, D.C. He's got the latest of all things in D.C., and that starts right now.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
It's the worst of both worlds. Welcome to the fastest show in politics, as the latest readings on the economy bring a sense of doom to the markets and new reasons to worry at the White House. We're going to talk it out in a moment with Bloomberg economics editor Michael McKee, who's in New York. It is the most pivotal day yet in Donald Trump's legal journey here, and we'll review arguments before the Supreme Court today on Donald Trump's claims of presidential immunity with constitutional law attorney Robert McWhirter, with analysis on this important day from our signature panel. They're both with us, Rick Davis and Gidi Shanzano, Bloomberg Politics contributors. We start, as always, on Wall Street. If we dare, let's get up to date on things right now with John Tucker. How's it look, John?
All right, Joe. This one actually has political as well as market implications. What do you get when you add a slowing economy and higher inflation? A lot of people upset. Market reaction, a sell-off in stocks, a jump in rates. 9 of the 11 major industry groups in the S&P 500 right now, they are lower. The biggest drag that's coming from communication services, and that is the home to, yeah, you guessed it, Meta Platforms. After their results, after the close of regular trading yesterday, they announced, among other things, they're going to spend more than investors were hoping they would. Blair Rucci, the chief U.S. economist at T. Rowe Price, she reacted to some of the data we got this morning, the big piece of data, the GDP report.
Overall, it's a report that says to the Fed the economy is not reaccelerating. It's slowing from the pace of growth in the second half of last year. That is telling the Fed that those interest rate increases may be having some effect in slowing demand, particularly for goods, but it's not alarming by any means.
Well, the S&P 500 right now 53 points lower, and that's down 1%. We're at 5,018 on the index. The Dow Jones Industrial Average 543 points lower, that's down 1.4%, and the Nasdaq Composite Index right now down 229 points. That's a decline of 1.5%. The yields, the 2-year up 6 basis points, were just around 5%, 499. The 10-year yield is up 6 basis points. That's at 470. And up next, in the batter's box, both Microsoft and Alphabet, they're set to deliver what are seen as pivotal reports after the close of regular trading today. We check the markets for you all day long right here on Bloomberg I'm John Tucker, and that's your Bloomberg Business Flash. Balance of Power continues with Joe Matthew.
John Tucker doing the job today in New York. It's great to have you, John, walking us through a tough-looking market here. My goodness. The headline in the terminal says it all. Stocks hit as GDP brings worst of both worlds. Yeah, pivotal. I keep hearing the word pivotal all day long here. Pivotal day for the markets, pivotal day for earnings after the bell, pivotal day for Donald Trump's legal journey here in Washington, the immunity claim before the Supreme Court. We're going to get to that a little bit later on today. But we have a problem, everybody. Certainly the White House can see it. Obviously, the stock market can. What's the worst of both worlds? Well, you get an economy that's slowing down more than you think and prices that go up more than you expect. And so we had to talk to the professor, Michael McKee, here today, Bloomberg economics editor, to help us understand what we're really talking about. Michael has not only a keen sense of the economy, but understands politics and the cross currents here. And Michael, it's great to have you. I wonder, we're going to start hearing Jimmy Carter comparisons again. What is the definition, Professor, of stagflation? When do we say that is real?
Hopefully before the killer rabbit appears on the pond. But the problem is economists are going to know what I mean when I say this is not stagflation, because it's the numbers under the hood of the headline GDP number show that the economy is stronger than it looks. But politically, when you print a headline in the Tulsa World that says, economy slows to less than half of what it was in the fourth quarter, then you've got a sales problem for the president. So it's not stagflation, which is when unemployment is rising, growth is falling, and inflation is rising. What it is a sort of a confusing picture on GDP, but with the possibility that inflation is rising. So inflation more than it is at this point a stagflation.
Great explanation. Does this justify the re-rating that we're seeing, maybe not even on Wall Street, but when it comes to the Fed? Obviously, expectations have shifted dramatically since 8:30 this morning.
Yeah, you get the swaps markets and the Fed funds market reacting to these sorts of things very volatilely, but in this case, I don't think it's something that's going to necessarily last unless we get confirming evidence. Right now, the markets have written off the idea of any rate cut until we get to December, and if tomorrow we get the monthly PCE inflation data, and if we get a bad number there, they'll probably push us into next year, if at all. But things can change on a month-to-month basis, as we have seen. Last month, you remember how we got shocked by the number of jobs that were created. We get that, and then we get a big drop in the number of jobs, and then people start pricing cuts back in again. So I wouldn't put too much emphasis on that. The Fed is going to do what the Fed's going to do, and they don't know what that is at the moment. And they'll go month by month and try to figure it out.
Well, if I'm reading you correctly, I can hear you and I can see you here on YouTube. You're not concerned at all. This is feeling like an overreaction as I talk to Michael McKee.
Well, I don't want to characterize the markets. Markets tend to, as a
I just
normal
mean
thing,
even the
overreact.
editorial reaction. Like just the analysis today. There's a lot of hair on fire.
Yeah, you're going to see that, especially on the political side, because they've got to deal with headline numbers much more than underneath. The inflation number is a bit concerning. The question is did it go up because January and February were revised higher? Or did it go up because tomorrow, when we get the March numbers are going to be significantly higher? If the March numbers come in as anticipated, it may be more of a statistical fluke that we saw faster than anticipated inflation in the first quarter. Remember, that's a quarterly number that we got today. And the more recent number, March number, might be better. The growth numbers, I don't particularly worry about, because consumer spending was down a little bit, but still relatively strong. Business spending was relatively strong. The problem came in having the inventory build be smaller than much smaller than anticipated, which could mean that companies have to make more stuff going forward and increase the economy, and because we also saw a real decline in what they call net exports, the number of exports minus imports. We imported a lot, and we didn't export very much, which may be due to the strong dollar. And if the Fed doesn't cut rates, the dollar probably only gets stronger. So that works that way. One other thing that was really interesting is that federal government spending fell for the first time in almost 2 years, especially defense spending. So it may be that the delay in getting the budget and getting the Ukraine-Israel military aid packages through caused that, and we might get a bump up in the current quarter.
How about that? See, that's why you read down to the 7th paragraph, or you have Michael McKee take a walk with you. That's fascinating, Michael. I really appreciate the time today, as always. Bloomberg economics editor Michael McKee in New York, throwing a little bit of cold water on the freak out. But as Michael says, let's give it a minute, and tomorrow's data will be awfully important here. I'm Joe Matthew in Washington. We're going to keep tabs on the markets for you. You can see that right now if you're with us on YouTube. Go there, search Bloomberg Global News, and find our live stream. The major index is down 1 to 1.5%, and a lot of red across the board today following the data, and we'll keep you posted on things. John Tucker's got markets covered for you in New York as well. As we talk about politics, we've always got our eyes on Wall Street for you. And in the case of today, a courtroom in New York and the Supreme Court here in Washington. This is a heck of a day for Donald Trump. I'm not even done there. I haven't mentioned Michigan yet here. There's like a triple split screen for the former president. Arguments are being heard today before the Supreme Court on the presidential immunity claim. This is what will either prevent or precede Jack Smith's January 6th trial here in Washington, even as Donald Trump goes through the criminal trial in New York, the hush money trial. And he spoke from New York this morning. Remember, he's got to be in the courthouse for that, so not in Washington today. But he spoke in advance of the arguments in the Supreme Court. Let's listen to what he said.
We have a big case today. This judge isn't allowing me to go. We have a big case today in the Supreme Court on presidential immunity. A president has to have immunity. If you don't have immunity, you just have a ceremonial president.
Donald Trump stopping on his way to the courthouse earlier today to talk with workers, a lot of whom were wearing red MAGA hats, and reporters who were across the street making a little moment there on the campaign trail. But if you're actually paying attention, you can hear these arguments. I realize you don't have cameras in the courtroom, but we've been listening to the conversation inside the Supreme Court, and we're going to talk in a moment with Robert McWhirter about this. What I read is a bad sign for Jack Smith on the terminal. Our top live coverage has been excellent today. If you want to follow the bouncing ball here in some pretty dense material, the Chief Justice, Justice Roberts, criticizing the D.C. Court of Appeals today. Its decision that a president can be prosecuted for his official acts, quote, because the fact of the prosecution means that the former president has allegedly acted in defiance, unquote. Roberts said such a broad statement concerns him. As we read the tea leaves, it's great to have constitutional law attorney Robert McWhirter back with us. Robert, thank you for joining. What are you gleaning from the arguments today?
Well, I think you just said it. It's like reading tea leaves. Often justices will say stuff in oral arguments because they want to hear what the responses are, and they're not always signaling where they're going to go. Look, just in terms of this case in general, I think it's kind of good to keep in mind, in a way, Donald Trump has already won. His goal was to delay Jack Smith's prosecution, and he effectively did so by getting the Supreme Court to even take this case. I think most people would say that Trump's legal arguments are rather weak. The court may modify that and give a few things, but if you listen to Donald Trump and his claims for absolute immunity, what he is literally saying is that a president can do anything, so that if Joe Biden was to order SEAL Team 6 to kill Donald Trump and take him out, Joe Biden could not be prosecuted, according to Donald Trump's own arguments. Well, I don't think most of us want to live in America with the president with that kind of power. And it's kind of interesting because on the campaign trail, Donald Trump keeps saying, Joe Biden needs to be criminally prosecuted for what he's doing to me now. Well, that kind of cuts against Trump's argument in the Supreme Court, where a president's not supposed to be criminally prosecuted for anything.
How true.
You know, and I just have to say, just to give a little history here, you know, America began, of course, with the Declaration of Independence. You know, we hold these truths to be self-evident that all men are created equal.
Yeah.
Everyone's equal before the law. But, you know, right after that first part of the Declaration, the preamble, it's an indictment of King George the Third for his criminal acts, which basically disqualified him from being our sovereign. That's why we went on a course. Well, one of those indictments is he has incited domestic insurrection among us. Well, that was the indictment of King George. You know, with that history and the charge of Donald Trump for inciting domestic insurrection among us, which is what he has already been found to have done with the January 6th Commission and others, I would find it shocking that a Supreme Court would cut out this broad immunity for him, given our history that we didn't want to elect King George. We got rid of King George, and that's one of the reasons why.
Really great analysis, Robert. You mentioned the timeline here, and I realize it's a win for Donald Trump to delay anything at this point with November in mind, but it wouldn't be outside of the realm for the court to rule on this by June, and that would leave time, presumably, for Jack Smith's trial, wouldn't it?
Well, yes. You know, in the United States versus Nixon, they ruled in 16 days, which, okay, if you wait 16 days for a haircut, that's a heck of a long time, but that is blazingly fast for the Supreme Court. So just to give some sense of how the court does its work. So if they ruled before June, it would be considered blazingly fast. Now, I hope the court does, and I hope we get some answer to this. But, you know, again, to go back to history, mentioning Richard Nixon, remember he had that interview with David Frost where he said, and it was a real gaffe on his part, but he said, you know, when the president does it, that means it's not illegal. Well, everybody widely condemned that and legally condemned that. And so I don't see how Donald Trump's arguments should get much more attention or credence than Richard Nixon's arguments did, you know, some 40 years ago, 50 years ago.
You know, Richard Nixon is an idol of Donald Trump's, and Richard Nixon told Donald Trump reportedly that he wished he had fought harder at the time instead of resigning. Just for the sake of everyone following along on their home games here, Robert, for our audience to understand, what are the options for the court, and do they include just sending this back to the appeals court?
Oh, yes. They could actually keep this thing going for a long time. The options is they could sit on it for months and months. They could even kick it off to the next year. The court can has a lot of power in terms of when this thing, and everything is on hold until they do so. They can move quickly or they can move slowly. And historically speaking, they have done both things in different cases. They could send it back to the D.C. Court of Appeals to modify the judgment somehow. They could create an entirely new test about, well, here's when a president might be prosecuted, here's when a president might not be. It's going to be hard. You're going to get, I would guess, what's called a plurality decision. Even if Trump wins, it would be what's called a plurality, which means the justices won't all agree on the same reasoning about why. And you're going to have some very vigorous dissents. And frankly, you're going to get some interesting alignments. You know, you can expect the so-called liberal justices will go against this, but you might get some of the others that will join them for matters of just originalism, outlining, kind of following some version of the argument I just gave about what America was intended to be.
I've only got a minute left, Robert, and I don't want to have to cut you off here, but you're so good at framing the significance of this historically. This ruling will end up applying to much more than Donald Trump. This is going to impact the presidency as we know it, right?
Yes, and that's really the most frightening thing for me. It's not just Donald Trump and his peccadillos. It's what it means for us in the future going forward as a democracy. And, you know, the Constitution actually gives the president very few direct powers. Most power a president has comes from acts of Congress. And that was by design. We wanted to limit that power. We didn't want a king of the United States. And George Washington set that precedent. And that's something we need to keep in mind, the implications for the future.
Love talking with Robert McWhirter. We learn a lot, as always, with your expertise, Robert. Thanks for being with us. Criminal and constitutional law attorney helping us understand the significance of these arguments. And we'll have more on this with our panel a little bit later on. Rick and Jeannie are with us as we bring you news live from Washington. I'm Joe Matthew. This is Bloomberg.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, it may not be stagflation when you look under the hood, but traders are still pretty worried about the data we got today. The GDP report showing a slowing economy and a higher rate of inflation. Toss into the mix some disappointing earnings. It's a recipe for a stock sell-off and for yields to push higher. Traders are also saying a rate cut from the Fed probably is not going to happen until the end of the year. Meta Platforms, the worst performing stock in the S&P 500 right now, down 12% after it said in its earnings report it was going to spend more than the investors feel comfortable about. After the close of regular trading, we're going to hear from two more of the so-called Magnificent Seven. That's Microsoft and Google parent Alphabet. Right now, the S&P 500, 45 points lower. That's down 0.9%, 5,026 on the index. The Dow Jones Industrial Average is 487 points lower. That's down 1.25%. The Nasdaq Composite Index, 202 points lower. That's down 1.3%. Yields popping higher. The two-year, which is more policy reactive, that's up just about 7 basis points. Let's call it 5%, round that off. 10-year yield right now, that's up 6 basis points. That is at 4.70. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Balance of Power continues with Joe Matthew.
John Tucker, thank you. Yet somehow NVIDIA is higher. Just funny to see this one little blip of green on the screen. We'll be in touch with John for the duration here, as you would expect, with our market coverage on Bloomberg. And we want to take a slightly deeper dive right now because this is a bit concerning, and it has a lot to do with the data out of Washington this morning. GDP freaked everybody out, as we were discussing with Michael McKee earlier. Growth slowing, prices rising. You are hearing the word stagflation, even though Professor McKee explained to us why that is incorrect today. Nora Melinda is watching the markets for us, Bloomberg Equities reporter at World Headquarters in New York. Nora, it's lovely to see you, and I appreciate your time. How would you frame this market today? What do we need to know?
So we are seeing a pretty brutal sell-off this afternoon, and this is all, as you mentioned, coming after the results that we've been getting, the earnings results, as well as that data that we saw this morning, specifically with GDP and the significant slowdown that we've been seeing in terms of the economy. So, of course, this is mainly led by Meta. We did get some earnings today that were not the prettiest. I mean, we did hear some great things on the profit and revenue side, but it's really the outlook that investors are really fixated on here. And that's after the company said that it expects to spend billions of dollars more than expected on AI this year. And it has investors quite apprehensive, especially as we think about AI and the outlook for tech stocks, with Alphabet and Microsoft slated to report after the close today.
Yeah, right. Yet I still say somehow NVIDIA finds a way to defy gravity. Nora, that's tough, boy. 12% on Meta. We're seeing Microsoft take a good knock as well. People are already freaked out about earnings coming up after the bell tonight. What are we in for?
I mean, I think that's what the focus is really going to be on, about what does the long-term outlook look like for AI, because of course that has been the big story of this year, specifically in pertaining to technology stocks. So when we look at Microsoft and Alphabet, that's what analysts and investors are wanting to hear. They want some sense of reassurance from these leaders and the CEOs of these companies that it is going to be a positive outlook looking forward.
We get them both tonight, right, after 4?
We do?
Yeah, so the whole building's going to shake when Microsoft and Alphabet come. Keep your eyes on the terminal. And Nora Melinda, it's great to see you, Nora. Don't be a stranger. Thank you for helping us out today in this kind of painful sell-off with a direct line to Washington, the economy, and a whole new reason to worry for Joe Biden, who, of course, just yesterday was taking a victory lap on the foreign aid bill. He signed it yesterday, and we brought you his remarks here on Bloomberg. And the line from the president was, the shipment goes out within hours, because they had, of course, prepared some hardware before in advance of this legislation passing. Tony Capaccio saw it coming a mile away, and he's got his hands on the shopping list, at least for some of the material that's already making its way out of here. Our Pentagon reporter has crossed the Potomac to join us once again on Balance of Power. Great to see you, sir. Thanks for coming over. This first tranche is about $1 billion that we sent over. What's inside?
For one thing, it's not the biggest tranche we've ever sent over. We sent over a $2.3 billion tranche in January of 2022. So, but this is 2023, excuse me. So, but this is a lot of defensive weapons in here. Claymore anti-personnel mines, and these 155 rounds that launch cluster munitions, all stuff that the human rights groups would have raised hell about a year ago.
And did.
And yeah, now it's part of the regular.
How do these mines work? These are the ones that jump up when you...
They can be mined. The claymores can be from remote control or tripwires.
Okay.
But the point being, these are defensive weapons at the moment to stymie Russia's gains, which are seen as incremental at the moment by the Pentagon, but gains nonetheless. It's not a lot of offensive weapons like more tanks to pound through Russian lines.
Yeah.
There's night vision goggles, which would be for night defensive actions and small unit tactics. Lots of 155s, these Depicum munitions, but it's basically, you get the sense this is basically, so they're not rationing, they can fire away in artillery battles, but not to launch breakout maneuvers in terms of the Ukrainians.
And this stuff is in hand already? Are they firing these shells today?
No, I mean, the U.S. has a lot of 155s in stock in Europe. Those would be the ones to arrive within days.
So we had stockpiles in theater.
Yeah.
So that presumably is the first to arrive.
That will be the first to arrive in the next few days. A Pentagon official talked to reporters on background today about a lot of this.
Got it. This is fascinating. The ATACMS. Tell us about this, because that went before the bill.
So this is like this is an amazing in a town that has no secrets.
Yeah, how about
ATACMS was authorized by Biden in February. This is all from the NSC yesterday. They were chirping like birds on the record about this. The president announced, authorized them in February. They were part of this March PDA. It was like $350 million of the found money.
Yes.
They were part of that, and then they were delivered shortly thereafter. Best kept secret. They leaked part of it yesterday to the New York Times, U.S. official, and then a few minutes later, the White House acknowledged on the record.
Amazing.
Pentagon spokespeople, he actually wanted to be quoted on saying they've gone over there, which is unprecedented. Wow. Yeah. So it's a well-kept secret, but the optics aside, those are going to allow Ukraine to hit deep into Crimea, and possibly nail that big bridge that Putin loves. Right. But it's a big deal. Very good fact here. Jake Sullivan said increased production allowed us to do this. So there's a Lockheed story here somewhere buried that they haven't talked about yet.
Who in Lockheed makes the ATACMS?
Yeah, they make them down in Arkansas. So that's a good story.
If anyone gets that story, it'll be you, I bet. You mentioned hitting the bridge. We heard Evelyn Farkas talk about that as well. Is the U.S. going to change its posture on offensive weaponry, on Ukraine crossing the border and keeping Russia from advancing?
We're talking about sovereign Ukraine territory. Now, Ukraine is considered sovereign Ukraine territory. They're not going to be able to, and they haven't used these ATACMS or longer-range systems to fire into Mother Russia itself. No, that would be violating. And the president, Jake Sullivan, I guess, said it yesterday, they've lived up to their words over the last couple of years. You remember all the hand-wringing about this?
Absolutely, sure.
This is going to be escalatory. It's going to lead to nuclear holocaust.
We're years into this thing, and we're told they're close to losing.
So everything that
nobody's keeping Israel from sending rockets into Gaza.
That's part of it too. But there was a lot of hand-wringing about every weapon that we were sending to Ukraine, and that's all gone now.
Yeah.
So I think the Pentagon official cautioned today. This person did not expect to see any major offensives anytime soon by the Ukrainians.
Interesting.
Ukrainians,
We're talking 10 minutes here about Ukraine. How come we're hearing so little about what's inside the Israel package?
It's always lips shut about Israel. It's always leak, which we're good at getting some of those.
Okay.
But this has about 14,000 Tamar interceptors. This is money we're going to pay Israel so they can buy them from their industries. Like 14,000 interceptors for the Iron Dome, and like another 100 launchers for the Iron Dome. They've got like 10 launchers. I think let me get this right. I think it's about 100 launchers now, and it would double it to another 100 launchers. Sure. Excuse me if I don't have the exact, but
not at all.
That's it. That's the big parts of it for Iron Dome, and it'd be built in Israel. The United States is building in Arkansas, building a Tamar plant with Israeli aircraft industries in Arkansas. So there's going to be production.
Raytheon's tied to that, or who's the U.S. partner?
Raytheon is tied to that. Yeah.
Interesting. You're like Doc Brown. I'm sorry I didn't have time to build this to scale. It's no privacy. Whether it's 100, we actually got the story. What are you watching for then? The next headline.
The next headline is going to be
on weapons for either of these.
Patriot missiles. Yeah. They were not in this package. There's going to be the Ukraine Security the Ukraine Contact Group meets virtually tomorrow. It's their second anniversary. They've been meeting for 2 years now. And Patriots are going to be discussed in terms of where to source them. But they are not part of this package that was announced yesterday.
Do you envision in our last moment here, specific to Ukraine, they've been waiting for so long. We read stories recently about troops or artillery units without shells for a month. Are things about to light up on the front lines when all this stuff arrives?
That's clearly my impression, too. Light up is a good way to look at it, yeah. And I think they're going to do a lot of night attacks, too. Drones have neutralized the whole concept of maneuver. They've neutralized it for the Russians and the Ukrainians. So they can't use these combined arms tactics in open fields, open daylight, because drones have largely neutralized that advantage that the U.S. has trained for and trained the Ukrainians on. So I think there'd be a lot more night maneuvers, night fighting.
With the U.S. helping with logistics
NVG,
and intelligence.
night vision goggles, and night attack. The ATACMS are going to probably be used at night a lot.
Fascinating. These are the headlines that will be written a couple of weeks from now, and you have the opportunity to hear it first from Tony Capaccio. And they must love seeing you coming at the Pentagon. talking about leaking like a sieve. You're a piece of work. Thank you for coming to talk to us, as always. Great reporting on the terminal and at Bloomberg.com. Look for Tony Capaccio because he finds out about it first. I'm Joe Matthew in Washington. We've got a lot to talk about today with our panel, and Rick Davis and Jeannie Shanzano are with us. Arguments before the Supreme Court, Donald Trump immunity, criminal court, New York, Donald Trump hush money case, data out today, economic concerns, markets down sharply. There's the baseline. We'll talk to Rick and Jeannie coming up in a moment after we check world and national news. Let's do that right now with Amy Morris in the Bloomberg 99.1 newsroom in Washington. Hi, Amy.
Hi, Joe. It was a stunning reversal. The New York Court of Appeals overturning the 2020 conviction of former movie producer Harvey Weinstein. The appeals court determined Weinstein didn't get a fair trial based in part on prosecutors calling women as witnesses to testify against him, but whose accusations weren't really part of the charges against him. He's also serving a 16-year sentence for rape in California. Donald Trump returned to court this morning as witness testimony in his hush money trial ready for a third day. Former tabloid publisher David Pecker took the stand earlier this week, testifying about his longtime friendship with Trump and a pledge that he made to be his eyes and ears for the campaign back in 2016. Pecker's back on the stand today. And that trial is ongoing. At the same time, the U.S. Supreme Court heard arguments in Washington over whether Donald Trump should be immune from prosecution for actions he took during his time as president. Justice Samuel Alito asked Trump's attorneys whether the country really needs to establish total presidential immunity to achieve a properly functioning presidency.
My question is whether the very robust form of immunity that you're advocating is really necessary.
Trump says he can't be prosecuted for actions he took on January 6, 2021. Special counsel Jack Smith says Trump wasn't acting as president, but as a failed candidate. Rudy Giuliani, Mark Meadows, and 16 other allies of Donald Trump have also been indicted in Arizona for their roles in an attempt to overturn Trump's loss in the 2020 election. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Traders focused on the data and earnings. The GDP report showing a significant slowdown in the world's biggest economy and persistent inflation pressures. That's leading to the risk-off mood we're seeing today. Worst performing stock in the S&P 500, that's going to belong to Meta Platforms. Of course, they reported after the close of regular trading last night. They sank on plans to spend more than previously anticipated. You look at Meta shares right now, down 12%, $433 per share and some change there. Some disappointing earnings also from Caterpillar. That is weighing on the Dow Jones Industrial Average right now. Still, overall, David Sowerby at Ancora Advisors remains pretty positive about company results.
We're going to see free cash flow growth for the S&P 500 of 14 to 15%. That's still a very good backdrop for portfolio management, even in the face of slower GDP, higher inflation.
And right now, the S&P 500, 45 points lower. That's down 0.9%. We're at 5,026 on the index. The Dow Jones Industrial Average, 480 points lower. That's down 1.25%. The Nasdaq Composite Index, 207 points lower. That's down 1.3%. And now to the yields because of that economic data. Right now, the 2-year is up 5 basis points. That's at 4.98. The 10-year is up 5 basis points. That's at 4.69. We should also note that traders pushing back the anticipation of Fed rate cuts. Remember, it used to be June. Now they're looking at the first rate cut sometime in December. And also, after the close of regular trading today, 2 more members of the cohort we know as the Magnificent Seven, they report. We're talking about, of course, Microsoft and Google's parent, Alphabet. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Balance of Power continues with Joe Matthew.
John Tucker at the lunch hour. We thank you. With the fun news from Wall Street, we'll be back to John a bit later, see how things are going here. A Maalox lunch for Jack Smith today in Washington. This is incredible what we're hearing coming out of the Supreme Court. Started 10 a.m. arguments in Donald Trump's immunity claim, presidential immunity, before the highest court in the land. Everyone sounds like an expert until the arguments begin, right? And if you're watching our top live blog on the terminal, you are plugged in here with what does not appear to be going in Jack Smith's favor. This is really something. 2.5 hours into the session here. Arguments making it sound like some of the questions and remarks from the justices are very skeptical of Jack Smith's arguments here and the lower court's rulings. As I told you earlier, Chief Justice Roberts criticizing the D.C. Court of Appeals. Such a broad statement concerns me when he talks about presidential immunity. Justice Alito supporting Trump's legal argument, saying it could be destabilizing if presidents are concerned. They could be criminally prosecuted when they leave office. My God, no one would ever leave. Is this already over? June Grasso is not only now an expert on Donald Trump's criminal hush money case, that's the trial underway in New York, but now to this in Washington, and she's with us now from New York, the host of Bloomberg Law. June, how do you read these comments?
You know, you actually did it for me. Jack Smith, I don't know if it's Maalox, Pepto-Bismol, or whatever, but it's not looking good for him. And the most you could say is that they'll perhaps send it back to a lower court, either the D.C. Circuit Court of Appeals or the district court judge. So as you said, the Chief Justice out and out said he's concerned about the D.C. Circuit Court opinion. Justice Alito basically adopting Trump's argument that he's been making outside courthouses, which is, you know, other presidents are going to be afraid of what they're going to do in office if they know they're going to be prosecuted. And Justice Alito saying we'll be like a banana republic. That'll be more destabilizing because presidents won't want to leave office if they know they could be prosecuted. Then you had several of the justices, including Alito, Gorsuch, I think, and Kavanaugh, saying, well, let's not talk about the facts of this case. This, as Gorsuch put it, is going to be a decision for the ages. Let's talk about the broad category here. So you didn't even hear so much about what Trump did here. And then you had several, like Kavanaugh talking about, sometimes it seemed as if they might be saying that presidents should not be, you should not be allowed to criminally prosecute presidents. I mean, it seemed like it was going there, but you never can tell. And then the liberal justices just trying to, you know, shore up the arguments of the attorney representing the special counsel. So it was brutal for the special counsel.
Michael Dreeben, yeah, speaking for the government, Dreeben says maybe motives would factor into the interpretation of whether a president is engaged in criminal activity. We're actually, the government's saying this openly here. June, we've got two very important headlines. Court is wary of broad Trump immunity, but may extend fight. Getting to your point there also, they have wrapped here. They've finished arguments in the immunity case, so we're done as we're speaking here. June, while you're with us, speak to history. In 2020, the court unanimously rejected Donald Trump's claims of absolute immunity. What's different now?
I don't know what's different. I really don't know what's different, because it would seem that, I mean, of course, the Supreme Court has never ruled on whether a president has absolute immunity from prosecution, but the cases before seem to indicate that that's where they might go. And I think most legal scholars looked at this and thought that the court wasn't even going to take this case because of the fact that the D.C. opinion was so thorough. And we all remember that, whether a president who orders SEAL Team 6 to kill a rival could be prosecuted. And here you have, you know, Justice Kagan putting forth things like, well, suppose the president ordered a coup. I mean, you know, blunt examples, while the conservatives were like, let's talk about history and how big this is going to be. And I don't care about the facts here. So, I mean, I'm going to go over it and see if there are any hopeful signs for Jack Smith. But I was surprised, to tell you the truth, that it went this badly, or seemingly went this badly. I will give the disclaimer that every lawyer gives, that you can't tell from the oral arguments which way the case is going to go. But if you listen to Justice Alito, you know which way he wants it to go. So I counted
it
five.
Sure sounds like it.
I counted Justice Alito, Gorsuch, Kavanaugh, the Chief Justice, and of course you don't have to hear from Clarence Thomas to know which way he's going to rule. So it was kind of amazing.
Well, I'll count five. That's hours until June Grasso is on the air with Bloomberg Law, and we'll be better for the fact that you have some time to dig into this, because I want to know what you're going to be talking about later on tonight. We need to get June Grasso an extra hour. Can we get the boss on the phone here? I mean, at least till we're done, because this gag order might come down today as well, right? We're going to have to talk to you about that as soon as it happens, June. We'll stay in touch as always.
I will be here.
Thank you.
I'm not leaving.
Thank you for doing great work in New York. You better not. June Grasso is the host of Bloomberg Law. Let's assemble the panel. They are watching this just like we are, or listening to arguments before the court. Jeannie Shanzano and Rick Davis are with us right now. Bloomberg Politics contributors. I'm not going to try to turn either of you into legal analysts here. Let's stick with the politics at hand. Rick, this looks like it could end up being a very good day for Donald Trump and not so good for Jack Smith. What do you think?
Yeah, it's so hard to read the tea leaves of these comments, and I'm completely confused. I'm, too, going to listen to June's show tonight to try and figure out what's going on, because private buckets of functionality of the presidency, public buckets of that same presidency, how you differentiate what's public, what's private. Obviously it's not going to be a slam dunk for Jack Smith. And the question is, what charges can he continue to press against Donald Trump if they give him half a loaf? So I must admit, I think that this could be a real distraction to what's happening with the court case in New York. But I mean, like, this could really gut Jack Smith's case, which right now there's no real evidence that that's going to happen before the election anyway. So it may be, from those who look at it strictly for its impact on politics, much to do about nothing.
Boy. Jeannie, if Donald Trump, I won't say wins this, it's not like that, but if the court rules in his favor on the immunity claim, sweeping, obviously, impact on the presidency as a whole, but in terms of this campaign, Trump versus Biden, what's the impact?
Well, you know, Joe, I just got out of a Supreme Court class where, you know, I have to tell you, the students were just as baffled as June Grasso as we listened to these oral arguments, because to June's point, this is, of course, a case that many of us as court watchers never expected they would grant cert. Then they did, and then they delayed it, in my mind, to the bitter end. We don't get a decision from them on this likely until late June. So as you're talking about the campaign, whichever way this goes now politically, Donald Trump has already gotten what he wanted, because I'm hard pressed to imagine, especially given the oral arguments today, that Jack Smith is able to move forward with the January 6th trial before the election. And of course, for voters, this is deeply problematic. We've got about 7 out of 10 Americans saying they would have liked the most serious, as they see it, of all the Trump cases, January 6th, to go to trial before the campaign, or before the election rather, so they can make a decision. The Supreme Court effectively robbed them of that when, by the rule of 4 of them agreed at least to grant cert, and they didn't speak to this immediately. And I would just add, the Court of Appeals, the Circuit Court's decision on this was sound. I was stunned they granted cert, and that to me was the first of many bad signs, and today is another bad sign. Jack Smith has got to have his hair on fire given what just occurred in that oral argument.
Wow, I said Maalox's moment. We can go hair on fire. This is sounding worse for Jack Smith by the minute here. Rick, talk about the campaign implications. If Donald Trump can turn around and say, "I told you so" on this one, what does it mean for his overall standing?
Yeah, it's a terrific talking point for Donald Trump, right? Oh, I told you that they were just prosecuting me for political reasons. Supreme Court stands behind me. You can see the speech that he's going to give, or at least the continuous text on Truth Social that he'll plow out, and that will be his platform in New York. This is the same thing, right? I'm immune from this. I don't know why I'm even here. So I think it's one way again that Donald Trump, the trickster, can turn what anybody would see as an embarrassing, horrible moment of being prosecuted for his actions in the presidency into a political advantage for him. And nobody does it better than Donald Trump. So I wouldn't anticipate anything less. He has the ability to demagogue issues like nobody I've ever seen. And this will clearly be part of the overall government conspiracy to deny him the presidency that he believes is rightfully his back in 2020.
Well, would it take 2020 off the table as a campaign issue, Jeannie? Does Joe Biden in that world keep talking about January 6th?
I think he will. I do think it matters a bit what happens. As I'm listening to this oral argument today, I have to say I am stunned by the Chief Justice in particular, the institutionalist that he is always described as, where he seems to be leaning on this. And then you add to that Kavanaugh and Coney Barrett. So, I think those three in particular, but particularly the Chief Justice, are the people to watch. But, I don't think this takes January 6th off the table by any stretch of the imagination. Certainly, Donald Trump is going to keep, as Rick was just talking about, saying that he was robbed. And quite frankly, given the timing of this, the fact that this is delayed, his supporters have a right to say, come on, guys, we're almost at an election. He's the presumptive nominee. How can you say this isn't political? And they have a point given this timing. And then, of course, people who oppose Donald Trump are saying, quite frankly, the same thing. You look at what the indictment by Arizona just yesterday. Why wait so long? 3.5 years. Now you've got him as a presumptive nominee. How can you possibly move forward like this? So I think all around the calendar is the real frustration here. And the slow pace at which the court always moves has made the political reality of this that much more fraught for all of us as voters and citizens.
Yeah. Well, and therefore, Rick Davis, this criminal trial in New York is ever more important. It may well then be the only trial of the 4 that take place either before the election or at all. What significance does that put on Alvin Bragg's case in Manhattan?
Well, certainly from a political perspective, it's the only game in town right now, right? It's the only trial that we think could have an early enough stage impact to convince people if he's either acquitted or if he's convicted, it will have, based on the polling that we've seen, some net effect. It's pretty clear right now that it's denying Donald Trump a chance to go out and campaign in states that otherwise would be important for him to be in. And so it's already having a pretty robust impact on the election. And I would say in a detrimental way to Donald Trump. And I would say, too, there's no evidence that he's been able to replicate the early fundraising success that he has had by using the backdrop of a courthouse to get people to give him donations. And what you label on top of that is more and more lawyers are getting paid because of these things going to trial. And so it's going to continue to drain the campaign treasury. So it's definitely going to have an impact on the politics of the election. The question is, does it all vanish as a negative and become a positive if Donald Trump's acquitted and he can take that to the campaign trail, which is always the danger.
Well, that's his best case scenario. That's the rainbow package for the Trump campaign. What in the world would happen to the polls at that point with Joe Biden already struggling? We have so many questions to ask still, and we'll continue with our panel coming up in hour 2. Great to have Rick Davis and Jeannie Shanzano with us. News breaking as we speak from the Supreme Court, and we'll have a lot more ahead. Greg Storr, our Supreme Court reporter, will join us. Kaylee Lyons will jump into the conversation as well. Constitutional Accountability Center President Elizabeth Wydra, all ahead right here on Bloomberg.
is Balance of Power. Live from Washington, D.C.
Supreme Court justices empathize with Donald Trump's immunity claim. Welcome to the fastest show in politics as we read tea leaves today in arguments that could determine whether Jack Smith's January 6th trial will take place at all. I'm Joe Matthew alongside Kaylee Lines here in Washington, D.C. A remarkable turn of events here, and certainly against the grain when it comes to conventional wisdom in this case, Kaylee. It's not what we were told we might hear today.
No, certainly we are hearing some skepticism among the justices on the court, specifically the liberal justices, around Trump's argument that he should be immune from prosecution, having committed these alleged acts while he was in office in terms of the crimes that Jack Smith has charged him with. The one conservative justice, Amy Coney Barrett, did express some concern about what happens if there is no potential for criminal prosecution, what would stop a president from doing whatever he wants. And that really gets to the root of this, Joe. What's happening today, yes, is tied it's inextricably tied with the fate of Donald Trump himself and whether or not he may go to trial in this case here in Washington, but it also potentially has sweeping ramifications for the office of the presidency, for everyone else moving forward.
It will one way or the other, depending on this court. It's not just Donald Trump we're talking about. This will impact every other president, by the way, including the one who sits in the White House now. So we've got a couple of smart voices coming up today, Kaylee. Of course, Greg Stohr, the best Supreme Court reporter in the country, is here at Bloomberg. He'll be with us at the table. And Elizabeth Wider will join as well with insights. And our political panel is that we've got to remember the political implications here on this presidential race can really not be overstated.
No, especially if what the court decides or decides not to decide, whatever action they take could decide whether or not Trump sees a second trial before that election on November 5th. So we do have a lot coming up on this hour. First, though, as always, we got to begin with a check on the markets because we got a lot of economic data today, and we've seen quite the reaction, haven't we, John Tucker?
Yes, we have, Kaylee, and the reaction is risk on for the most part. In the driver's seat, as you say, that economic data kind of in the passenger seat, I'll say the earnings reports. Traders not too thrilled with either one at this point. So the GDP report that you're talking about this morning showing slowing growth and higher inflation. Now, normally that would mean stagflation, but smarter people tell me if you look under the hood, that's really not the case. And then you had Meta Platforms helping set the negative tone. The worst performing stock in the S&P 500 after its results after the close yesterday, down 11%. Let everybody know it's going to spend more than investors are comfortable with. Spending more is bad for Meta, but Joe, you had to ask this question earlier about NVIDIA. It's what they're spending on. That's AI. So that is good for NVIDIA. And that's why that stock is up today about 3.5% right now. Also, we are waiting for Google parent Alphabet and shares of Microsoft. They're the next to the so-called Magnificent Seven to report, and that's going to happen after the close of regular trading today. Right now, the S&P 500, 37 points lower. That's down 0.75%. We're at 5,034 in the index. The Dow Jones Industrial Average, 453 points lower, down 1.2%. The Nasdaq Composite Index, 1% lower, 162 points lower. The two-year yield, that's up 6 basis points. That's at 4.98. And traders are now guessing the Fed's not going to cut rates until later this year. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. A balance of power continues right now with Joe Matthew and Kaylee Lines.
All right, John Tucker, thank you very much. Pointing out that there is now a chance that we don't get a single Fed rate cut before the election. And we might not get a second Trump trial before the election either, Joe, depending on how the Supreme Court rules after the arguments they heard today.
A massive re-rating from the economy to the political world.
Yes.
And this is why you have to join us every day here on Bloomberg, because it really is remarkable how a narrative can shift overnight. And I think that we can say that's already happened today in the Supreme Court, regardless of how this turns out.
Yeah, we have to keep in mind here for our TV and radio audiences, there were already 2 lower courts that ruled Trump was not immune from prosecution. He had appealed it to the Supreme Court, and everyone was assuming the Supreme Court would decide on similar grounds. Some thought the Supreme Court wouldn't even take up this case at all, which of course they have done. But judging the way the arguments have gone today, maybe it's not as cut and dry as legal analysts initially thought. when they were considering what these 9 justices might do.
A lot of folks told us the Supreme Court wouldn't even take this up at all because the appeals court's case was so strong, so well written. So let's explore some of the nuances here with Greg Storr. As we mentioned, reporting for Bloomberg on the Supreme Court. I can only imagine what your day has been like so far. It's very kind of you to spend some time with us, Greg. It's good to see you. Hearing from Chief Justice Roberts, criticizing the D.C. Court of Appeals decision got everyone's attention today. Is it possible they just kick it down to the court? What kind of options are you weighing in your head as you listen to the justices?
Yeah, the Chief Justice raised that very possibility. Maybe we should kick it back down to the appeals court, or at least we should tell them that reasoning is wrong. Sort of the overall sense in the courtroom was we want to draw a line here between what are official presidential acts and therefore potentially off limits for prosecution and what are not, what are private acts. And the Chief Justice's question and some other questions suggested they didn't think the lower courts had done enough analysis to try to separate out what's in and what's out.
Okay, so it kind of raises this question, if they're just kicking it down to a lower court to ultimately decide, if this is going to become more narrow, just considering the specific things that Trump is charged with and what he did in office, or if I just wonder how narrow or sweeping and broad ultimately this decision is, whether or not it's made by the Supreme Court or by a lower court that they've kicked it back to.
Well, in terms of the big constitutional principles, they're clearly thinking about something sweeping. They really want to think about this, and Justice Kavanaugh talked about, I'm thinking about future presidents and how it's going to affect them. So in terms of the principles, big. In terms of the Trump case, it really kind of depends. Jack Smith, the special counsel, the lawyer in his office, Michael Dreeben, was basically arguing, look, just on stuff that is undisputably private actions by the president, we have plenty to go to trial here. And in fact, they say, even if you think a few things are off limits, let the trial judge sort that out. Let's go ahead right now. So the exact impact of this Supreme Court decision on the Donald Trump trial remains to be seen.
Is it unlikely or possible that the court completely agrees with Donald Trump and the presidency is almost reestablished or reinvented in a certain way?
Yeah, that didn't seem likely. I mean, Donald Trump's arguments were really, really broad that he was making. And even, Clarence Thomas, the very first question out of the box, is basically saying, where is this in the Constitution, this notion of presidential immunity? Yes, he said before, it's not in there. So it's hard to see that Donald Trump wins a decision kicking out the case. That's not likely to happen. But it could be enough to kick the can far enough down the road that we get past the November election, and then if he becomes president, it'd be incredible, but he would have the power to say, Justice Department, drop this case.
Right. So much of this really just comes down to timing more than anything else, Greg. Obviously, the Supreme Court could wait until the last day of their term to rule on this or to issue an opinion on this if they so choose, which would be end of June. If they're just going to kick it down to another court, would they wait that long, or is that something they typically would decide on faster?
Given the scope of the questions, they're clearly thinking about big things, and it's hard to imagine they're going to crank that out in just a matter of a few weeks. And this is the very last argument day of the term, and even under the best case scenario, even if this were an ERISA case or some other kind of narrow area of law, you wouldn't expect the decision until June. So I would be surprised, given the way it went today, if we get a decision before the second half of June.
All right, Greg Storr, Bloomberg Supreme Court reporter, one of the best in the business. Thank you so much. And that just gets to the point, Joe, of the election timeline, because if we're assuming June, and the judge in this case in D.C., Tanya Chutkan, has said, I will give all parties 3 months to prepare at least for trial.
Yes, right.
Realistically, assuming no further delays, which we know is always the effort of Trump's legal defense team, is to delay. It would be incredibly hard, if not just to begin the trial, certainly to finish it before voters are heading to the polls.
So we're back in this world now where we're talking about, imagine a president-elect potentially on trial like that after the election and before the inaugural. This is a possibility, just like so many are. And I'll remind everybody that Donald Trump is actually back in court today, not in the Supreme Court, but in New York, with his criminal trial, the hush money case resuming. Testimony, David Pecker, former National Enquirer publisher, on the stand. And we did hear from Donald Trump outside the courtroom. He stopped to talk to some workers on the side of the road. Kaylee, he talked to some reporters as well. Here he is.
We have a big case today. This judge isn't allowing me to go. We have a big case today in the Supreme Court on presidential immunity. A president has to have immunity. If you don't have immunity, you just have a ceremonial president.
So for more on this, we turn to an expert on constitutional law. Elizabeth Wydra is joining us now. She is the Constitutional Accountability Center president, Supreme Court litigator herself. She's here with us in our Washington, D.C. studio. Elizabeth, thank you so much for being with us. I wonder if you could just first give us your take on what you heard in the arguments today, the kind of questions the justices were asking, the answers they elicited, and ultimately how you think that will shape what ultimately is decided here.
Yeah, I mean, it was really an extraordinary morning at the Supreme Court. Here we have this unprecedented argument for broad, sweeping, permanent immunity from criminal prosecutions for former presidents. We've never heard that before. This is definitely, as many things with Donald Trump, something that's unprecedented. And the justices were extremely skeptical, I would say, most of them, of that broadest possible claim that Donald Trump is making. There did seem to be some interest in providing some protections for presidents for clearly official acts, keeping those in some ways protected from criminal prosecution. But what I heard today from the justices was really a reaffirmation of the very important principle that goes back to the very beginnings of our nation, that no one is above the law, including the president, perhaps especially the president. You know, when our Constitution was drafted, it was very important that our chief executive not be a king. And absolute immunity was something that the king obviously would have enjoyed in Great Britain, and something we did not want to replicate here in the United States. So the Supreme Court, of course, seemed to recognize that, and were troubled by the assertion from Donald Trump's lawyer that he should be entitled to this type of immunity. You know, some of the arguments, line drawing, you know, what actions might be immune from criminal prosecution, right. And that's very few.
Well, speak to us about that, the difference between an official and a private act. How is that being redefined right now?
Yeah, so they were trying very hard not to redefine it, but rather to try to draw lines based on what we already know. So the lawyer for the United States, Michael Dreeben, did a very good job of saying, you know, there's a few core things that only the president can act, for example, recognizing foreign nations or making appointments where that's just beyond the reach of congressional legislation, including criminal laws. But pretty much everything else is fair game, except if there's an as-applied challenge, which is very legalese, but basically it means that otherwise the president can be criminally liable if the facts suggest. One thing that I thought was extremely interesting that came out today was several justices, notably Amy Coney Barrett, questioned Trump's lawyers very closely about the indictment from Jack Smith and said, okay, let's go through some of these acts. You know, what he was trying to, assuming the indictment is correct, and that was an assumption that Trump's lawyer had to do, when he was trying to find these votes, when he was trying to get this fake slate of electors, was that an official presidential act or was that a private act? And Trump's lawyer did concede that several of these indicted actions were private and not official, even under their definition. And what that means is that the trial could go forward even if Trump's argument about official acts were to be accepted. And I'm not sure it will be. It's really
important.
It's very important. Now, of course, the question then gets to timing. But I thought it was really important that there was that concession that the trial could go forward, at least in some way.
Well, and it's worth keeping in mind that while we did see specific questioning around the case here in Washington, he's claimed immunity from prosecution in the documents case as well down in Florida, which is another federal case. So how are all of these things potentially tied together? What implication could there be, not just for the case in Washington, but the case in Florida? And then also, I'm assuming this doesn't apply to the state cases like in Georgia for the election subversion, because there's multiple criminal cases that we're dealing with here.
Yes, it's a little hard to keep track, but for sure. So he's also claiming immunity, exactly right, in the documents case in Florida. You know, I think one of the things that's really important about this case, especially in terms of the timing, is that if it isn't finished before the election, and if Donald Trump were to win re-election, because it's a federal case, presumably once he took over the Justice Department, he could make it go
pardon, and yeah.
Yes, that is not the case, of course, when it comes to this newest Arizona indictment or the New York case that's currently underway, because those are state criminal indictments. So that's an important distinction.
It absolutely is. As we spend time with Elizabeth Wydra, President of the Constitutional Accountability Center, Supreme Court litigator, we have a voice of experience here at the table, and I want to ask you about history, precedent here. 2020, the Supreme Court rejected Donald Trump's claim of absolute immunity. To what extent could that lead us to a decision here?
Yeah, I mean, I think, the court has on many occasions pushed back on the most extreme legal claims that Donald Trump has made. He has often, whether it's the election fraud, so-called election fraud claims that he did bring before courts over and over again, and he was repeatedly rebuked on those, even by judges that he himself appointed.
Yeah.
So he's often lost on these major legal claims that he's brought before
They
the
seem
court.
to be questioning that today, though. Are you sensing that this is a different conversation than we predicted or expected?
I think what they are, concerned about is drawing the line. I think in some ways the indicted actions here, the alleged actions in this particular case, subverting the will of the people, trying to stop the peaceful transfer of power, which go to the very heart of American constitutional democracy, that seems pretty clear that it's not within, the president's duty to take care of the laws, to violate them. But I think they are concerned, as they should be, the Supreme Court, about what happens in the future. So that's what I think a lot of what we heard today was about.
And we have less than a minute left, but to go back to your point about the thinking of the founders when they were actually forming our system of government and writing the Constitution with the separation of powers in 3 different branches, if you are a strict constitutionalist, is there any other way to read the question here and to read the document that would suggest that there is credibility to Trump's argument if you are a strict constitutionalist?
Absolutely not. So there's some times where history is ambiguous. This is not one of those cases. They sold the Constitution to the people in part because this president would not be a king, and in part because he could be potentially criminally liable if he committed crimes, which is a major change from the British system. So if you're an originalist, if you're a strict constitutionalist, there's really only one outcome here, and it's that Trump's really outrageous claim of immunity, unprecedented claim, is rejected.
We're really glad you could come talk to us today. Thank you for being with us on this day of arguments. Elizabeth Wydra, fascinating conversation, especially to hear this from an actual Supreme Court litigator. Keep this conversation in mind as we wait for a ruling in this case. I'm Joe Matthew alongside Kaylee Lyons in Washington. We'll assemble the panel next. The political side of this is ahead, only on Bloomberg.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks are lower, yields are higher, and you can chalk most of that up to the economic data that we got today. The GDP report showing a slowing economy in the U.S. and higher inflation. So that's the worst of both worlds. 7 of the 11 major industry groups in the S&P 500, they're down right now. Worst performing stock in the S&P 500, that's Meta Platforms. After their results after the close on Wednesday, shares down close to 11%. They're spending more on stuff like AI. That's Meta. And then you have companies that sell the hardware that powers AI. Companies like NVIDIA, they're looking up. NVIDIA shares right now climbing about 3.5%. And remember when traders were banking on a March rate cut from the Federal Reserve, then a June rate cut? Well, now it looks like they're banking on December, the end of the year. S&P 500 right now, 42 points lower. That's down to 0.8%. We're at 5,028 on the index. The Dow Jones Industrial Average, 466 points lower. That is down 1.2%. The NASDAQ Composite Index right now is down 187 points. That's about 1.2%. The two-year yield, 6 basis points higher. We're at, well, let's round this up. We're going to say an even 5%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Balance of Power continues with Joe and Kaylee.
John Tucker, thanks. Fun job for John covering the markets today. Fun job for us covering economic data that is apparently causing this whole mess. And it's not only hair on fire in Wall Street, it's also the same in Washington. If you're Joe Biden, you're trying to tell a story about Bidenomics, this is probably not what you were looking for. Indeed, I'm Joe Matthew alongside Kaylee Lyons in Washington. The whole narrative kind of changed at 8:30 this morning. In terms of the economy, changed again at 10 in terms of politics. The Supreme Court, we'll get to that with our panel coming up here. But, you know, we're looking at a pretty tough market, and that feeds directly into the conversation here on the campaign trail, whether this is an economy that people trust Joe Biden to handle.
Yeah, I mean, it's just a day after Bloomberg and Morning Consult released our latest joint poll, which showed that Biden is losing in 6 of the 7 swing states, and the economy is very much front and center. Most voters there do not think it's heading in the right direction, and the data today would suggest maybe it is not, or at least to the extent that economists thought, is growth came in under estimates, but the price index came in over estimates. So sticky inflation, lower growth. What does it all mean for the markets and the Fed? Enda Curran is joining us now, who reports on economics for us here at Bloomberg. So, Enda, obviously we're reassessing the degree to which the Fed may be cutting rates this year. It's getting pushed back and pushed back and pushed back because growth has been strong, inflation has been sticky. If growth is less strong, but inflation is still sticky, how does the Fed come down on that? Do they act to shore up the economy, or do they kill inflation no matter the cost?
Well, there's an element of devil in the detail with today's GDP data, right, Kelly? So the headline is that the economy grew much slower than expected in the first quarter. That's the headline. But inside the detail, pretty technical stuff, the slowdown is really because the U.S. was importing more goods than it was exporting. That detracts from growth. So there's a kind of a mathematical calculation going on. Headline GDP weaker because of what's going on with trade data. The rest of the parts of GDP were actually okay. Consumer spending okay. Spending on services increased. So the economy is ticking over at an okay clip. But now within those numbers were some pretty scary inflation data for sure. The core inflation reading came in strong. So what I'm saying is the growth story is not as bad as it looks, but the inflation story wasn't. The inflation data was not good, and that's why rates will stay high.
Michael McKee was explaining earlier that's also why we're not going to call this stagflation. You don't have all the ingredients here, and the job market remains the exception to every rule. It's just powering ahead, which has been a real gift for this administration. But when you consider the reaction on Wall Street and what we're seeing in terms of a rethink on what the Fed is going to do, what are we going to hear next week?
So I was over at our colleague Ed Harrison's desk watching the live pricing on the bets for Fed rate cuts, changing in front of our eyes, paring it all the way back. They're betting now
in the minutes after 8:30.
That's right, and they're now betting on maybe one rate cut this year, 125 base point rate cut this year. So that's not a lot of relief if you're a small business or a household, and that of course plays into the political cycle as well. You now have a headline of slowing growth, even though I'm saying it's technical, but you've got the headline that the economy is slowing down. At the same time, the inflation story is not technical, that's real. That still hasn't come back to target. So that's not a great combination, I think, for the administration in the current cycle.
That's for sure.
All right. I just want to point out as well that we always consider with the Fed financial conditions, because that's what they're trying to do, is have tighter conditions. You have a bond market selling off and a stock market selling off. Technically, conditions are tightening.
Doing the job.
So maybe it is doing a little bit more work for the Fed, and I just wonder how we need to consider that in our calculations.
What's old is new again. Absolutely. Thanks, and for being with us on a confusing day when it comes to data, although the market seems to think it's got things figured out. Moving on to our panel here, Kaylee, it's not just the economic news and the market reaction today. It's a very significant set of arguments being heard before the Supreme Court. They've actually wrapped their session for the day. The arguments over Donald Trump's claim of presidential immunity. Our signature panel is with us now. Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, having heard some skepticism from swing justices when it comes to Jack Smith's arguments against. Jeannie, I wonder your thoughts today. This could go a couple of different ways, but based on what we heard, and I realize we're reading tea leaves, we're trying to understand what the justices mean with their statements and their questions. This day actually went better for Donald Trump than a lot of people thought it did, didn't it?
It really did, you know, and I think back to when they granted cert in this case, I think that's when I was most surprised, because I thought for sure this close to an election, they would let the circuit court's decision stand. They did not. And so that was the biggest surprise. But once they had done that, I think the thinking was for most of us that they would put this to rest fairly quickly. They didn't do that. And now, based on the oral arguments today, it looks like they could send it to a lower court. We certainly won't get a decision from them, you know, arguably until late June when the term ends. And so this is a win from Donald Trump just from the calendar perspective, because it really won't give enough time to have the January 6th trial before the election. And of course, even if they have the trial, you are so dangerously close to an election that for supporters of Trump and opponents, that raises all kinds of questions about the political machinations of the court in the electoral context. So I think it was a win for him as far as the schedule is concerned, at the least.
Well, Rick, as we consider the potential political ramifications in terms of the election cycle itself, obviously Trump's base of supporters, as we know, has been proven time and again, is not likely to leave his side, believes that he is being targeted by this Justice Department, it's being weaponized against him. This is a witch hunt. Whereas those who are not in Donald Trump's camp believe that he's done things wrong, deserves to be prosecuted, what have you. There's already two very firm sides here. So I just wonder the basket of minds we're realistically thinking about that would care whether or not he goes to trial, that care about the outcome, that will change their vote because of it.
Yeah, I think I'd be watching two distinct groups. One, we know from our Bloomberg swing state survey that anywhere, depending upon the state, from 6 to 15% of Donald Trump supporters are willing to not vote for him if he is, quote, convicted of a crime. And that goes without saying for now which court case includes. I think it's general enough to say if he's convicted of a criminal act, he loses support, some of it amongst that group. Then I would also say there are the undecided voters, and there are plenty of them in some of these states. And the main focus of the Trump campaign and the Biden campaign has been to have a conversation with them. And these are primarily suburban women voters. And they could determine the outcome of the election regardless of a conviction or an acquittal. And this isn't the kind of topic you'd want to be having 6 months before a presidential election with a targeted voter like a suburban woman. Hey, I won today. I've got immunity. I can do whatever I want to do. That's not I don't think that's going to be in any TV commercials coming out of the Trump campaign. Yeah, I think it's a problem. I think it delays the conversation that they're trying to have. And of course, there's these ripple effects. Today, a targeted state, Arizona, has announced 18 defendants are indicted because of election activity, including a unindicted co-conspirator named Donald Trump, whose name will be on the ballot in November. I would say I'd rather have a good, clean win in Arizona than worrying about what's going to happen in the Supreme Court today. Today was a bad day for Donald Trump in Arizona.
Well, this is all super important, Jeannie, but you can see this coming, right? Unless the Supreme Court completely rules against Donald Trump, if there's any sunlight here, you can write the Truth Social post now. Vindicated. We brought our claim to the Supreme Court and showed the world that Joe Biden's weaponization of government was illegal. And that's going to be the perception, right?
Yeah, that's going to be what Donald Trump and his campaign team say. Quite frankly, what else can they say? So that is what they're going to say. I don't think we know yet how this plays out. I am a pollster, but one thing we know about polling is it's very difficult to poll people on future behavior, particularly when they don't have a good sense of the scenario. So, you know, we always ask them who they're going to vote for, or who they support. But to ask voters, you know, what you would do if somebody is acquitted or if somebody is found guilty, it's really hard to know, at least for me as a pollster, if you could trust the data coming out of that. So we really are truly in uncharted territory in terms of how this all plays out. Donald Trump will surely say that this was a witch hunt and he was vindicated by the Supreme Court if that happens. But I'm not sure how that lands with these voters. So we really have to wait and see. You know, it's one of the cases in which, for me as a social scientist, there's not a lot of research you can do to get to an answer. And we can't look back in history because we've never been here before.
It's a point very well taken, Jeannie. And of course, Rick, the other side to this is that it's not just about what people do with their vote. It's also about what people do with their dollar. And to this point, Donald Trump has proven an incredible ability to fundraise off of these legal challenges, at least since his court trial has kicked off in New York State, where he is again today, mind you. He's been able to raise millions of dollars. So how should we be thinking about that dynamic here as well?
Yeah, everything is relative. His first quarter fundraising lagged his previous fundraising in 2023. So sure, he is raising money today while he sits in the court, but he's not raising as much today as he did a year ago today, if under the same circumstances. And he is plowing more and more of that money into legal fees. So the net to him keeps getting smaller. So smaller overall base, smaller ability to spend. And we even saw data off of this report that Obama for the first time surpassed Trump on small dollar donors. That used to be what Donald Trump had as his special sauce. He had more small dollar donors than anybody, and those people would be with him no matter what, thick and thin, and that money would just roll in. So those times may be a changing.
All right, Rick Davis and Jeannie Shanzano, our Bloomberg Politics contributors. Point well taken from Rick on Biden pulling in those small dollar donations as well. There's so many different facets to this conversation, and we're keeping our eye on the court, not just here, the Supreme Court in Washington, but up in New York as well, Joe.
Yeah, we've got a lot more to follow here on Balance of Power. This is Bloomberg.
I'm John Tucker in the Bloomberg News, and with this Bloomberg Business Flash, major averages, they are lower, but off the worst levels of the session right now. The economic data that's driving things, the GDP report that we got this morning shows slowing growth and a higher rate of inflation in the U.S., and that's a combination that initially really spooked investors. Again, the major stock averages falling, yields are jumping. Meta Platforms helping depress the risk sentiment after its earnings report. That was late yesterday. They're going to spend billions of dollars more than previously anticipated. Again, the worst performing stock right now, the S&P 500. Two more of the so-called Magnificent Seven cohort of stocks. They report their results after the close of regular trading today. Of course, that would be Microsoft and Google parent Alphabet. And right now, S&P 500, 28 points lower. That's down about 0.6%. Again, off the worst levels of the session. Right now at 5,042 on the index. The Dow Jones Industrial Average, 372 points lower. That's down just about 1%. And the Nasdaq Composite Index, 134 points lower. That is down 0.9%. That two-year yield, 6 basis points higher, right at 4.99. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Balance of Power continues with Joe Matthew and Kaylee Lyons.
All right, John Tucker up in New York, thank you so much, reminding us it is an important day in terms of economic data, as we got lower growth, higher inflationary pressures. Not a great combo for President Biden. But of course, here in D.C., we also have been distracted by a few other stories, including arguments at the Supreme Court, Joe, talking about basically the powers of a president and where they may stop or continue when it comes to criminal prosecution. That's what has been grappled with by the 9 justices and defense attorneys for Trump and other attorneys for the Justice Department.
You're the first to describe these arguments as a distraction today.
No, I'm just saying.
I keep hearing the word pivotal surrounding this,
yes,
Kaylee, but
you're
no,
right. This is not a sideshow.
You're
this
making
is the
me
main
laugh
show.
because this is Kaylee understands. This is one of these days in the news business where it's pretty hard to have competing headlines on this level. I mean, we have 4 top stories today. The thing about the Supreme Court arguments, though, is that they will have a lasting impact, this ruling, on not just whatever happens to Donald Trump, but every remaining president, including the guy who's in office right now. So, yeah, look, we're here in the swamp where FOIA man enters the fray. This is the new Big Take DC podcast. Did you like that dramatic turn? Thank you. I'm trying to follow the bouncing ball here as Saleha Mosin joins us at the table. We do this every week at this time as the podcast drops. And FOIA Man is somebody that we want to hear about because he embodies so much of what people see right and wrong with Washington. Saleha, great to see you. Welcome back to the table.
So great to
How did you meet FOIA Man?
FOIA Man, Joe Kaylee, he is our colleague, Jason Leopold. He is in our LA
I
bureau.
didn't know that he was like a superhero, though.
He's a superhero. He has hundreds of thousands of Twitter followers, and government officials and agencies across Washington are scared of him and his FOIA requests.
Well, we should probably explain FOIA requests,
Let's
right?
do that.
It's if you
Thank
want to get information from the government, you file a Freedom of Information Act request to secure that, right? That's essentially what it is. Maybe sounds easy, but it's not necessarily always as easily done than said.
No, you have to know your agency, you have to know the policy or the issue that you are seeking information on. You need to know the personnel that is involved in that. It's not just for journalists. Anyone, any citizen, any organization can file a request. We happen to have someone who has filed the most requests as an individual, even competing with like the New York Times Company or all of Bloomberg put together. He's filed more, Jason Leopold has.
Did Jason know this, or did you discover this in the course of doing this story?
No, he knows
He's
his
a record
data.
holder.
He's a record holder.
Amazing.
He's a redacted record holder, right?
Got it.
Everything's
I like
redacted. But it's important right now, right? We're talking about this immunity case. We're talking about we've got elections happening, and we have an electorate that actually doesn't trust people in charge. The average trust in the government has dropped to historic lows. A Pew Research information found that 16% of Americans trust the government. Gallup found that 30% trust the media. That is really low, really low. It used to be in the high double digits, 70, 80%, maybe 40 years ago.
So it kind of just speaks to this idea that there is a perhaps even greater lack of trust in institutions that we have seen being compounded in recent years, and that maybe is why you want to try to hold these institutions to account. How much power does an institution have to say, no, I'm not sharing that info with you, it's classified, national security reasons, whatever it may be, you can't have it, we get to keep that under lock and key?
So much power. We have reporters like Jason and others who combat that just through knowledge and just being persistent. But the thinking is that if you want to rebuild trust between the public and the government, then documents where the average voter, the average citizen can look at the report and see for their own eyes, make their own judgment is important. Same with the media. If we can show that our reporting is based on a document that everyone can look at rather than unidentified sources, that trust can be slowly rebuilt.
Thank you for, by the way, delineating. We're talking about freedom of information requests that are part of our business. It's fascinating, I think, for a lot of people to learn that anybody can do this, but you do need some money, don't you?
Oh, yeah. I mean, it takes, they send you CDs. So then you have to have a CD player or a way to read the documents that have been loaded onto the CDs, which Jason does not have. He has to get it converted. They charge you, the government charges him $15 for each CD that he has to then take to get converted somewhere. I don't know, Kinko's where he goes. It does cost money. And then you have to sue. And you have to sue the government to get information, so you need lawyers.
Incredible. So while this is something that any individual can do, there is a high barrier to entry, you might say.
Absolutely. And that's why we have someone who government officials call a FOIA terrorist. That's how he's been described because he's so persistent in trying to get information.
Well, sometimes persistency is just the very heart of the job of a journalist, and you just kind of keep at it. So it's interesting to think about what the government is willing to share readily, easily, make it publicly accessible by default almost, and what isn't. Some of those things are easily accessible, say through the Bureau of Labor Statistics with economic data, right? Anything that's happening in the economy for the most part with these certain metrics on a pretty consistent timeline, they're like, here it is. Economists can analyze it how they want, but this is the government estimates of growth or what have you. There's less room for manipulation, I guess, in a case like that.
And they show their methodology, right? And so you can get information on how they came up with their data, which is always good. The more you know about the information you're getting from anywhere, the media, a government institution, a company, the better.
Well, we've certainly got that data today, Joe.
That's for sure. Do you have your eyes on this? We've got a problem. Houston. Markets are tanking on this data as everyone kind of rethinks where we are in terms of the economy, in terms of interest rates. And if you're Joe Biden, that's not a good thing.
No, we have Fed Chair Powell last week when all the IMF officials, we had hundreds of economic officials from around the world gathered in Washington for spring meetings. And Powell's big message was that actually we might not see the interest rate cuts that you expect. Now, Biden himself has predicted that there will be a rate cut. And I don't know if we're going to have it. It would be great for him.
That cut at the end of the year, right? Whether it could be the November or I guess the September meeting.
Yeah.
Right.
And we'll be playing that cut of Joe Biden predicting, what did he say? It might be delayed by a month.
Right. And I think he was talking about originally how we thought there would be a cut in June.
Yeah.
So he was maybe forecasting a July cut. Right now, this market isn't expecting anything until December at the earliest, potentially.
He should not be forecasting anything. No president of the United States should be forecasting what the Federal Reserve is doing. And that's something you guys have talked about. We've talked about on the podcast.
They've been super disciplined about that until right about now.
Yeah.
But it's campaign season.
It's an election year.
Yeah. So you can hear more about that on Podcast Pass. And of course, a new podcast dropping today with the FOIA man, Saleha Mosin, hosts that Big Take DC podcast. You can get it at Apple, Spotify, anywhere else you get your podcast. So stay tuned for that. But we want to keep in tune with this conversation around the economy as we're talking about whether or not President Biden is right about rate cuts this year, given the data that we are seeing. And we go now to Catherine Edwards, who is a labor economist, a policy consultant, also writes for Bloomberg Opinion. Catherine, it's great to have you. Obviously, this market is now thinking that it may be the very end of the year that the Fed ultimately decides it's time to ease policy. When you look at the kind of data we've seen today, softer growth, but still persistent inflation, do you think that assessment is about right?
You know, I don't make predictions on when rate cuts are happening, whether I'm president or not. I think it's worth noting how special the time period that we are living in this economy what has defied expectations. The doomsday scenarios of last summer, we're not really seriously talking about a recession anymore. And, speculation on rate cuts, I think the timing matters a lot to financial markets, but it matters a lot more to households that are facing debt. And I would prefer to see them sooner rather than later before these household debt loads, really start to hurt families.
Okay, so that said, you're a labor economist, and the labor market remains the exception, it seems, to every rule here. It's the reason why, or at least one of the big reasons why we're not calling this stagflation today, why we're not expecting a recession tomorrow. But for how long, as long as rates stay higher, can that exception stay in place?
There are certain tailwinds to the labor market that are completely unrelated to inflation, and that is that we have very shifting demographics. Even though our labor force participation is high, our working age population is not as large a share of the population that it used to be, and that is going to put downward pressure on unemployment that we have. The youngest baby boomer turns 60 this year. Our workforce and its relative size is a lot different than it used to be, and that is going to put downward pressure on inflation or on unemployment because we haven't had the same kind of type of demographic distribution. So the example I give is, the last time we were fighting inflation to this degree in 1980, you had a lot higher unemployment because, of course, you had a very large mass of very young people who are, the first ones laid off, people who can be rehired a lot more quickly. We don't have that same type of distribution today. That's a tailwind on the labor market, that the baby boomers are leaving and that you have essentially a relatively smaller workforce, not an absolutely smaller workforce. In the same way, I would, when it comes to rate cutting and thinking about what's going on in the economy, I think there's a question of going back to those demographics and how they're influencing the labor market, but how they're also influencing the efficacy of interest rate policy.
Well, that is a really interesting question, Catherine. And actually, Chairman Powell has been asked about this. I don't think at press conferences, but in some of the fireside chats and Fed speak kind of things we've seen from him about whether the interest rate mechanism is really one that is still working as intended, given the resilience we have seen in the economy and in the labor market, despite the fact that we saw this incredibly, almost unprecedented increase in the Fed funds rate. So if it's not as easy as interest rates, are there other ways we should be thinking about this post-COVID economy and what it is subject to, manipulated by, dependent on, if that makes sense?
Yes, Powell has to talk about interest rates because that's his toolbox. He can't
that's what he has.
That's what he's got. And I think, some of the questions there are how effective is interest rate policy if you have such a large share of homeowners that have refinanced below a 3, right? It doesn't matter what goes on with interest rates. I don't have any other debt besides my house, and I am not taking on new debt anytime soon. That's a very large chunk of the consumer base. And then you're going to have an even larger chunk that is, the set of households that really have no room to reduce demand. At the bottom of the income distribution, you're looking at 40 to 50% of regular spending is just on food, right? It's not as if they have a lot of, room to cut in terms of their budget. So you've got some people who don't have room to cut demand. You have some people who don't really feel the need to because interest rates aren't touching them. This raises some really big question marks for interest rate policy. But I think probably the most telling thing is we have this GDP report come out and we don't really rush over to see what Congress thinks about it because the kind of assumption that is right is that they're not going to do anything. Fiscal policy is a policy that can be used, especially during extreme times. We use it during recessions, but we have not seen them really talk about what would a fiscal inflationary policy look like because fiscal inflationary policy is raising taxes.
Catherine Edwards with us, labor economist, policy consultant, Bloomberg opinion contributor. With all of that said, and I'm not going to ask you to predict the next rate move, Catherine, but how important will tomorrow's PCE data be in confirming what we're feeling and seeing today?
Yeah, there's a lot of pressure riding on this report, which is such a ridiculous thing to say considering the numbers already done, right? It's not as if anything can change to influence what it'll say. Expectations are growing, but I You know, it's worth remembering, we always talk about this 2% target, but CPI between 1990 and 2020 averaged 2.9, right? So we're so much closer than 2.0, right? We just have to get, it's really less a 2% target so much it is an under 3 targets. And it's helpful to keep in the back of your mind just how far we are from the finish line. But also to be, I think, very fortunate that the conversation we're having now is when will the rate hikes ease? When will the rate cut come? When this time last year, we would have been speculating how high do you think unemployment is going to get, 7 or 8? So we have pulled off some pretty miraculous engineering of the economy so far, and we have problems left, but I'll take these problems over a recession any day.
All right. A little sliver of optimism to end things on today. Catherine, thank you. Catherine Edwards, we kind of needed that. Labor economists, look for her work on the terminal OPIN Go. I'm Joe Matthew in Washington alongside Kaylee Lyons. We've been watching the markets react to the data, and we'll have a lot more on this coming up, including a really important, Kaylee, after-hours session today. Bloomberg Business Week with Carol Massar and Tim Stenivek. I hear them now. How you guys doing? What's coming up?
Man, we're trying to strap ourselves in because it's going to be an interesting one. You're right.
Yeah.
Low growth, high inflation, not what the doctor ordered. And we'll see whether the earnings after the close, Tim, are what the doctor ordered.
I think that was John Tucker, who we all just heard, by the way.
See, groaning and
Very noisy, very disruptive.
It makes a lot of noises in here. We're just saying.
John Tucker doing God's work in a sell-off day. Thank you, guys. Kaylee, I'll see you at 5. Bloomberg Business Week starts.
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody, live on radio, TV, YouTube, and Bloomberg Originals. I'm Carol Masser along with Tim Stenivek. Let's get to the setup on this. What do they call it? Little Friday?
Thursday's Eve.
Thursday's
Friday's Eve works. Thursday's Eve, I guess, should be yesterday.
We call it
I guess
Thursday.
nobody calls it any of these things.
We're going to play it straight. It's April 25th, 2024. Earnings still top of mind, everybody, but we've got stocks. They've been under pressure, though we're off our worst levels of the session. No doubt about the economy, Tim, front and center again.
Yeah, today data showing the U.S. economy slowing as inflation jumps. It's not a good combination.
Yeah.
So we've got a roundtable on the economy and the reaction when it comes to the U.S. rates market, because we are seeing rates higher across the curve.
Also, folks, what you need to know about Meta's sell-off today. It, too, is off its worst levels, but still down about 11%. So we're going to get into that. We're also going to get into another of the Magnificent Seven that reports after the close of bell. We, of course, mean Alphabet.
Also, Airbus just out with earnings. So we got the company's CEO, Guillaume Ferret, joining us a little bit later on the results, impact, and the outlook, and also what's going on with Boeing's woes and how that affects Airbus.
And one more thing, everybody. Hey, team, skip the chicken. So says Chipotle to its employees. We're going to get into all of that on this Friday's Eve.
That's much better.
On the day's top stories and a look at that trade, because we are off our worst level, certainly on the equity side of things. Let's get to John Tucker, who's in for Charlie Pellet.
Okay, I'm going to say this for the fourth time, this phrase, in the last couple of minutes.
Because it works.
Stocks are coming off the worst levels of the session. Risk assets did take a big hit initially after that GDP report showed slower growth and higher inflation. That's a bad combination. Initially, it raised fears of dreaded stagflation, but the smart people tell me you take a closer look under the hood, and that seems to ease some of those concerns. In fact, there's still resilient household demand and business investment. And after the close of regular trading today, we're going to get the next two members of the Mag 7 cohort to report. That would be Google parent Alphabet and Microsoft. Still feeling the impact of Meta's earnings. Those shares down right now just about 11%. Investors worried over their spending, but what they're spending on is helping some of the other stocks. That would be AI spending that benefits stocks like artificial intelligence maker of chips, NVIDIA. Those shares, they are up right now just about 4%. Overall, the S&P 500, 23 points lower. That's down 0.5%. We're at 5,048. The Dow Jones Industrial Average, 336 points lower. That's down about 0.9%. The Nasdaq Composite Index, 112 points lower. That is down about 0.7%. The yield's still elevated. In fact, traders now betting on one hike, and that would be at the end of the year. 2-year, up 6 basis points. That's at 4.99. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Carol and Tim.
Can't say it too much. Stocks off their worst levels of the session. Hey, a rebound.
It works.
It works. All right, we're going to call this an unwelcome combination. U.S. economic growth sliding to an almost 2-year low last quarter, while inflation jumped to uncomfortable levels. John just talking about all of this, interrupting a run of strong demand and muted price pressures that had fueled optimism for that soft landing sigh. That soft landing, Tim, it feels like maybe not going to happen, at least not for today.
At least not today. With more on today's data and the reaction in the U.S. Treasury market, back with us is Bloomberg News international economics and policy correspondent Michael McKee. Also, Bloomberg News rates reporter Michael McKenzie, both here in the studio. Michael McKee, I want to start with the data on growth and inflation. Just break it down for us and what exactly has folks so concerned?
Well, the number came in worse than forecast and certainly down from the fourth quarter's 3.4. We had 1.6% growth in the first quarter, but it really wasn't as slow as it appears because at least as far as people like the Fed would be concerned, because a lot of it was trade. We imported a lot more than we exported, partly because of the strong dollar, and it's cheaper to bring in imports. And if imports are coming in, it does suggest that retailers and others are anticipating they can sell this stuff.
Yeah.
Consumer spending, 2.5%, not as bad as it could have been, down from last quarter, but still reasonably good. Business investment still strong, 2.9%. Inventory is another problem. Inventories weren't as high, but inventories in trade are very volatile. So overall, it's not that bad a report. When you take out inventories and trade, you get a 3.1% growth rate. So not too bad. What worried everybody, and this is Mike's people over there, is the PCE inflation numbers. Now, the government calculates this number quarterly with average of the 3 months, and it also does a month by month. And what ended up happening is a big jump of 0.3% in the year-over-year numbers for both headline and core. Core particularly concerning people. And so that's what the market's focused on and started falling out of bed because of. Now, we've gotten the monthly figures for January and February. We get the monthly figure for March tomorrow.
Right?
And the question is, was this a problem all across the quarter? Was this a problem in January and February and they had to revise those numbers? Or are we going to have a big negative surprise tomorrow?
So if March comes down, we wouldn't be so worried.
We wouldn't be so worried. If March comes in as forecast or goes a little bit lower, then you'll watch the markets melt up tomorrow, probably.
Well, I don't know if I want to say melt up, but we definitely have seen a move up once again in terms of the Treasury curve and yields. So, Michael McKenzie, come on in on this. Talk to us about the rate moves that we saw today and the significance.
Well, it's a classic. You get a hot piece of data, another hot piece of inflation data in particular, which has been the story for all this year. And as Mike's just said, if you see some relief tomorrow from the March number, you might get some stability here in Treasuries. It's been interesting this morning. We did get above 5% in the twos, but the buyers came back. We're right around that 5% level still. 10's got above 470, came back a bit as well. The 7-year auction, nice concession, so they took down 44 billion of 7-year notes just now. So in general, the Treasury sold over 180 billion of coupon debt this week, 2s, 5s, and 7s. There's a lot of supply. The problem is, of course, if the inflation number remains sticky tomorrow and it indicates that there is no relief near term, you've got a refunding coming next week. And that announcement's going to keep putting supply on the table, particularly because the refunding is quarterly. They set out what they're going to sell for the next 3 months. And I suspect the 3-year will be fine. It's the 10-year and the 30-year, the longer dated stuff. And that was selling off a lot today as well. So you could see a further test coming here of 475 and higher in 10s, for example, because we're pricing out the rate cuts for this year now. We're down to just one. I was talking to an investor this morning who always said it was going to be one this year, and they're feeling pretty good about this now. And they're advising you should start scaling into bonds at these levels. But as she also said to me, don't go all in at these levels at the moment. There's still plenty of time to see just how the data turns and how the Fed's going to react, particularly next week when Powell gives his press conference. Is he actually now going to say potentially there could be some changes here? And that's where the market will be really focused on from here.
Oh, so Michael McKee, jump in on that and what we do hear from Fed Chair Jay Powell with that May meeting next week.
Well, everybody's going to be looking for him to maybe put some time frame on it. He's already said we're not going to cut rates as soon as people thought, and we're waiting for more progress on inflation. I was laughing when Michael was talking there because this morning I was looking at the Fed funds futures and the swaps rate for when markets think we're going to get rate cuts, and they priced everything out until December. And just a moment ago, they priced November back in by a basis point. Now it's going back and forth. This is why I predicted it this morning. It goes back and forth. A little bit. And the funny thing is okay, people want to make a bet one way or another. That's fine, but the Fed doesn't know what it's going to do, and because they're data dependent and they're watching this data and it's not coming in as they thought, so they have to rethink what they want to do and when they want to do it, and they're just going to wait meeting by meeting to get a handle on it. Right. So whatever the Fed funds futures or swaps say at this point isn't necessarily what's going to happen.
But Michael, are the rate moves and the traders, are they data dependent? I'm thinking about what Liz Ann Saunders of Schwab said to us yesterday, and she's like, stop focusing on the debate about what's the Fed going to do, when is it going to cut rates, how many rates, like just that's not what investors care about. Like, and she was tying what's going on in equity markets is based on what's going on in the rates markets. The rates market, are they taking their cues? I mean, they do take their cues from Jay Powell. They also, though, do from data points, right?
Yes, they do.
Help us understand.
But they do. But you've got to remember, there's different types of investors. I mean, the people who are trading IIS swaps, and sort of trading between whether there's going to be a November cut, December cut, or maybe saying actually November's too close to the election, so maybe it's going to be a September cut, and they'll jump back in there if they get any kind of relief from the data side. They're the short-term momentum players. Longer-term investors who have been telling us for weeks, God, it's so nice to see yields finally getting into that 4.5%, 5% zip code. We didn't have that since 2007. And so their advice is, look, you've got to start strategically allocating more and more money and scale into the bond market as it sells off. The other point to make about all this, of course, is that the market priced in a lot of rate cuts at the start of this year, in part because Powell made the famous pivot in December. Now, as the market takes that out, you're tightening financial conditions. If you keep pushing yields higher, you're going to keep tightening financial conditions. And therefore, things will start to slow down again. And then the market will go back. It's kind of like a washing machine cycle.
But that's kind of what we saw in like August, September, October,
yes,
when we saw yields move higher.
Yes. So at the moment, the Treasury Index is on course to have its worst month since last February. And in fact, it's not that far away from actually being the worst month since the dark months of 2022, when things were really getting rocky. So that shock is coming through. Equities will probably take more of a hit too if yields keep on going up. Because ultimately, can this economy live with real yields going towards 250? I mean, that is debatable. But I think at the end of the day, as rates keep going, that's going to actually help slow things down. So ultimately, you will get some kind of cuts from the Fed, I would think, if this is the direction of travel.
What about the argument that, well, wait a minute, some investors are actually feeling, wealthier, that they've put money in, whether it's money markets or so on and so forth, and they're getting some decent returns. Or you look at some of these mega cap tech companies who've got so much cash on their balance sheet, and they're actually making money. We talked with our Bloomberg intelligence team, and they said they're actually making some real money on all of this. How does that impact things?
Well, there's a theory.
In terms of the economic impact and the slowdown.
There's a theory that the Fed's high rates are actually boosting the economy, but nobody really at the Fed would believe that.
All right, that's a
the wealth
smackdown
effect
for me.
is not big enough. And the fact is that people who have enough money to be really making money in the markets aren't going to just start spending more because the markets are going up. They'll just keep spending as they do. So I don't think there's a lot to that.
What do you say to Michael saying real yields at 250? Can the economy live with that?
It looks like it. I mean, that's the thing that the Fed is saying at this point is we don't have to, because we have real yields at that level, and we have very low unemployment, and we have reasonably strong growth. Inflation's a bit of a problem, but we'll see how that goes over the next couple of months. So we don't need to react at this point. And when you go back in history and you look at what happened after previous recessions, when the Fed started raising rates before we got into the great financial crisis and went to zero, this is not an unusual rate level. 5.5 is maybe a little bit higher than you would have seen, but you're looking at 4 to 5% as a kind of a normal rate. Now, it's been 20-some years since we've been there, so people aren't used to that, but the economy functioned with that.
Is that the feeling that you're getting right now, talking to bond investors, that this level of rates is the new normal?
Yeah, they think it's a return to what we had before the financial crisis. I mean, the financial crisis was the biggest economic shock since the Depression. You had the biggest collapse of financial markets and of the banks since the Depression era. I mean, it came, 10 years after they dismantled Glass-Steagall? So, again, it takes a long time to recover from those kind of huge balance sheet shocks, particularly when it's overlaid with a massive housing bubble bursting. So you had both households and banks taking a massive hit. It took a decade to get through. And then you get COVID, which is suddenly just is a massive infusion of cash into the broad economy. And so we now have, inflation picking up, the Fed unable to be confident enough that it can start to ease back on those brakes and start cutting rates again, because they don't have the confidence that inflation is truly under control. And it is a tricky period for the Fed, because whenever you do see a pickup in inflation, yes, it will come down, but if it remains elevated, that means the economy is vulnerable to another inflationary shock, which just kicks it back up into gear. But I think in general, bond investors like what they're seeing. They do think, yes, there's potential for rates to go a bit higher from here, but in general, they think we're pretty much near the top. But it's very difficult to pick a top. So this is why a lot of the longer-term investors are just scaling into the market. And in particular, though, they are not comfortable about debt beyond 10 years. And that gets back to the spending that's going on in Washington. It gets back to the fact that whilst the tax receipts have come in strong this year, that will kind of push supply, eases the pressure on supply concerns. Next year and beyond, particularly given however the election shakes out, you're going to have another round of supply, another more pressure coming through. And the one thing I will say, if you look at the 10-year and the 30-year, they really haven't truly come back to where we were before the financial crisis. Because if you look at the very geeky bond model that says, what is the risk premium? It's only still around 0 for 10 years. That, to me, is a problem because you need to have a positive risk premium. Partly that'll come about if the curve steepens, but if you talk to investors, that's why they're a bit reticent about 10-year and longer debt.
I do wonder, we've had a lot of guests, I feel like, who've come on and just reminded us about the importance of U.S. government debt and managing it and servicing it and the additional issuance that will be needed. Mike, go back, right? How many years that we've talked about this so much in the past and then it kind of went away, but concerns about the cost of the ballooning government debt and servicing that. How do you think about that in terms of the economic impact?
Well, the way the Fed looks at it is if it has an impact on the economy, they might have to react, but they really can't do a whole lot because the government, the fiscal side is not their area. We have been talking about the problems of high debt forever, and we've never hit the spot where it really affects the economy. Now, economic theory tells you that it will, but we don't know where that is, and we don't know how it's going to play out. This is the biggest economy the world has ever seen. We have our own printing press, so there are ways you could deal with it, but you don't want inflation to break out because of that. So there isn't much the Fed can really do. They don't have a context for it because we haven't had the problem. They just think at some point it's unsustainable. Where that point is, we don't know.
That's why I kind of bring it up. I feel like we used to talk about it and then it went away. Final thoughts here, Michael? Just got about 10, 15 seconds.
I would think that Powell speaking next week probably is more important than tomorrow's data. And then I think the jobs number next week, if we still see a strong labor market that's not softening, I think the market could probably well take out rate cuts for this year then.
Interesting. Throw in refunding on Wednesday.
And then you got the refunding, but again, the tax receipts are good.
All right.
It's a trader's market.
Our own Michael McKee and Michael McKenzie, great duo. Still to come, the year of efficiency, come back, or so it seems to be the call from investors who are taking Meta platform shares down today. More in a moment.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, Mike McKee says it's not stagflation, but traders, they're still worried about the data we got this morning, the GDP report showing slowing economy and higher inflation. Toss into the mix some of disappointing earnings. It's a recipe for the stock sell-off and for yields to push higher. Traders also saying a rate cut from the Fed probably not going to happen until later this year, November, maybe December. As you said, Meta Platforms, worst performing stock right now in the S&P 500. Those shares down.
January, February.
Well, no, the betting is, it was
I know.
December. Now it's kind of like pulled back to November.
Just interesting.
Anyway, after the close, we're going to hear from the next two members of the cohort we know as the Magnificent Seven. That would be Microsoft and Google's parent, Alphabet. Anyway, again, I'll say it again. We're off the worst levels of the session. S&P 500 down just 0.4% right now, 20 points lower. We're at 5,051. The Dow Jones Industrial Average, 348 points lower. That's down 0.9%. And the Nasdaq Composite right now, 93 points lower. That is down 0.6%. Real quick, those yields, the more policy reactive 2-year yield, let's just call it 5%. We'll round it up. Up 6 basis points the 2-year.
You can't do that. You can't do that.
I just did
You got to
it.
be exact.
So, how many decimal points you want me to go out?
Just telling you, those decimal points are money.
No, we round up. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. You thought this was going to be a solo act?
Yeah, no, it's not going to be. Sorry. I feel like I'm around my dinner table growing up. This is kind of what we did. All right, John Tucker, thank you so much.
Why didn't Tim bring any cherubs in with him? It is bring you.
Because they're little critters.
Well, after I got home last night, I realized I had 2 kids. And
whoa, honey, where'd that one come from?
It is Bring Your Child to Work Day, but
children.
You kind of want older kids to bring in, I think. You want to wait a few years.
I think your son would have been great.
Yeah,
All right.
I wouldn't be here if you were here today. I'd be running around.
2 kids.
Yes, 2 kids. That's right.
All right, if you missed it, you got to go back to yesterday's show podcast, download it. All right, let's get to Meta Platforms because shares of Meta are tanking today, although down 16% at their lows, just right now down about 10%. And so this has kind of been at its lows today, the biggest move since October of 2022. This as Mark Zuckerberg asks investors for patience again as Meta gets ready to spend billions of dollars more than expected this year, fueled by investments in AI. That spending forecast coupled with slower sales growth than anticipated, really safe to say, freaked out investors last night when they reported, and then, of course, in today's trade.
Well, back with us right now, the guy who led us into the report yesterday, also out of the report yesterday with the expert analysis. He's back with us right now. Of course, that's Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh here in the studio. So you were on with us right as the numbers came down, the amped up spending forecast. You called it right when you saw that number. As you've had a few hours to dig into it, to listen to the call, is today's sell-off justified given what we heard from Mark Zuckerberg on the call?
I mean, the earnings call actually was quite good in the sense that there are a lot of details around AI which show that Meta is one of the top companies when it comes to generative AI. I would say in the top 3. And I think that's music to investors. So if they were saying we are ramping up CapEx to invest in generative AI, by offsetting the losses that we are, and we'll curtail our spend on Reality Labs, I think the stock would have been up.
Who are the other 2? Are they Alphabet and Microsoft?
Alphabet and Microsoft.
Are the other 2
Yes.
companies, okay. Where in Meta Platforms you'd say would be number 3?
Because they have their own large language model, they have the infrastructure, the GPUs that you need to train those models, and they're actually deploying it on their family of apps. The thing we were discussing yesterday, Meta AI, it's a contender to gain share in search, and that could be a big product in itself. So why get distracted by Reality Labs, AR, VR? I mean, look, it's a long-term bet. It's a pet peeve for Mark Zuckerberg where he feels very passionately that it'll be a big category. I just think they're not sharing enough details with the investors to convince them that this is a bet worthwhile, spending $50 billion on. Imagine if Meta was making an acquisition worth $50 billion and they had nothing to show for it. How would the investors react on that?
Not so great.
Yeah.
Hey, having said that, I feel like when we talk about artificial intelligence, you guys, the Bloomberg Intelligence team, did a great thing on Gen AI and just trying to understand kind of where we're all going and the players in it. But having said that, I feel like our conversations so often, Mandeep, have been about Microsoft and what they're doing, their big investment that awakened the world, if you will. Meta, like, how is it that they got to be so quickly, it feels like, such a leader in AI?
Well, so you bring up a great point. Actually, so all the CapEx they were making on Reality Labs, some portion of it actually did play a role in them getting to where they are in generative AI. So not all of them, all of the investment they made was bad CapEx.
Yeah.
It's just, I think with generative AI, what they found is they have the data, the proprietary data from the social networks that they can use to train their own generative AI algorithm. The reason why Alphabet is in that top 3 is because they have the data, search, maps, and we are going to see that tonight, how well they end up doing.
Well, this is what we were talking about, right? That the machine learning, it only becomes smarter if you have all the access to the data points. Is that?
And these companies have data at scale.
Yeah.
So Microsoft, I mean, it doesn't have its own data, but it partnered with OpenAI that had the data. So that's why all these companies have that common denominator when it comes to data.
What's the data that Meta Platforms actually has? If we think about this from the perspective of search, and I think everyone's familiar with the way that Google search works and the way that Google's experimenting with AI in its search results, what's the data that Meta Platforms is actually tapping into to deliver the answers that people are looking for? Because frankly, I'm not that interested in, I don't go to these platforms to look to answers the same way I would using Alphabet's Google.
Well, so think of how LLMs are trained. They're trained on open web data where there are real conversations. Like Reddit is the most commonly used data set across all the large language models. The reason why that data is so good for training is because it's got real conversations that the model or the algorithm can learn from. Similarly, with Meta, they've got images, they've got text data, they've got videos. So all this data in aggregate has a lot of knowledge that it can be used for training their own large language model in addition to the open web data. And look, they are trying to commercialize it. They're trying to develop an ecosystem around it where the chatbot can be powered by Meta's large language model. So all this is going in the right direction. They're deploying it within their apps. Like right now, you can go to Meta AI within WhatsApp, and you can have a conversation like with any other chatbot, like Google Search. And so there's so much surface they can monetize. Why get distracted by Reality Labs?
So, okay, so last quarter, look to the current quarter. If they come out and we do second quarter earnings and they say, what, fill in the blank, then would you be worried?
No, and they
Is there
have
something that they could say, though, when they report the next time around?
So you go back to third quarter of 2022.
Yeah.
They did the same. They had CapEx and OpEx growth way above of top line growth, and that spooked the investors. That lasted 2 quarters, and then they walked back. They walked back their CapEx guide. They walked back their OpEx guide. I imagine they gave a pretty wide range for CapEx. Well, they'll say we'll be at the lower end of the CapEx, and everything is great.
Everything will be wonderful.
So they're essentially just giving themselves some room right now.
I think so.
Or testing the waters, perhaps?
Like the press release had, it's a multi-year investment cycle. Nobody wants to hear that you're going to keep losing $20 billion every year.
When you're up 40% going into the print for the year, and when you're up, 3-digit gains last year,
right?
Then you have that wiggle room.
Well, yeah, I mean, the stock can go down.
Stock's still up 20% this
right,
year.
but investors were like, wait a minute, because we gave you, look at what we did.
I mean, you got to earn the trust of the long-term shareholders. Remember, when they had an 80% drawdown, a lot of the long-term shareholders just gave up. And now they acquired these new shareholders. Last quarter, they announced a good capital allocation strategy, buybacks, dividend. That's great. But now suddenly it's like, oh, we are in an investment mode, and guess what? We're going to spend a lot.
We saved 2.5 minutes for Google, Alphabet. So they're just up about almost 12% this year. So give us kind of the key things. Is Gen AI once again a big factor in this release?
Yeah, I mean, search is what drives all their profit. You don't want that search number to miss because cloud and YouTube are great. Everyone likes the diversification aspect of Alphabet, but you can't afford to see that search number go down.
I have been really impressed impressed with the way that they're delivering AI-generated search results.
Yeah.
Like you ask Google a question in your browser the same way that you have, or in your phone, it generates the AI answer. It's been pretty good.
And look, they have the consumer habits. That's why it's so hard to take share from Google, because everyone is like trained on Google.
But are they selling ads against that at this point?
It doesn't matter. For an incumbent like them, they just need to make sure they don't end up losing that engagement. They will be able to show you more ads. I mean, right now, in its current form, even before generative AI came to the scene, they only monetize 50% of their ads. 50% of the ads didn't have any, it showed blue links, but there were no ads shown, because that's how they kept their users engaged. They only showed ads when you have a bid for the keyword, and that's when they show ads.
So that engagement more important, like I think about the partnerships between Apple and Alphabet, like those things are more important to Alphabet and their bottom line, ultimately?
If Apple says we are using generative AI to come up with our own search, that's a big threat to Google, because then it loses all the iOS ecosystem users and it's not the default anymore. That's a big threat.
What are you looking for very briefly from YouTube and YouTube Shorts?
YouTube, I mean, the expectations are quite low. I think 15% growth when Meta did 27% growth. There's no reason why YouTube ads shouldn't grow more than 20%, and the YouTube subscriptions should also grow above 20%, because that's been doing very well over the last 2 quarters.
These are the paid subscriptions to YouTube
paid subscriptions.
to remove ads.
Correct.
Okay.
Yeah, and so
what about Shorts?
Shorts is kind of embedded in that ad revenue because they don't have a subscription, but it should, like I said, with all the kind of noise around TikTok, it should help YouTube and Instagram. And Instagram it did. I think with Meta's this quarter results, it was pretty strong.
Search and engagement. AI, got it. There it is. Our marching orders. Mandeep, thank you so much. So appreciate it. Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh with the latest on Meta, as well as what to look out for when it comes to Alphabet. Hey, coming up, we've got Airbus out with earnings about 3 hours ago. We're going to hear from the Airbus CEO.
Yeah, looking forward to that. Though, first, in the meantime, I check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 News in Washington, D.C. Hey, Amy.
Hi, Tim. The Supreme Court heard arguments over whether Donald Trump should be immune from prosecution for actions he took during his time as president. Justice Sonia Sotomayor asked Trump lawyer John Sauer about their end goal with this case.
This is what you're asking us to say, which is that a president is entitled not to make a mistake, but more than that, a president is entitled for total personal gain to use the trappings of his office. That's what you're trying to get us to hold, without facing criminal liability.
Justice Sotomayor, under questioning from Justice Amy Coney Barrett, Sauer acknowledged that some acts alleged in the indictment were private acts. Those arguments lasted more than 2 hours and 40 minutes. A crucial witness in Donald Trump's criminal trial is describing his role in the central part of the case against the former president. David Becker, the former publisher of the National Enquirer, is testifying for a third day about what prosecutors say was a 3-man conspiracy to aid Trump's bid for the presidency. And we can tell you the FCC has now restored net neutrality rules that prevent broadband internet providers from favoring some sites and apps over others. The move effectively reinstates a net neutrality order that the Commission first issued in 2015. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
John Tucker in the Bloomberg News with his Bloomberg Business Flash. Kind of a bad combination today for the risk assets. The economy losing momentum in the first quarter and inflation accelerated. This is a kind of a troubling performance that we saw with the GDP. It expanded at a 1.6% pace. That is actually the slowest almost 2 years. And then inflation, that was most notable in the services. The major stock averages sold off as a result of that, and yields pushed higher. Yet Meta Platforms' worst performing stock right now, the S&P 500, that is down just about 11%, 11.3%. Caterpillar shares, they're weighing on the Dow Jones Industrial Average. They delivered a disappointing second quarter sales view, and those shares, Caterpillar, down right now 6.7%. Overall, the S&P 500, 36 points lower. That's down 0.7%. So that's much better than we saw earlier, pairing some of those earlier losses right now at 5,036 on the index. The Dow Jones Industrial Average down 452 points. That's a decline of 1.2%. And the Nasdaq Composite Index is down 145 points. That is a decline of about 0.9%. Back to those yields, the two-year yield up 6 basis points at 4.99%. The 10-year is up 6 basis points. That is at 470. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Tim and Carol.
Great, so much. Thank you so much, John Tucker. Well, we are in the midst of earnings season, and Airbus out with their earnings results today. The European plane maker benefiting from trouble at its arch rival, of course, the other big player in the industry. We are talking about Boeing, which, as you all know, has been mired in crisis following a near catastrophic accident early in January. Airbus has quietly pressed its advantage, picking off orders from Boeing loyalists that have been clamoring for more planes.
As for the earnings update, Airbus will further increase production of its advanced A350 wide-body jet as the plane maker benefits from surging demand for the long-distance travel and the crisis engulfing its arch rival Boeing. Earnings before interest and tax missed analysts' forecasts amid higher costs. Airbus continuing to struggle with a supply chain that remains constrained. Shares of Airbus ADRs that trade in the U.S., Carol, down right now by about 4%.
Yeah, we've seen them. I mean, the overall market here in the United States has been much lower. We've seen bounces off the lows. Earlier in the session, shares of the ADRs of Airbus down about 5.6%. But as we said, bouncing off those lows with about a 4% decline. But lots of things we want to know. Certainly in a year that we have talked so much about the woes over at Boeing and what it means for Airbus specifically, as we've seen some of the airline carriers, much known to those of us here in the U.S. who have been thinking about, okay, where do I buy my planes in the future?
As a reminder, though, for everyone, the customers of these companies cannot just simply pick up the phone and switch their orders from Boeing to Airbus. A lot of these planes are ordered for years to come. They're accounted for years to come. Plus, the fleets are have the pilots that are trained on these certain pieces of equipment. They have maintenance crews that are meant for that. They have airports and gates that are meant for those things. You can't just switch these things out.
Right. This is something we've talked about with our George Ferguson of our Bloomberg Intelligence team and the rest who cover certainly these two big players. Right now, though, let's get more on Airbus's results and the outlook. We head to London and Bloomberg's Guy Johnson talking with Airbus CEO Guillaume Faury. Over to you.
Carol, thank you very much indeed. You guys have laid it out brilliantly in terms of what we're facing here. As you say, Boeing taking the spotlight for all the wrong reason, Airbus cracking on and delivering planes to its customers. But the Q1 numbers look a little light on where I think analysts were expecting them to be. So I think investors this evening here in Europe are wondering why costs are so high at Airbus right now. Why is cash flow so light? Why is this company carrying the kind of levels of inventory that nobody thought they really would be having to do so at this point? So let's try and find out some of the answers to those questions. Guillaume Faury is the CEO of Airbus and joins us right now. Guillaume, welcome to the program. Thanks for taking the time to join us. Let's talk a little bit about where we are with these Q1 numbers. As I say, cash flow looks a little light. We're wondering why you're carrying so much inventory. We're wondering why costs are so high. Are these one-offs? Are these just associated with the first quarter, or are these going to be numbers that are going to linger into the latter part of the year?
Hello, Guy. Good to see you. We've indeed released our Q1 numbers. We've delivered 142 commercial airplanes in the quarter, which is 12% higher than last year. So In terms of production deliveries, we feel we're on track, and that's very important. The quarter is indeed a bit soft, but it's again on track with our expectations to keep our guidance unchanged for the year. We are building indeed a lot of inventory. We're operating in a complex and difficult supply chain environment, and we want to make sure that we have the resources, that we have the hardware, the equipment, and everything we need to keep ramping up in a year that will be backloaded, a bit like what it was last year.
Okay, so we're going to see more aircraft deliveries in the back half of the year. There's a line, Guillaume, that stands out from the press statement, and it's right at the top, and I think it's worth repeating to the audience. We delivered first quarter 2024 results against a backdrop of an operating environment that shows no signs of improvement. Geopolitical and supply chain tensions continue. Guillaume, why are you still dealing with supply chain issues? Many other industries face these kinds of problems during the pandemic, but they are long in the rearview mirror. Why is aerospace still struggling with these issues? Why are they so hard to fix? Why is the supply chain not being sorted out more quickly?
Yeah, Guy, it's a very important question. Actually, we are in a long-term industry. We employ people which are highly skilled and qualified, and a significant number of the workforce of the people left the companies in the supply chain at Airbus with other companies during the pandemic. So we are rehiring people, but it takes a lot of time to onboard them, to train them, to give them the qualifications, and to have them at full speed. And this is a bit across the supply chain. But there is another reason why we are in this difficult environment, and we will remain in a challenged supply environment, is because we're ramping up at full steam, at the maximum speed we reasonably can. And this will continue till we reach the rate 75 on the A320, which is expected in 2026. And you see that now we decide to continue to ramp up on the A350 beyond the rate 10 that was already announced, up to rate 12 in 2028. So we are victims sort of our own success. We have a lot of demand, the demand is higher than the supply, and this will continue to stretch the supply chain for some years.
The supply chain, as you say, is stretched. You are having to support the supply chain in many different ways, putting staff into their factories, supplying or helping out with financing, or at least telling the banks how the order book is going to look. Guillaume, are you getting to the point, though, with the supply chain where you're going to have to start taking bits of it over? You're going to have to start taking equity stakes in order to make sure that you can deliver on that ramp up in production that you're talking about and supply the aircraft that you have promised?
Actually, we count on the financial institutions to do the financing, to play their role. We are the end customer, we are the OEM, and the support we're providing to our suppliers is mostly in the form of technical support, sending our own teams on site, understanding the way the ramp-up plans are secured, if not working together to adapt and anticipate as much as we can. And we have some suppliers which are in real difficulties that have to do transfer of work. And in that case, it's a lot about anticipating, making sure that the execution is okay, that the quality for the new site goes as expected. So actually, we are more contributing people, skill, know-how, competencies than money to the supply chain.
Do you think, though, that you are going to have to go further than that? Could you be buying some of these companies to make sure that your supply chain is secure?
There are few cases where we have to take these kind of decisions. We like to be making those decisions when there is not only a defensive approach to a difficult situation to manage, but also a strategic intent, a strategic relevance to the case. And you might remember that we acquired 2 years ago, together with Safran, a company called Aubert & Duval, because that was making a lot of sense for us strategically on those special alloys for the long-term future. There are other ways of dealing with the situation, with national associations that go deep into the supply chain with mediation and with brokering relationship between suppliers and financial institutions, as I said earlier. That's mostly what we do.
Yep. Okay, we've seen what happens when the supply chain can cause problems. Let's talk a little bit about what's happening with Spirit right now. Boeing, Dave Calhoun, obviously in the process of retaking over that business in Wichita. He says, though, that he will not be held hostage by the Airbus portion of Spirit. He wants that deal to go ahead and go ahead quickly. He sounds like he's saying that he basically wants that whole transaction to go at his pace. Are you comfortable with going at his pace?
Well, I fully respect what Boeing is trying to achieve with Spirit. As you know, we are at Airbus with a very vast majority of our aerostructures, of our fuselage coming from make, from core business, of our fuselage coming from make, from core business and companies that we own. So we respect what they try to achieve by buying back Spirit. Now there are some important work packages of Airbus planes that are with Spirit, mainly the A350 Section 15 and the A220 wings. And we want just to be clear on the fact that we don't want those work packages to be with our main and direct competitor. So we need to find a way forward that works for both parties, but we don't want to take anybody hostage. We just want to do what is right for Airbus.
When do you think, therefore, you'll be in a position to make all that happen? Airbus obviously needs this to work, but does it need it to work quickly?
Against the backdrop of this change of situation with the recent announcement that Boeing wants to acquire Spirit, we have started to work. We have engaged with Spirit, but I can't be precise on the time it will take. We have just started the discussion. We are engaging in a very constructive and active manner, obviously, but it's premature to give a timeline.
Okay, so when Dave Calhoun talks about maybe the end of this quarter, that doesn't sound familiar to you?
Well, there are different ways of dealing with the situation. As I said, we are very constructive and we don't want to take anybody hostage, but we want our interest, rights, and the discussion with Spirit to be smooth and efficient, and we are engaging for that.
You said earlier this week, Guillaume, that you are turning customers away when it comes to the narrow bodies. You are sold out many years ahead. How many customers are you turning away at the moment? How many people are coming to you and saying, can you sell us some airplanes? The guys were talking about this just a moment ago. You can't just pick up the phone and kind of order an Airbus. There's a long timeline here. But how many customers are ringing you up saying, have you got any slots? How many people are you having to turn away right now?
Well, I don't like the idea of turning away. We are always welcoming customers reaching out to us. Now, the facts are what they are. We have no available slot for the A320 family now before 2030, and that's the reality. So we have to face that reality, and there is indeed in the market a shortage of planes. There is more demand than supply. We're trying to do our very, very best, but we are with an order book that is what it is. It's a very big one. And for new customers coming, they have to understand, they have to respect the fact that available slots now for the A320 family are in the next decade.
How far into the next? How far out? Assuming you get to your 75 per month level, how far out are you sold out?
We have, as I said, available slots in 2030 onwards.
Okay, 2030 onwards. Let's talk about the wide-body market. The wide-body market has come back and looks pretty healthy right now. You've announced that you are, as we were discussing earlier, going to be ramping up your production of the A350. But it's not going to be until 2028. Indigo from India earlier today announcing a fairly substantial order. You say that the supply chain is in a position to make that ramp. Why are you waiting as long as you are? Why 2028? Is that something that you could potentially do earlier?
No, that's not something we can do earlier, and actually that's quite early. You might remember that we were at rate 4 during COVID, and we have started to ramp up from rate 4 to rate 5 this year and to the rate 10 in 2026. So that's a quite steep ramp up already. We have assessed the readiness of the supply chain to go beyond the rate 10, and we've come with a successful outcome of this assessment, and with the possibility to go to rate 12 by 2028. So that is indeed a steep ramp up, and that is freeing up some spots between 26 and 28, and obviously more capacity beyond 28.
Guillaume, great pleasure to catch up. Thank you for spending some time with us on the program this evening. Guillaume Faury, the CEO of Airbus. Guys, back to you.
All right, great stuff as always. Guy Johnson, thank you so much, as he said, talking there with the Airbus CEO. Some headlines crossing the Bloomberg off of that interview, specifically talking about the supply chain being stretched for some years. And this one certainly caught our attention, that Airbus has no available slots for the A320 family until 2030. So
it's just remarkable.
We talk about this, right? You place these orders, they're in the order stream, if you will, for many years, and it kind of holds up. And you can't just kind of pop in and buy a plane, basically.
Yeah, the CEO also telling Guy just now that Airbus won't take anyone hostage on the Spirit Aero transaction, and that says it's premature to provide a timeline on a Spirit deal. The CEO also saying that a few supplier cases might need financial investment, and that the supply chain, as you mentioned, Carol, will be stretched for some years.
Shares of Airbus just down about 4% off their lows of the session, but that following an update on their business.
Keep that in mind when you're ordering that A320.
I will.
You're not going to get it until 2030, okay?
Well, and if you work for Chipotle and you're ordering
nice transition.
you want
upgradable.
You want chicken in your meals? You're not going to get it.
Here's why. Chipotle telling its employees.
If you work there.
If you work there, yeah.
Which I thought was actually kind of nice, that when you work there, you can eat there.
It makes sense. It told its employees last week not to include chicken in their own meals because surging customer demand crimped supply, but the chain now says its workers can go back to ordering freely. I mean, it makes sense that you want to save this stuff for the customers.
It's
I can think of
very
examples
popular,
of
right?
restaurant owners telling employees, hey, when you come in the morning, please don't park in spots in the parking lot, park somewhere else, so then the customers will have those parking spots later. Same kind of thing.
Yeah. Well, listen, people are doing things to protect their business, you know, whether you're at a Chipotle or whether you're going to Venice, which is a story we have to bring in that you brought to our attention, John. What's going on in Venice?
This is kind of like congestion pricing for like people, for pedestrians. So, I mean, Venice is... It's a destination for everybody. Right. It's the most beautiful city, one of, in the world. Carol's never been there, so she doesn't know. But anyway, they're going to charge you now as a tourist to come into the city. I guess you're going to have to wear like an Easy Pass on your head. Under an Easy Pass reader.
It's interesting, right?
It's not really.
They
I
say
thought that was funny, John,
well, they
don't
say
worry.
that, I know, I'm trying to get serious. Some of us has to be serious. Somebody does. They're trying to balance the wants and needs of tourists and residents, right? So the crowds and so on and so forth. So it is a form of congestion pricing.
Absolutely. So visitors who don't live, work, or study in Venice are going to have to start paying a €5, it's about $5.34, fee on Thursday for a total of 29 select days, mostly weekends, until mid-July from 8:30 to 4. Those who stay in hotels or registered accommodation overnight won't have to pay, according to the mayor of Venice.
Access payment.
I don't know how, well, yeah, it's just like, are they going to have like gates where you walk through and like little turnstiles?
It's a QR code to access the city of Venice.
The idea of over-tourism is nothing new in popular destinations, but the way that they're dealing with this is certainly something
But then it raises concerns of like, you know, I'm being tracked right now when I go to, for maybe some nefarious purpose.
John,
for the gelato
John,
you're going to buy in Venice?
just the name John Tucker, people have been tracking you for years. I'm just going to point it out. Interesting story. You know, that, by the way, Venice back in 2021, they banned large cruise ships from docking to limit the number of visitors. So they've been on a mission. All right, chicken and Venice. Who would have thought we would have put that together?
Hey, it worked. You can do it, Carol.
Yes, indeed. Hey, for those of you watching on TV, the close is coming up next. Chipotle, by the way, we're going to hear from the CEO, Brian Niccol. And we're going to continue to count you down to Microsoft and Alphabet earnings, folks. This is Bloomberg Business Week, and this is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec. on Bloomberg Radio.
All right, everybody, we're just about 1 hour away from the closing bell on this Thursday, April 25th. Don't say it, just say it, but we are off our lows of the session.
We are. The S&P 500 down
trade.
0.6%, NASDAQ composite down. Let's go ahead and call it 0.9%.
Very different tone right now.
Very different tone.
Or so it feels.
Stagflation jitters hitting stocks across the board.
And that was the original reason, right? Where we saw a bunch of selling, some concerns. Low growth, high inflation, not a great combination, yes.
We've been waiting for her to join us for the last hour because we got a lot of questions for her. Abigail Doolittle, Chief Markets Correspondent, is going to be joining us in just a few minutes.
Who are the buyers coming in? I want to know. What kind of
give her
momentum?
all the questions ahead of time.
All right, I'd like to give her a little help here. She doesn't need help though. Speaking of the markets, though, the next thing the trade is going to be focusing on is going to be, no doubt about it, what we get from Alphabet after the close and Microsoft. We talked about Alphabet last hour, so we're going to kind of give you a heads up on what you need to watch out when Microsoft reports today.
Plus, Chipotle shares rallying off their earnings. We're going to hear from CEO Brian Nickel, and then let's talk hotels.
Yeah. We're going to have the director of the Michelin Guide on the pivot to hotels. They rank restaurants, John. You know that, right?
Michelin stars.
Now they're doing it to hotels. So.
Why is it like a tire company rating restaurants?
Yeah. That's the origins. All right, we'll talk later. Can you tell us what's going on with the trade right now?
I feel like you've stolen some of my thunder. Well, in the driver's seat, economic data. In the passenger seat, the earnings reports. GDP report that we got this morning showed slowing growth, higher rate of inflation, and that's pretty much spooked investors. Major stock averages falling. The yields are jumping, but as Carol said for 15 times in the past hour, we're off the worst levels of the session. S&P 500, 29 points lower right now. That is down 0.6%. We're at 5,042 on the index. The Dow Jones Industrial Average, 423 points lower. That's down 1.1%. The Nasdaq Composite Index right now, 127 points lower. That is down 0.8%. Worst performing stock of the S&P 500. That belongs to Meta after the results that they had after the close of regular trading yesterday. Spending a lot more money. Investors don't necessarily like that. Shares of Meta right now down 11.4%. And over at Morgan Stanley, Andrew Sheets says, you know what? This is a stock picker's market, as he puts it.
We still think when we look more broadly, there are segments of the market, especially if we step back and think globally, that we still think are more reasonably valued. It's really about picking our spots.
And as we look at yields after that economic data today, 2-year yield just under 5%, 4.99. That's up 6 basis points. The 10-year yield, that is up 5 basis points. That's at 4.69. And it's worth noting that traders have pushed out their expectations of a rate hike to later this year. It was December, and now it looks like November. Just one rate cut, that is, from the Federal Reserve. 2 more of the Magnificent Seven in the batter's box today. Both Microsoft and Alphabet set to deliver what are seen as pivotal reports after the close of regular trading today. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Carol and Tim.
2 brothers, Andre and Edouard Michelin, made the first guide back in 1900, and they were trying to create demand for automobiles. They made tires, and they wanted to create demand for automobiles.
You knew that right off the top of your head?
I'm looking at her computer. I don't even think she looked it up. I think she knew it. I'm looking at her screen now. I don't see it
I'm
anywhere.
supposed to be using these chat bots.
Did AI tell you that?
Hey, Google.
Have you ever been to a Michelin restaurant? Like, you don't know. Probably. Not Chipotle.
Oh, but good. And their guac is really amazing. Should we move on?
Yeah, John Tucker, thank you for the update on equity markets. Hey, speaking of equity markets, Wall Street today rattled by data that showed exactly what stock traders did not want to hear. Significant slowdown in the world's largest economy and persistent inflation pressures. We saw stocks get hit across the board, the S&P 500 extending its April slide. With more, we're joined by Bloomberg News Chief Markets Correspondent Abigail Doolittle. She's here in our Bloomberg Interactive Brokers studio. Abigail, we were saying throughout our broadcast, stocks are off their worst levels of the day. We were talking about, Carol brought up this idea that there are buyers coming in, and one question we wanted to ask
are they?
you.
That's what I'm curious.
Well, I guess they're
They
on,
have
'cause
to be,
They
right?
have to be, because that's so. What's going on in the market? We thought today was going to be like a bigger sell-off than we're seeing now.
I think a piece of it has to do with the fact that earlier today you had Microsoft down about 4%, you had Google down more than it is right now. Both of those stocks down about 2%. Actually, excuse me, Microsoft is still down 2.9%. But that being the biggest weight to the S&P 500, the fact that it's 1% better than it had been. When it had been down about 4%, it was the worst day since, I believe, 2022 or January 2023.
You're talking about Microsoft or?
Yeah, Microsoft. And so basically in more than a year.
Yeah, at its worst levels since 2022.
Which speaks to the real fear after that Meta report, which is kind of funny only from the standpoint that Meta, they put up a great quarter, as I'm sure you've been talking about. And then in terms of the guide, the growth is not quite as robust. And they're also talking about more of a spend on AI. Now, I think one fear around Meta is last year, of course, we had the year of efficiency. It worked out really well. The year before, though, it was the year of the metaverse. Is AI going to turn into the metaverse? Now, it seems like AI is not going to turn into the metaverse. But what's so interesting to me about it is, and I think we talked about this the other day, Meta was up 130% into this report, priced to perfection over the last year. Microsoft, I think, is up like 5% into its quarter. Before today, up maybe 8%, but not the same degree of perfection. And I think that for Microsoft, the bar is a little bit more even, at least relative to the near term. We're looking for double-digit teen growth, top and bottom line. Azure, their cloud product, 28% growth. And then the Copilot, the AI, one analyst is saying that revenue may come in light. He's also saying that for Microsoft, and I think maybe Google too. I wish I could remember the exact language, but something. It's all about basically surviving and advancing. That's it. So that's what Microsoft needs to do.
But we keep we're having a joke a little bit about we're off our lows of the session, because it really did feel kind of not dark, but it was certainly a different tone, right, earlier on. And it's just, so is it just that explanation of maybe investors maybe not feeling so negative about some of these big tech mega caps, or what is it?
I honestly think that it has a lot to do with that weighting to Microsoft and Google, because
most names in the S&P 500 are still lower, about more than 300 right now.
Yes, I'm looking at that right now myself. Actually, I'm looking at the NASDAQ 100 version of that, so I can pull up the S&P. Actually, I have the S&P 500, yeah. So more than 300 stocks are, and a lot of them are quite a good weighting. However, to the upside, from a point standpoint, you have NVIDIA up 4.3%.
Yeah.
You have Broadcom, you have Tesla, you actually have Apple up there. So you have some other heavyweights on the other side. So that's also helping. That's probably where more of the buying is going. In terms of that NVIDIA buying, probably has to do with that 10% drop last Friday. That was nuts.
It was nuts.
Yeah.
Well, what was the volume earlier in the session on the downside?
To the downside, it's been higher. It was higher before on the downside. It was 40% above the 20-day average. I pulled this up in advance, Carol, knowing that you were going to. I was like, I'm going to nail it today. I'm going to nail the volume today.
Well, you nail it.
Right now,
you nail it every day.
Right now, it's still 23% above. So, the selling, the buying. Overall, right now, to your point, 300 stocks are down in the 500 in the S&P 500. The sellers are in control and charge.
But it's interesting, like you saw, like even a little blip. Was it like around 2 o'clock, and we moved a little bit lower, and then we saw the buyers come back in again?
Yeah. So the sellers don't have the death grip that they had earlier today. One thing I would say, though, technically, it really seems as though we're sliding down to 4,700.
Talk about why that is, because you've talked about that a little bit over the last couple of weeks, and I'm wondering if you're continuing to see the technicals there.
I am. So what we're seeing now is to reverse an uptrend, the uptrend out of the October 2023 lows, that started happening in mid to late February, yet stocks were still going to record highs, but the buyers were becoming more tired, so it was going a little bit more sideways. And then over the last 4 weeks, it started to go to the downside, especially for the Russell 2000, that's even more. Now, over the last couple of days into today, the buyers tried to make a relief rally attempt to break the downtrend. They hit up to another level of descending resistance. So they hit sellers, they didn't have the confidence, Meta happened, and now they're firmly back down in a channel that's expanding, which speaks to uncertainty, it speaks to a lack of knowledge, it speaks to a fear. And it's not just earnings. I feel as though this Fed meeting next week might be kind of interesting. I don't think that they're going to.
I feel like Mike and Michael McKee and Michael McKenzie saying that that's going to be really key next week.
And what were they saying? Because it's some kind of information I hear, and it could be hawkish bearish.
Well, like what kind of tone do we get from Jay Powell, who finally kind of jumped on board
just a couple of weeks ago?
Exactly. So does he double down? Is there more conviction around that? I think that's going to be key.
And it's not just the Fed meeting next week; it's also payrolls for the month of April that come on
But they
Friday.
still
And
thought,
if that comes in hot, though, it's another sign.
And then PCE tomorrow, isn't it?
Yeah.
But they were kind of blowing that off a little.
They said it's
okay.
Although,
well, let's not blow things
But Mike
off.
was saying that but Mike was saying that if it comes in light, because the reading we just got was for the quarter, right? So if we start to see that maybe it's actually coming down this month, maybe that could
be helpful.
Portend that.
But on the other hand, what if it
downward
goes
trend.
higher?
Exactly.
That could be that.
This is
it
why
could
we're
make
all
for an
employed.
interesting.
This is why we are all employed.
Lots to talk about.
Markets move.
They do, and sometimes many times in a day. Abigail, thank you. Bloomberg News Chief Markets Correspondent Abigail Doolittle. That is today's overall trade.
Yeah, and one day after Meta Platforms alarmed investors with its forecast, the stakes are high, Carol, as two of the biggest AI players prepare to unveil results. We spoke earlier about Alphabet. Now it's time to talk a little more about Microsoft.
Yeah, the company due to deliver what is seen as a pivotal report as traders expect fresh insight into how broadly consumers and enterprises are adopting AI services and really what growth will ultimately look like from here. So let's get to it.
Well, we got Bloomberg Intelligence Senior Technology Analyst Anurag Rana joining us from our Chicago bureau. Anurag, good to have you with us ahead of these results from Microsoft. Big picture, what are you looking for from the company, especially in the wake of what we heard from Meta Platforms last night?
Yeah, and always nice to be here. So the big things that we are focused on is what is the AI contribution to Microsoft revenue, and on the second part, we also want to see what is the non-AI tech spending looking like. Just because we have had some pessimistic results from companies like IBM and Accenture that have said that people are not spending as much on older technology products. So those are the two areas where we'll be focused on.
Okay, how do you define non-AI tech spending, or how does Microsoft define non-AI tech spending? Because as you know, these products are increasingly woven together right now.
Yeah, luckily for us, Microsoft actually gives a number when they report their cloud numbers. So last time, for example, their cloud infrastructure product, Microsoft Azure, grew 28% in constant currency. Out of that, 6 percentage points were contribution from their AI workloads. So workloads, for example, on which OpenAI runs, things like that. So there is a little bit of demarcation right now where we can see it. Now, in the long run, I think it's going to be very difficult to see what is AI and what is non-AI.
Well, so how does that complicate your job to kind of make the distinction and figure out, kind of what's moving the needles?
Well, I would say in a couple of years, it's going to be what is the top line growth for a company. I really could care less what they internally qualify as AI and non-AI. So, right now, for example, let's pick a company like IBM. If they're going to grow 4 to 5% and they can talk all about AI they want, is that going to help them grow their top line maybe 10% more, 15% more than the 6% growth that they're going? So is the 6% growth going to go to 7 or 8, or is it going to stick around that 6% range? So I think that is the single biggest thing. What we look for is what is the organic top line growth for a company in order to figure out whether all that they're talking about, the growth drivers, are true or not.
So help me out here, because I just feel like we're so AI obsessed. And, Mandeep was on, Mandeep Singh earlier, and we, talked about a great event that you guys did, the Bloomberg Intelligence team on Gen AI, and really trying to figure out, the impact and the way forward and how it impacts not only our world, but really kind of the investment world as well. Having said that, Microsoft, what's more important? Is it cloud? Is it what they're doing on AI? And I know they all kind of start, I don't know, I just feel like everything kind of crisscrosses against one another. But what's the most important thing?
Yeah, the most important thing right now is the cloud number and how that's shaping up. And the reason is because people understand, you have the Office product, Excel and Word, and if you don't upgrade it right now, you will in 6 months or 12 months. So that's really that doesn't drive the needle. But if Microsoft is becoming one of the favored cloud vendors for people to go out and build their AI products, that helps drive revenue down the stream. And I think that remains the most important data point as to, if people are choosing one cloud provider over the other, is that Microsoft, is that AWS, is that Google, where are people going? Because when you establish products now, then they're going to grow into much bigger products down the road.
How exactly do you look at Microsoft's investment in OpenAI and the relationship that Microsoft has with OpenAI when it comes to what they report quarterly?
It's a very beautiful strategic move on their part because they, obviously, as we know, they really can't acquire anything at this point. So making sure that, they have the investment in OpenAI. And remember, the ChatGPT app that you use a lot, the back end of that is Microsoft's, cloud infrastructure product Azure. So the more you use, the more money Microsoft makes from that. So I mean, it's a good thing from them. And then remember, that was just one piece of it. Second, they're taking the technology from OpenAI and infusing in their own products right now. So whether that's Office 365 Copilot or whether that's the GitHub Copilot, so those products suddenly have been supercharged with certain AI features from OpenAI, which frankly speaking, Microsoft would have had a tough time to do it themselves.
How much does the AI investment that Microsoft has made, or AI technology that Microsoft has incorporated into its products, make the Office suite more valuable, make Windows more valuable as a platform? How does it help those core products from so many years ago, these legacy products?
See, it's like any other software product. It helps you to enhance your productivity. So remember now, you'll be more inclined to stay with that product. You may be inclined to upgrade to the next version of it, which has higher features. And that's really the game at any given point for a software provider. If you have got me as a user and I'm paying, let's say, sake of argument, $50 a month per user in a company, you're going to add a little more functionalities to it. Now you can charge $55 or $60. And that also helps both in